all three industry sectors and the various categories of customers that we manage our business around.
All right, Warren, but do you think that FY25 can be better than FY24 revenue growth of that 10.5% odd?
Well, we don't provide specific guidance, but we continue to be cautiously optimistic in terms of our growth prospects, and we are working hard to satisfy the requirements of our customers and to identify new needs, and that will provide the stimulus for the growth that we are committed to continue to provide.
Okay. For VinFast in particular, Mr. Harris, will it contribute to growth in this current year?
VinFast will contribute to our revenues, but we do not anticipate any growth in the next couple of quarters at least. As with most new energy vehicle companies, once they've developed a portfolio of product, they shift their focus to building and selling that product. And I think that's where VinFast are at in terms of their maturity cycle. And so we think that demand for them is going to have to be confirmed before they extend their current portfolio.
Well, in your previous interaction, you had guided for margins to improve, but margins actually have come off by around 20 basis points in this quarter to around 18.2%. What's the margin outlook from here on?
VinFast will contribute to our revenues, but we do not anticipate any growth in the next couple of quarters at least. As with most new energy vehicle companies, once they've developed a portfolio of product, they shift their focus to building and selling that product. And I think that's where VinFast are at in terms of their maturity cycle. And so we think that demand for them is going to have to be confirmed before they extend their current portfolio.
Finally, sir, what about the order book and the pipeline going ahead? Is there any concern about EV growth slowing down?
Yeah, it's certainly we've certainly built on the order book, and pipeline continues to be strong. There are some specific customer issues that are grappling with the tapering of demand on the EV side of things. But if we look at the macro situation and we look at the overall sector, the transition in not just automotive but aerospace and industrial heavy machinery in and around the move to alternative propulsion systems, the investments that our customers are making in software-defined vehicles, the move to shared and autonomous, those are the tailwinds that we're intersecting with, and we continue to believe that will provide us with sufficient opportunity to continue to grow and expand our business.
Well, thanks a lot for joining in, sir. We look forward to having a chat with you in the next quarter as well, or maybe in the interim. Wishing you a good day ahead as well. Well, let's focus on the big earnings then. Reliance, that's going to be reporting its numbers later today. The street is looking at a modest rise in EBITDA on a year-on-year basis. Sonia joins us to run us through a detailed rundown of the earnings preview. Sonia, take it away.
Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 31.50. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we're expecting a weaker growth on the back of lower gross refining margins and muted growth in the Geo and retail business. Geo is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
All right, Sonia, thank you very much for that. So that's the big number to watch out for today. Well, almost coming up to 9:10. So let's quickly get the day's trading call with Mitesh. Mitesh, which one is it going to be?
So I'll go with a buy on India Mart for targets of 2995 3000 levels.
Okay, all right.
Okay.
Mitesh, India Mart is Mitesh's 9-10 pick. Well, let's just have the Infosys rate in the pre-open and see what the rate is. Take a quick look at what the opening levels suggest. That's a 5% pop at about 1850 at this stage, at this point in time. Nimish is, okay, I think what we'll do is we'll look at the stock in more detail, but the standout brokerage reports are in focus with Nimish, who's standing by. Nimish, good morning.
Hi, morning, Prashant. So today's standout is on ICICI Lombard. Citi, interestingly, has initiated a sell on the stock with a target price of 1575, a potential 16% downside from current levels. Citi believes that while the company's multi-product model, diversified distribution footprint, robust underwriting and strong parentage supports the steady growth and profitability. However, some risk and some headwinds are emerging for the company, which includes disproportionately high and swift increase in the B2B business, which can lead to higher lumpy and ad hoc risk, and further rising competition, which means and there is also reducing distribution mode in the retail segment. So these are the few risks for the company going forward. While elevated investment income in the near term can support the near term outlook, but there are now concerns over the profitability over the longer term, which is ignored by the current market at this rich valuation. So while they have put out some upside risk as well, which includes moderation in the retail competition as well as better experience in the B2B business, but this is a risk for the company going forward, and hence an initiating sell on ICICI Lombard with a target price of 1575, a potential 16% downside from current levels.
Okay, so that's a call that really stands out, a big sell on ICICI Lombard. Got that. Thanks very much for it, Nimesh. We'll get to a report on defense as well, which is coming from Nirmal Bang, which also is, it's quite a view that they've taken. We're very positive on it at the start of the year, but they've turned negative. More on that in just a bit. But going back to Infosys and this 5% pop that we're seeing on the screen, let's run you through some of the commentary. Of course, brokerages are widely positive. A lot of people have increased their targets and their EPS numbers as well. Let's start with Bernstein. The call is outperformed. The target has been increased to 2100. They're saying that Infosys has delivered the strongest beat in 10 quarters. And the guidance has been increased as well. Deal momentum is strong. They see the beginning of an upcycle trend as growth recovers. And BFSI is at an inflection point. So that's one view. That's Bernstein. Moving to Nomura, also a buy call, 1950 is the target price. Nomura is saying that they've raised their EPS estimates by 2 to 3%. It is their top pick in the whole pack. And they're saying Project Maximus impact on margins continues to play out. That's, Infosys' stated objective to keep taking margins higher, and they've delivered 100 basis points improvement in this quarter. Moving to Jefferies, again, a bullish view over here. Buy call 2040 is the target price over here. They're saying that initial signs of recovery in BFSI and strong deal wins suggest that the worst is behind, and that's what's making Jefferies quite optimistic. They're seeing an overall all-round improvement in operating performance also suggests that the worst is behind. Estimates have gone up by about 3 to 4%. They're expecting the company to deliver a 10% EPS CAGR over the next couple of years. So that's Infosys. Lots of positive views coming in today. Okay, I guess with that, we'll move on and go back to that report on defense that I was talking about. This is a Nirmal Bang note, and they've turned very cautious. They had started coverage in the sector not too long ago. They were fairly optimistic on some stocks, but now they're saying valuations are too high. Upasna has more.
Thanks so much for that. Nirmal Bang has downgraded the defense sector to sell. It says that the exuberance around the defense sector has built solely around the strong order book for signing higher valuations. Therefore, the conventional financial metrics does not fully capture the industry's true value. particularly cyclicality, profitability and efficiency. While the brokerage remains structurally positive on defense sector, the current steep valuation does not factor in the risk from execution hiccups, rise in raw material cost, competitive pressures and cash flow generation. Despite assuming extremely strong earnings growth, the ROE estimate for FY26 by Nirmal Bang remains in the range of 10 to 30%. It says that it prefers to remain on the sidelines until valuations return to the reasonable levels. Therefore, it downgrades the defense sector to sell.
All right. Well, we've got the 60 seconds to go for Upasana. Thank you very much for that. We've got 60 seconds to go for the market opening, and I think we'll have lots to track this morning. Infi will, of course, be right off the block with a gain. What after, of course, is the question. Stock's done 12% this month. But, there are lots of brokerages, as Surabhi just mentioned, who are now calling for 2,000 plus rupee price targets here on the name. There's, of course, going to be, the other names. Tata Technologies will be in focus. There'll be, LTTS, which should be in focus. Some of these stocks are coming up on your screen with cuts, 1% lower there. Wipro, of course, is later today. It's a busy day. And, of course, there's the big one, which is Reliance Industries, which also should start up in just a bit. I mean, the opening itself, right? I mean, given the global backdrop is more than anything that one can wish for. It's all 1.5% cuts on global indices. Here, it got a higher start. So 30 points higher. Outsized impact from Infi, I'm assuming. But 24,822. Nifty Bank is, of course, has been the weaker of the two indices. It's down about 100 points. And we're at about 52,500. Yeah, there you go. We've got Midcap Index, which is up about 1/3%. Stocks at about 56,900. And many other names are also starting actually, look at the advanced decline. It's very evenly matched. 800 up and about 757 stocks, which are slightly lower. So it's almost 1:1 at the word go, but all about stocks. Surabhi.
Absolutely. Infosys 3% higher. LTI Mindtree is still continuing its good form from yesterday, 1% higher. HCL Tech, Wipro, TCS. But guess what? Beyond that, things are completely fizzling out. Some consumer names are still retaining a tinge of green from yesterday. Nestle and Tata Consumer, Britannia would be a case in point. But otherwise, the market is reeling under some profit booking. Some of the metal names like Hindalco, Tata Steel, JSW Steel, they are down about 1.5%. Power Grid and Ultratech Cement are some of the weakest names this morning as we start off. There's BPCL, NTPC, so fair bit of PSU. Coal India, ONGC, a lot of PSUs, which are shaking off some of the exuberance of the last couple of weeks. So that's how it is, 33 down on the Nifty right now. Let's look at what's happening to the bigger banks. HDFC Bank is flat. ICICI Bank is down about 0.5%. SBI is also down about 0.5%. So banks not providing any support at this point in time. And Reliance is also quiet ahead of numbers, down about 0.3%. But I guess, Nigel, the bigger story once again is in mid-caps. I mean, and like yesterday, we had the big, wobble, the shakeout yesterday. Even right now, mid-caps underperforming at the start.
Well, as you did that market check, the Nifty has come off 100 points from the high point of the day. So there's been a bit of a sell on the opening in today's trading session. And the mid-caps, they are the ones that are pulling back. You have nearly two stocks that are declining for one stock that's advancing. Let's see how that goes. The sector that's coming for a clonk today is actually the tire space. Ceat came out with its set of numbers. Margins continue to remain under pressure. The hope is that they've taken a couple of price hikes, so hopefully things improve from here on. We'll get chatting with the management in just a bit. That's down 0.5%, but Apollo Tyres is down close to 6% as we speak. So big pullback on that one. Balkrishna Industries as well as down close to around 2%. And you had MRF that's pulling back by 2.5%. So the tire space has come in for a bit of a knock. Persistent Systems, the top line growth was okay. The problem was on margins. The street hasn't taken that kindly. That stock is down closer to around 6%. LTTS had started off in the red, but that dip got bought into, so the stock is now down only around 0.2%. What's doing well? South Indian Bank, I think that one as well came out with its set of numbers. That's seen a big uptake in today's trading session, so a pop is what we're seeing on South Indian Bank. Indus Stars, we had highlighted this yesterday as well, that from the telecom pack, it appears this one looks best placed. And that one, in fact, yesterday was higher. Today as well, it's moving a little bit higher. MTNL is moving on hopes that maybe some kind of a package or something moves in the right direction for them. The other stocks that are on focus, the Dalmia Bharat opened up well in the green. But that's, sold off actually from the high of the day. It was up close to around 2%. And after that gap up, the stock is now down close to around 1%. So clearly the street believes that there is some kind of a one-off in these numbers. And those numbers couldn't be that good, given the kind of pricing, the kind of volumes that they reported.
JSW Infra is also a weak one, again reacting to numbers. Yeah, but the margins cooled off a lot. Margin fell almost 10 basis points. 61% became 50% in this quarter. Stocks down about 4%. So some result reactions playing out. Persistent is now down about 6%. So sharp reactions there.
No, absolutely. And, market's down about 55 odd points or so. I just want to highlight one more thing. You look at the Nifty Alpha Index. So the Nifty is, actually with a 50-point cut, it's what? A quarter percent, not even a quarter percent down, right? 0.2%. But look at the Nifty Alpha Index, which is essentially the high momentum pack. And I was highlighting this yesterday during the closing hours as well. That's down a full 1%. So that is telling you something. This is the high momentum part of the market where the cracks are emerging in a much more significant way. So broader markets, yesterday's rally also in a way was a kind of a one-trick pony. IT was the sort of, big leader. Today, once again, I think a lot of it has got to do with what Infi and maybe a couple of other IT names are doing. But more stocks coming through in just a bit. So Persistent, I think we mentioned bulk of the big ones. Apollo is down 7, Persistent is down 5, Chennai Petro is down 8%. It's got very large volumes for this point in the day. Oil India is down 3, JSW Infra is down 4, NLC India, Borosil Renewables. I go down the list, but the volumes will start to dry up here. And on the upside, market breadth is clear slam dunk negative. 1,600 stocks are down and 500 stocks are up. That is market breadth. This is still very early, but it gives you an indication of how things are kind of sitting very, very early in today's session. On the upside, IREDA is up. Torrent Power is up 2%. Cyient has got some gains. VST Industries is a big one. That's a 10% mover on VST. Very large volumes coming through. So that kind of stands out at this point in time. But I think we have a market master ready. Nisha is with us, Ruby.
Yes.
Just a couple of points. Chennai Petro has gone ex-dividend, I think so. So that's the reason why, in fact, the stock is low.
Okay, all right. So let's take this conversation forward with Nisha of Kotak AMC. Thanks, Nilesh. Great to have you on. Pleasure. Busy season, earnings, markets roaring, budget around the corner. So what do you make of things? And we know your view. You've been sort of asking investors to be a little cautious, but investors have a mind of their own, and this market has bought every dip up until now. How do you view the current market construct?
So there is a very great saying which says that markets can remain irrational more than you can remain solvent. So we have to respect market momentum. But when I was a kid in 1977, there was a movie called Amar Akbar Anthony. This market reminds me of Amar Akbar Anthony. Amar was an upright police officer. What is the quality stock? Reasonably valued stocks, stocks where there is high floating stock, kind of signify. On the other hand, Anthony Bhai was Chalta Purja, naughty, mischievous, far more entertaining. There are many stocks which are in momentum, where floating stock is limited, where valuations are sky high. It's entertaining, undoubtedly. But we all know, in the end, Anthony Bhai has to converge to Amar and Akbar and become upright. I think it's time to buy Amar Bhai equivalent stocks. Try to slowly take profit from Anthony Bhai equivalent stock and wait till such time they join the bandwagon of Amar and Akbar.
Nilesh, you always have the best analogies. I don't know how you come up with them, whether you think it through or whether it's spontaneous, but it is literally the best. And it sort of explains the point so well. The issue right now is that, Amar Bhai has been sort of walking a very lonely path for a while now, and I'm talking about FMCG stocks or even banks for that matter, because a lot of people feel that Amar Bhai doesn't know how to run. So you have to leave Amar Bhai aside and think of maybe Akbar or Anthony. But to come back to the more serious point, IT has started delivering. We are seeing, first signs of perhaps a bottoming out over here. What about banks? What about FMCG? How much would you allocate to these in the portfolio now, given the market?
I think both these sectors have underperformed market for some time, and valuations are fairly attractive. We believe both these sectors have potential to outperform the market once momentum trade starts playing out. In FMCG, elections have given money in the pockets of consumers at the bottom end. Many of the state budgets are also putting more money in the pockets of consumers at bottom end. We believe budget will also provide boost to the consumption through investment in infrastructure as well as some direct benefit transfers. Monsoon is progressing on average monsoon, normal monsoon. Put all these things together, FMCG should start outperforming the market over medium term. Of course, within FMCG, you'll have to avoid those FMCG sector which is becoming like telecom sector, hyper competitive. Their profitability will go for a toss. You'll also have to look at those FMCG stock which is now catering to mass market products rather than just premium products. And most importantly, we are seeing unorganized sector bouncing back in FMCG with their innovative strategy. Who would have ever thought that a namkeen maker could command a very high valuation if gossips are to be believed? So innovation will be key, adoption will be key, but I think FMCG is one sector to bet upon over medium term.
We know our Amar Bhai for now. Nilesh Bhai, hi, good morning. Prashant this side. So, you know, in two sessions today and Monday between now and the budget, right? That's the big, going to be the big talking point, and we'll of course look forward to getting your insights once the budget is out. But right now, I think we can, for a short bit, talk about what the expectations really are, right? And from a capital market point of view, there is always this talk about capital gains and what will happen to capital gains. But there are also nuances. For example, for the mutual fund space, one big category which has taken in so much inflow has been arbitrage funds, and which have done very, very well. Some chatter amongst taxation experts that we could actually see some we could see some changes to that category as well. Arbitrage funds right now enjoy equity taxation, and there is some chatter that that may change. I mean, we don't know, but I just wanted to sort of touch upon that. Your thoughts, Nilesh Bhai?
So, Prashant Bhai, many centuries ago, Kautilya mentioned that taxes should be collected like honeybees collect honey from the flower. I don't know whether Kautilya was aware of equity arbitrage fund or not, but definitely he hinted towards equity arbitrage fund. This fund gives investor perception that their income will be taxed at 15%, as majority of investors are in growth plan and keep money for less than 1 year. Arbitrage fund is classified as equity fund, and hence any earning of arbitrage fund in growth plan for less than 1 year is taxed at 15%. The government actually laughs all the way to the bank because arbitrage fund continues to roll over their future position every month, and in that they pay STT. The STT paid in last 3 years in Kotak Equity Arbitrage Fund between FY22 to FY24 is 1.1% to 1.56% of our average AUM. As a percentage of return declared in FY22 to FY24, it is 18% to 22% of return. And more importantly, arbitrage fund is only one trade in the market. If I am going short future, there is someone else who has to go long future. Otherwise, my trade will not go through. So the market participants, the long-only participants, pay another 18 to 20% of their return by way of STT. Collectively, 15% STCG from investor, 18 to 22% STT from the fund, and 18 to 22% STT from the market. The average tax collection for the government from equity arbitrage fund is 51% to 59%. Average of last 3 years is 56%. Where else this Kautilya's example of collecting taxes like honeybee collects honey is better illustrated. So my recommendation to Honorable Finance Minister will be, you should devise more ways of taxing like equity arbitrage fund, where you get more than maximum marginal rate of tax of 39%. And more importantly, investor is happily paying. There are also advantages of equity arbitrage fund. It provides financing to the long-only participants. And many a times, thanks to market efficiency, long participants are borrowing at rates which are very, very competitive. Without arbitrage fund, do you think retail investors would have bought 21,000 crore in cash market on budget? Probably no. So arbitrage fund is the perfect example of Kautilya's way of collecting taxes, and we should devise more instruments in that.
Okay, that's an interesting point. I don't think, at least I didn't think of it that way. But yeah, that's staggering STT collection for the government. It's a win-win, as they say, right? But you know, broadly on taxation, Nilesh, and I'm not getting into whether the 10% rate changes or not. From a mutual fund perspective, is there anything else that you would like to see? Because the debt blow was dealt about a year and a half back to the industry. Arbitrage is, hybrid is still a category where some funds still manage to get more efficient taxation. Any further tweaks that you would advocate?
So my only humble submission to Finance Ministry is that the tax incentive should be for the right opportunity. For example, Surbi, all of us would have put money into public provident fund account. Our parents taught us that from your first salary, please open PPF account. We did some calculation back of the envelope. If you had kept on putting 12,500 rupee every month for last 25 years, you would have put 37.5 lakh rupee in PPF account over last 25 years. PPF account interest is tax-free. The total value of that PPF balance from 37.5 lakh rupee would have become about 1.07 crore tax-free. On the other hand, if you had done same investment in SIP of an average equity-linked savings scheme, I'm not talking about the best performing equity-linked savings scheme, just average, the value would have become about 4.4 crore taxable. You remove taxation out, you still make 3 crore extra on 37.5 lakh rupee of investment between PPF versus ELSs. And markets have run up after I did that calculation. Now, where should our government give incentive? PPF is 15-year plus 5-year plus 5-year kind of investment. And we are giving incentive for long-term investment in fixed income. Shouldn't we be giving incentive for long-term investment in equity, which will create value for our citizens? How many Indians have 3 crore rupees as retirement package or as retirement kitty? Just one decision of choosing PPF over equity-linked savings scheme could have made that difference in 25 years. So my humble submission is there is lack of financial awareness among many Indians or most Indians. SEBI has done a fantastic work with mutual funds, sahi hai, but we have a long distance to cover. Our tax incentive should be for long-term investment, which makes India financially secure.
Okay, all right. I'm sure what you're saying is being heard.
The message is don't fix what ain't broken. So, I mean, just let it be more than anything else. Nilesh, by great conversation. Thank you very much. And I think those numbers put a lot of this, a lot of the arguments in clear contrast and perspective. So thank you for joining us. And as I said, we look forward to speaking with you once the budget is actually out. That is, of course, on Tuesday. I think the market's down about, what, 50 points or so, 24,753, guys.
Okay, let's move on. We have a corporate conversation now lined up. The stock in focus is Ceat. Now, it's been a mixed bag for the company in the first quarter. Revenue saw a healthy growth, but margins have fallen for the third straight quarter, impacted by higher input costs and rubber prices, which have been rising higher. To talk about the performance and the road ahead, we have Mr. Arnab Banerjee, MD and CEO of Ceat, with us. So let's start with the performance. Revenue up almost 9%, but your margins are under pressure. Is it just raw material? Is it something else? Do you see this pressure coming off?
So when should I
think you're on mute.
Sorry about that. So good morning. The revenues have indeed taken off well with double-digit growth in replacement and international market. These are the two profitable segments which have moved up now to 75% saliency overall. Margins are under pressure primarily because of input costs. I think we have doubled down on efficiencies because of our lighthouse implementation in Halol as well as Chennai. Manufacturing cost has come off well. It's primarily natural rubber, which is at a 13-year high within a short span of time. And as I had been mentioning earlier, if the inflation happens gradually, we can manage the margin easily. If it happens in a short span of time, like it has happened this time on the natural rubber front, it has an impact on margin in a quarter kind of time frame because price increases which are happening with a lag.
All right. Hi, sir. Good morning. Nigel on this side, and good to see you in. Give us a number, the average price of rubber for the past quarter. I think it was hovering around 150 per kg. Then it went to around 190 per kg. So what's the average for quarter one? And at current reckoning, what is it?
So it's close to about 185 to 190 in quarter one. And right now it's hovering at around 209 as we speak. So we expect this to stabilize and taper down as the tapping comes out. And there's a huge amount of rainfall also in the southern parts of the country. Container availability for imported rubber is also an issue right now, so which is leading to speculative activities. We expect this to stabilize by mid of quarter two. And hence, we don't see it as a very long-term trend. And this spike should stabilize and start coming down.
Okay, what does it mean in terms of margins then? Because margins have come down from close to 15% to around 12%. But to be fair, Mr. Banerjee, you had indicated in your last interaction with us that the first half of the year would be weak and then you expect it to recover. So do you see it recovering in the second half of the year? If yes, should we get closer to around that 14% odd mark?
Yeah, I've been mentioning that we would like to keep our margins within a narrow band, and we've just fallen a little bit behind of the lower end of the band at 12%. Quarter two, the raw materials basket is expected to rise by another 5 to 6% over quarter one. So quarter two, the price increase impact which happened in quarter one also will be felt in quarter two. We have to manage quarter two prudently. And thereafter, we expect the pressure to ease out in half two of this year. And we are also seeing a very robust demand in margin accretive areas, which is international sales, two-wheeler sales, rural demand is coming back, and also passenger car tire sales where we have started investing heavily.
Got that. Mr. Banerjee, hi, good morning. Prashant here. So just to stick with pricing for one bit longer, some have made the case that there is there is structural sort of pricing, a pricing strength available in the industry, and you're kind of well capitalized to take advantage of that with your brand, etc. Is that really the case? Right now, of course, prices are going up because you need to, and that's happening with a lag, as you said, and things will stabilize in a quarter or two. But is that are underlying conditions favorable to support slightly premium pricing over a period of time?
Absolutely. The key enabler is the demand situation. I think replacement demand is pretty good. Commercial segment, passenger segment, as well as two-wheeler segment, as I mentioned, the rural demand is coming back. Rural growth is higher than urban growth. So if the demand situation is supportive, we will be able to take pricing up in passenger as well as in truck bus radial, where our products are getting accepted because of superiority in performance. Which is being seen by the end customers through repeated trials and efforts over the last few quarters. So we are pretty confident about being able to take price up, but it will happen with some lag.
Okay, very quickly, Mr. Banerjee, you were targeting high single-digit growth, volume growth for the year. At current reckoning, do you believe that you can get to that? And coupled with the price increases, do you think the revenue growth for the year should be in the vicinity of around the mid-teens?
Mid-teens exactly, I cannot say, but definitely double digit. We are pretty bullish on the top line growth and in the right areas, which is international. Our order book is absolutely strong. And there's some disruption, as I mentioned, because of container availability and freight rates, etc. But on a long-term period of 2 to 3 quarters or 4 quarters, we are pretty much confident on that front. Our two-wheeler sales is robust. Our four-wheeler sales is going to improve in future, and we have done remarkably well on the commercial vehicles tire sales also. OEM was a little bit subdued for us in quarter 1, which is expected to pick up with the new models which are getting rolled out on Ceat tire, and we are nominated on that. So we are quite confident of double-digit growth.
All right, double-digit growth on the top line with the margins headed, towards that 14% odd is what you're guiding for. Thanks a lot, Mr. Banerjee. First quarter a little bit weakish, but hopeful of a recovery in the second half of the year. For the time being, we slip into a short break. On the other side, we get chatting with the management of Tata Communication and Polycab. Welcome back. This is Corporate Radar. So let's get straight to our next management. Tata Communications, that's a stock in focus. For quarter 1, their data revenue saw 20% growth on a year-on-year basis, while the digital portfolio revenue also saw a 51% growth. Their margins are also improving on a sequential basis. To understand what's the way ahead, we're joined by Mr. Lakshmi Narayan, the MD and CEO of Tata Communications. Hi, sir. Good morning, and always good to see you in. We have the overall growth picture. That's at around 20% odd, but you had done some inorganic growth. So what was the organic growth for the past quarter?
Yeah, so we don't really call out the organic growth. The reason being there are 2 acquisitions that we did last year. One of them being Switch, which we acquired in May last year. So it's nearly 1 year, 1 full year is already over. And right from the day 1 of the acquisition, we have been managing the 2 teams as one single team with one single leader. Similarly, on Kalera, which we closed the deal in October, right on day 1, we announced an integrated management team of Kalera. And Digo, a product that we launched 2 years ago, was doing very well in the market. We essentially brought Digo and this together with single teams. So we really can't distinguish the Digo growth from a Kalera growth, because in a go-to-market, we integrated the teams from day 1. But having said that, there are a couple of more point-worthy data points to note in our digital portfolio. Obviously, now the customer interaction suite and therefore the entire collaboration and customer interaction suite is a very large part of our digital portfolio. The cloud and security portfolio has grown very well. Our media portfolio has shown a very significant jump on Q-on-Q, as well as on year-on-year, on the back of events pick up in the last quarter. And also, we have seen a fairly significant growth in our connected solutions portfolio, particularly Move. We have seen a good growth both in the MNO segment that we operate, as well as in the automotive OEM segment that we operate. So these are very notable callouts from if you will, the organic portfolio, if you will.
So just to kind of get that point, you don't reveal the breakup, the numbers, but the reason we are asking is that there seems to be some concern that while the inorganic moves that you're making, those are really delivering growth, there's some confusion about what's happening to the organic business and the organic revenue. So going forward, can you...
Yeah. Sorry, I think that's the reason, sorry to interrupt, but that's the reason why I'm calling out individually. So the media portfolio Switch is already 1 year, right? So give or take 1 month, and it's been operating as one. And this quarter, we have shown a good Q-on-Q growth of 9% and year-on-year growth as well. On the only portfolio there has been a blip is in the next-gen connectivity, and that is a customer-specific issue that we saw a blip in this quarter. But last year, we grew the next-gen connectivity very well. The ISO Multi-Cloud Connect product that we launched has seen nearly 40-45% growth year on year. And Move platform has shown growth. So I think overall in cloud and security, we have seen a double-digit growth. So these are all the other portfolios in our digital, which was not influenced that much by inorganic acquisition. So that's the point I wanted to make.
Got it. So basically, organic growth is also, chugging along. No reason to worry over there. Got that point. Let's talk about the data growth.
Sure.
Yeah, sorry. Yes.
No, I think, they are chugging along, as you said. I think we have to be also very conscious of the macro environment. We all operate in the same space as other players are operating, and people have been calling out the slowness in the macro environment. And that applies equally to us. The only thing I would call out is, despite that, we have achieved good growth and we've been able to give an uptick in our margins, which I think is a commendable performance by our teams.
Sure. So let's just talk about the data growth. The revenue growth there is about 20%. In the last 2 quarters, it was a lot hotter, almost 26, 27%, 28%, I think, as well. So what is, either those quarters were a bit of an aberration and a lucky blip, or a good, blip in terms of a good quarter. What is a more sustainable run rate? And you also mentioned that the environment has been sluggish and challenging. Does it continue to remain so? And on data in specific, what is the kind of growth you can guide for?
We don't want to give any guidance and start a new practice, but I think the environment is still cautious. I think the environment in the US, with the elections and expected rate cuts, not knowing when that will happen. So there are these environmental factors. But having said that, our international markets have grown very well. I think in our digital portfolio, the way I see it is, the 4 pillars of our digital fabric: the network fabric and the cloud and security fabric. So these 2 fabrics are, I would say, somewhat immune to the macro, and I think we expect that because people look at more cost efficiencies, more global contracts. How can we consolidate global vendors into that? So I think those 2, regardless of the macro, should do very well. The customer interaction portfolio is more discretionary because it's more dependent on marketing spend. And so there are 2 types of interactions with customers. One is on marketing and improving the customer experience on after-sales service. And the other is more about authentication and so on. So that is somewhat dependent on the macro and somewhat cyclical. The IoT fabric, again, is somewhat discretionary because people would want to invest in delivering connected solutions and delivering better connected products to deliver better experience. And that would come under the discretionary spend. So that's probably how you would look at the impact of the macro on our portfolio.
Okay. All right. Mr. Lakshmi Narayan, let's ease you out a little bit. We're not getting too many numbers from you, but let's compliment you on the margins. You have said that in the past that gradually you see margins move towards that band of 23 to 25%. And on a sequential basis, there is some improvement. So tell us, for this year, how much, better can it get from what you've delivered in the first quarter? On an average for FY25, what can it be? And by when do you get to that band, 23 to 25?
So firstly, on the 23 to 25%, we said that that's our medium-term target, and we would get there in a couple of years' time. This quarter, we are very, very pleased to see the uptick from the exit of last quarter of 18.5% to 20%. And we anticipate that we will retain at this level and gradually start to improve in the coming future quarters. So because at the increase in margins are on the back of a lot of activity that is going on to bring the benefits of synergies and the programs that we are running inside the company to deliver better operating leverage. But having said that, we are also investing even further in developing more within this platform. So Kalera, for example, as a result of the acquisition, there are some cost synergies that we are working on, but we are also investing in expanding the product portfolio to move beyond SMS to to WhatsApp and other channels, and we are building out the software platforms on top. So those investments will continue. And therefore, we would gradually improve the margins. Our focus is to get to the 23-25% in a couple of years' time.
So FY26?
You can say that, yes.
Okay, all right. You also said that you're looking at doubling your data revenue by FY27. The street believes that looks very, very aggressive without any more M&A. So that guidance that you've given of doubling it, does it include some M&A? And if yes, should we hear about something in this fiscal itself?
No, firstly, I just want to correct, it's not a guidance. We said that is our goal, and we set ourselves a fairly ambitious target. So looking back at, our performance over the last 5 years, it's been largely focused on getting our balance sheet right. It's been getting the margin profile right, the operating model right. And having done that, the choices was, we stay there and deliver low growth but high margin, or deliver a faster growth. And in order to deliver a faster growth, and also to become a lot more relevant in the digital journeys of the customers, we had to expand our portfolio, and we have to invest in strengthening our products and platforms. That is exactly what we said we would do, and that is what we've been doing. And last year, we have invested over $600 million in all the capability enhancements, organically and inorganically. So, that's a picture that I wanted to paint, to let you know that we are investing for growth, right? And that's the motion that we're now. And because that we've said that ambition is that, and we are investing, we are already beginning to see that our relevance with our customers are increasing. And it depends on when the macro conditions will improve. We are very well prepared and set up in order for us to achieve the growth targets that we've said we will.
Okay. All right, sir. We will leave it on that note for today. Thank you very much for joining in and giving us some perspective on your business. Well, with that, we'll move on to our next management conversation, and the focus is now on Polycab. Now, the first quarter was actually a miss for the company on all fronts. EBITDA margins were under pressure due to a change in the business mix. The cables and wireless segment saw some good revenue growth, though. So let's talk about the outlook going ahead. We've got Inder T. Jaisinghani, Chairman and MD of Polycab, with us, as well as Gandharv Tongia, ED and CFO of Polycab. Gentlemen, thanks very much for joining in. Mr. Jaisinghani, if I could, come to you for the overall picture, because, if you look at the first quarter, the year is not off to the good start, because there was a miss in terms of the top line, the margins. I'm talking about analyst expectations over here. So can you tell us what the environment is like for the cables and wireless business, as well as your FMEG business, where the good news is that the losses seem to be reducing and, things are looking better?
FMEG now it is growing because we are increasing our network, and already we are bringing with the new varieties and capturing right market. But it will take further time. But we are at least at par now, and we are coming to this year in the profit, and it is going to grow continuously at a 20-25%.
That's FMEG, sir. So 20-25% growth on your FMEG business. Profits this year will turn profitable. We got that. Just start with the headline on the basic business, cables and wires. What's happening there?
Cable and wire business also is good, but because of today, depending upon because of volatility of the market, and all dealers distributors are trying to reduce their stock, but overall demand is good from both the point of view, dealer network and the infrastructure. There is a good demand, and I think so continuously it is going to grow. There's no short of any demand.
Okay, all right. Good morning, gentlemen, and good to see you. When the last reported market share that I have is around 25% in the wires and cables business, and it appears, in comparison to the other listed peer, you have grown faster. So, have you gained market share in the first quarter?
Yeah, we are.
Yeah, thank you, Inderbhai. It will be difficult to make that statement at this stage because the other listed companies have not yet published their numbers. But it seems that we are continuing with our growth trajectory, and this year also will probably end up having some gain in market share.
Okay, good on that. Just one more quick point before we get into the nitty-gritties is that normally you'll mention that Project Leap, which had that target of around 20,000 crores odd. But I think in yesterday's presentation, it was missing. Are you coming out with a fresh guidance? 20,000 crores in this year, and 2026, it looks even better. Before your analyst call, I wanted to know about that because that was a notable miss yesterday.
Yeah. You are perfect in your detailing. You're right. So in 2021, we embarked on this particular project. This is a transformation project, and its name is Project Leap. BCG, or Boston Consulting Group, is helping us on this project. And under this project, we wanted to attain a top line of 200 billion or 20,000 crore rupees by fiscal 26. And as you know, in the last year, fiscal 24, we had achieved almost 18,000 crore rupees of top line. So in the current fiscal, we'll recalibrate our guidance because 20,000 crore rupees we should be able to achieve sooner than FY26. And between second quarter and third quarter, we should be able to come out with the revised guidance.
Okay, but 20,000 crores looks like maybe you'll get to it in this year. Don't you think it's possible?
I think what we can certainly do is we will continue to grow at a rate which is going to be better than the industry growth rate. And if that happens, it's quite possible that we are able to achieve 20,000 crore rupees top line before the FY26 deadline.
Okay. And what about margins, Gandharva? The dip that we've seen this quarter, I'm just going back to the headline margin number. So you're at 12.4 versus 14%, 14.1% last year. Now, is this a temporary blip? How do you make up for it? And how does the rest of the year look?
You're right. In fact, last year we had a dream run. We had almost 30 to 40% volume growth. The top line grew from 14,000 crore rupees to 18,000 crore rupees. Even the EBITDA as well as PAT margin expanded. The PAT margin was almost 10%. Against that great performance, even the current year, we have started with a positive growth. The top line grew by almost 21%. This is again the best ever first quarter performance of the company. And as you rightly noticed in your opening remarks, there is a change in the mix. The EPC business, which used to contribute almost 3% to our top line, in this particular quarter has registered growth of 292% and contributed almost 10% to our top line. Historically, EPC businesses are less margin business than our cable and wire business, and that is why the blended margin has contracted to 12.4%. The other two reasons why there is contraction is the exports business registered a bit of a degrowth, and exports margin is comparatively better profit business than our domestic business. And the third is the channel business registered a bit of a degrowth in the month of June, and the institutional business in domestic market registered a very solid growth. So because of these changes, there was a mix at the company level, and that is where the contraction was noticed. In general, we are comfortable having a EBITDA guidance of 12 to 14%, and this quarter also it was within that particular range. We believe that in the quarters to come, we should be able to maintain and improve on EBITDA margins.
No, but 12 to 14% is still a band, and I'm trying to understand whether, realistically speaking, whether you will be at the lower end of that band because of all the factors you mentioned. It's not just one factor. Mix is just one issue. Lower exports and the channel issue that you spoke of. So how many, out of these three issues, which ones do you think will start reversing, whether the cables and wireless growth comes back enough to ensure that you remain closer to 14%, the top end of that margin guidance band?
So as far as the domestic cable and wire business is concerned, it is dependent on volatility in copper prices. In this particular quarter, there was a fair amount of volatility. Copper moved from close to $9,000 to almost close to $11,000. And yesterday it was hovering around 9,300, 9,400 levels. So if that volatility continues, it might have some impact on the immediate term basis. But if we were to take a mid-term view, we believe that we will continue to grow at a rate which is going to be better than the industry growth rate. And in that case, we should be able to operate at a higher end of the EBITDA margin guidance of 12 to 14%.
Okay, all right. So you're maintaining that. And just to reconfirm, if you have to revise your guidance, it will be done in the second half of this fiscal, right? Quarter 3, quarter 4, if in case you want to revise it.
Yeah, we will certainly revise the guidance and we'll try to do it at the early, but safer to assume that we should be able to do it in the second half for sure.
mathematically, that guidance actually is not very material right now, just mathematically, but you all know how business is trending on ground, so you all be the best judge on that front. But you mentioned the international business, which has degrown more than 25%. And I think the contribution has come down to around 5.5–6% odd. Earlier, you all had guided that, say, by the end of this year, it moves to around 10 to 12%. Do you maintain that guidance that things recover from here on? And by the end of this year, we'll still have 10% of your total revenues coming in from the international business?
You're right. Our guidance till fiscal 26 is to have 10% exports contribution to the company's top line.
Yes.
You are right that in this particular quarter, there was slowness and sluggishness, which was noticed. This was predominantly coming from a particular geography. Outside that geography, other geography has registered growth. And we believe that in quarters to come, we should be able to move towards 10% guidance.
So you believe that things will recover then from here on, right?
You're right.
Okay, all right. Any update with regard to the conversations you all were having with the tax authorities? That was a bit of a blip that you all saw late in December, but the market seemed to be in that sort of a mood that they bought that dip and the stock price is much higher. Stock price aside, have you all heard from the tax authorities?
So we have not received any demand or any notice from the Income Tax Department, alleging what was stated in the PIB release. We are in discussion with the Income Tax Department. We have been told that this is a time-consuming process, and as and when we receive any notice or any further communication, we will continue to notify the stock exchanges as we have done over the last several months.
Any timeline indicated?
This is a government-led initiative, and there are timelines under the Income Tax Act. I've been told that in general, they should be able to wrap up such exercise within the 12 months of the end of the fiscal in which the search was conducted. That means that by March of 25, in general, the department should be able to conclude. But these are government timelines, and they are dependent on several ifs and buts.
No, but it's still helpful, and appreciate you being candid about it. It just gives investors an idea about sort of what time frame to work with, because this is still an open issue. There is no statement from the tax department saying that there is absolutely no demand. So it's still sort of lying open. Just to talk about, some final issues, let's get back to Mr. Jaisinghani as well. Sir, you were in the midst of a big CapEx rollout plan. What are the capacity utilization levels right now? How much more capacity would you be adding? And in terms of top-line growth, what is the further impetus we can expect with this CapEx coming on stream in FY25 and FY26?
Basically, today we are capacity utilization around about 70 to 72%, and continuous demand is there, and a lot of variety we are adding in our cable line. Special cables, we are coming with the EHV cables, we are coming with the which is required in the electricity board, MECC cable, aerial bunch cable. So a lot of new variety also we are going to make it. So we are continuously putting in a capex, which is going to give us at least 20–30% more coming time, our revenue, and with the good reasonable profits.
Okay, all right. Final question then, Mr. Jaisinghani, before we let you go. The promoter holding, a couple of years or so ago was around 68.5%. It's come down a little sub that 65% because of that small stake sale that we saw in the month of June. What's the plan? I mean, you're still very much in control of the company, but since the stock price has moved and you would have worked very, very hard to build the company, do you believe that you could sell a couple of more percent, given that demand is so strong for your stock, and you could take some money off the table?
No, we are sometime require in a family something which is the family has to decide. So we had decided whenever we see that the right time in coming 3–4 years, we are doing sometime in 1–3–4 years. But that we are together thinking very clearly that what we have to do, what required for our family. That's all.
Okay. So it was a family requirement. That's why you sold that 2% odd. But is there a plan that there could be some further requirement where you could bring your stake down by a couple of more percent, say to around 60% or thereabouts? Could that be a part of the plan?
No, that is not in our mind at all.
So as of now, no more stake sale from the promoter.
Okay, we got that. That's a no that we have noted and registered. Got it, Mr. Jaisinghani as well as Gandharv. Thank you very much for joining in and taking questions today. So that's Polycab with how they're viewing the business going forward, saying that the FMEG business will be profitable this year. It already, I mean, at the EBITDA level, it's already looking better in the first quarter, and they're expecting to hold margins towards the higher of that band of 12 to 14%. 20,000 crores in revenue is the target for the current year as well. Stock is doing well, but the market really isn't. Check out the screen now. The mid-cap slide has expanded. There's a 1.4% drop at the index level. The advanced decline ratio is very negative. 1,800 stocks down now. Just about 440 stocks on the upside. And even the large caps are feeling the heat. Pull up something like TCS, which is sort of barely positive. Look at Infosys, which is still retaining a 3.5% up move. But a lot of the other tech stocks are seeing profit taking. Case in point would be a Wipro. Look at a Tech Mahindra. These are some of the stocks on the way down. So good time to bring Mitesh back in as well. Mitesh, profit taking going on as we see things. What's your advice for now? Index level stocks, what to do?
Surabhi, I think yes, some sort of profit taking at least is happening, especially in sectors like metals, two-wheelers, etc. And I think that's where some weaknesses can be seen. IT today is reacting like a misbag, but FMCG is doing good. So I think we'll approach the market that way. On the Nifty per se, maybe levels of 24,550 on this spot could be the support area. So we might in the next 1-2 days head towards there as we also run into the budget event. Some profit booking can happen. So we'll keep a watch at 24,550. But on the Nifty, I said in the morning around 24,950 take profits, but we didn't get those levels. But even now, I think exiting may not be a bad idea. It does look like a heavy market. Having said that, I have a sell on JSW Steel. Keep a stop at about levels of 925 and look for targets of 880, 875. Sorry. And a buy on Coforge with a stop at about 6,000 for targets of 6350.
Okay. All right, Mitesh, thanks very much. Got that. We'll come back to you during the course of the day. Let's see how it progresses right now. About a 90-point drop on the Nifty. We'll take a break, come back with a lot more on the other side, a lot of the stocks that are making headlines this hour.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
Did lose an American hero that day. We wish that he were with us tonight, but his memory will live on forever in the hearts of his family, his community, and the nation that he loved. This November, we have a choice. It's a choice between one team that wants to build this country up and another that wants to tear this country.
Welcome back. Well, let's focus on a couple of stocks that are making the headlines. Market overall is, of course, down. Let's look at Persistent Systems because that stock has sold off quite a bit after the first quarter numbers. Rima, what has gone wrong?
Well, growth for Persistent is very strong, but the street is a bit concerned about the margin performance. So we told you about the reported margins. Reported margins were also a miss. They declined by 40 basis points to 14%. But you know, this reported number of 14% has certain one-offs. One-offs related to reversal of earnouts, incentive structure, there is a change in the depreciation policy, etc. Now, according to one of the analysts, the adjusted EBIT could be as low as 9.5%. Now, everyone's calculation is a bit different. I tried to reach out to some more analysts. Not everyone's on board with this 9.5%, but the key takeaway is that this margin number has got some one-offs, and therefore the actual adjusted margin would be lower. That said, the management in the conference call was today morning at 8 o'clock. They said their endeavor is to, grow well and keep the margins in FY24 similar to last year. Another point to note is the strong outperformance of the stock. Since June, which is when the IT rally began, Persistent is up 35%, while the Nifty IT is up 24%, and valuation premium of Persistent has also shot up. Back to you.
All right, got it. Thank you very much. That explains the stock reaction. It's a pretty sharp reaction on the way down. Persistent, a bit disappointing this quarter. Let's move on to JSW Infra. We're again talking about a result that has missed expectations. Vivek, what are the issues here?
Well, it's a soft start as far as JSW Infra is concerned for FY25. Analysts on the street were penciling in a volume trajectory in the range of 30 to 31 metric tons. And in fact, consensus seems to have missed the fact that there was a shutdown, a maintenance shutdown as far as JSW Steel's Dolby plant was concerned. On the back of that, the volumes that have been declared have come in close to 28 metric tons. So looking at the actual numbers, revenues higher by 15%, EBITDA down 6%, and margins at 50%. The effective tax rate this particular quarter was higher. That also impacted, the entire P&L. Profitability down 7.2% on a year-on-year basis. Now, what is the good part of the result? The good part of the result was that the third-party market share has actually risen to 50% in this particular quarter, versus, just around 37% in the quarter gone by. Now, what impacted the volumes? The one-off, as well as, there was another issue. Dharamtar as well as Jaikar port volumes were actually lower this time around. What aided the volume trajectory? There was incremental volumes seen from the acquired assets, as well as increased capacity utilization at Paradeep Iron Ore and Coal Terminal. Brokerage is our mix, while, Kotak has a slightly negative stance with a sell rating. BNP Paribas believes that given the fact that the company has acquired new assets in the form of Navkar Corporation, there is a possibility that Q2 and H2 can actually be quite strong, and the company will be able to meet, and in case the performance is quite good, it may be able to even beat its own volume guidance given.
All right, Vivek, thanks very much. We'll leave it on that note. Let's take a break right now. We'll come back on the other side, and then it'll be time for our special segment. The budget countdown has begun, and Lata will have with her Manish Sabharwal, Vice Chairman of Team Lease, on what the budget can do for employment generation.
It's a choice between people who are proud of America and people who are ashamed of America. And ultimately, it's a choice between America last and America first.
So expect a steady quarter from Reliance Geo this time, a 2.9% revenue growth, which will be driven largely by volume growth, that's subscriber addition, while the pricing or the ARPU increase is expected to be 0.1 to 0.2%. These are the numbers: 26,712 crore by way of a top line, EBITDA margin seen at 52.5%, while the profit number is around 5,430 according to our poll. Two key metrics to track. One, subscriber addition. How many subscribers come on Reliance Jio quarterly? expect a number between 9 to 10 million, while ARPU, the average revenue per user, has been flat for the last 3 quarters. This quarter, expect a minor tick up to 182. But Morgan Stanley says that the Q1 numbers assume less importance because the price hike benefit comes in only in Q2 and Q3. According to them, the benefit to the ARPU could be as high as 16 to 18%. But watch out for the net impact because there is downtraining, there is subscriber churn which takes place. So keep your eye on the net impact of the price hike, which we've seen very recently.
Today in our pre-budget series, we asked what can the budget do for job creation. Now, employment numbers have been confusing. The latest CLEMS data from the Reserve Bank, which is based on the periodic labour force survey data, shows that the number of jobs created went up sharply in 2021 and 22. Remember, both COVID years. The CLEMS data also shows a fall in labour productivity, which means quality of jobs is probably the problem and not number of jobs. Today, I have with me someone who has immensely contributed to the formalizing of jobs. Manish Sabharwal, Vice Chairman, Team Lease, a company that has hired 18 lakh employees in the past 15 years. Manish is also a member of the National Skill Mission. So thank you very much, Manish. I can't think of a person better placed to speak to the government and to us about employment creation. Also, kudos for an excellent article in the Mint. So let me start. What should the first thing the budget do for formalizing jobs and indeed employment creation?
I mean, if I recognize the budget as a financial statement, the biggest gift it can give is macroeconomic stability. I think we sometimes take that for granted. So I think the notion that I think we have oversold fiscal and monetary policy as a way to create jobs. You know, if fiscal deficits could make countries rich, then no country would bother being poor. So I think the biggest gift that the government can give is just macroeconomic stability and obviously the steady shift from capex, from revenue expenditure to capital expenditure. I mean, the 10 lakh crore last time was a new milestone, and I hope we'll sort of keep recognizing that productivity is our challenge. And that goes back to the question that you raised of why are we having this debate? Are both sides right? And I think both sides of this debate are right. Unemployment has never been a problem since 1947. Our unemployment has been between 6 and 9%. Our problem is employed poverty. Now, what can the budget do about employed poverty is a really important question. Most people will say that employed poverty is about structural reforms or structural transformations, you know, moving from farm to non-farm employment, moving from informal to formal. So my sense is that the budget, we should not expect it to do sort of institutional reforms or capacity building reforms. Those are multi-year reforms, but it can do flick of pen reforms. And so there are a bunch of flick of pen reforms, whether it is going to a single labor code, whether it is reforming the social security system, whether it is making the Jan Vishwas Bill 2.0. Jan Vishwas 1 was a great innovation, but it was only 100 out of the 20,000 plus criminal provisions for employers that were removed. So there's a lot of daily life of employers. So I think if the budget shifts from this bird's eye view of employment to the worm's eye view of employment, what is the daily life of employers? That would be the biggest gift.
Oh, that's two excellent things that you've said. So let me go, word by word. The flick of pen and worm's eye view. Now, the flick of pen, let's start with this Jan Vishwas itself. What can it announce? You said 100 employers' acts were decriminalized. Many more need to be done. How should they do that?
So there are 25,000 ways to go to jail for employers in India. And that list is way too long. It is way too random. And basically, no, you don't put CEOs in jail, right? So there are transmission losses between how the law is written, interpreted, practiced, and enforced. So Jan Vishwas 1 was an innovation. You know, we haven't ever had a targeted decriminalization. But I think because of the way it was done, which was asking ministries or departments to surrender their criminal provisions, nobody cuts the tree they're sitting on. So I'm hoping Jan Vishwas Bill 2.0 really what I call reverses the gaze. The government will decide these are the 5 ways that you should go to jail. and all departments should remove provisions that don't mean. It's very obvious there's established jurisprudence, harm to others, fraud. There are 4 or 5 reasons why which things should be criminal. Not filing a challan should not be criminal. Not putting chuna in your bathroom should not be criminal. I mean, these 26,000 ways are just randomly ways to go to jail. And combined with the fact that nobody goes to jail. If somebody steals Provident Fund, they should go to jail.
Yeah.
So I think that let's have less provisions, let's enforce them better. So I'm hoping Jan Vishwas 2.0 really takes this 26,000 number, of which 50% is with state government. So really only 12 to 13,000 are with the central government. Takes it to the next level of saying that, look, we are moving to a different regime where we will have fewer criminal provisions. We will enforce those criminal provisions, and we will be clear, because currently it just encourages corruption and informality. What is informality?
Fair.
Informality is a sense of humor about the rule of law.
Okay. Well, let me come to the more important thing, which perhaps all of us have felt. This social security appropriation, which the government does, or which employers are forced to do, EPFO, ESI, etc. Many of us are not able to get the pension money of our previous jobs because they are lost. There was a time of pen and paper. You have a very strong view against it. If you can explain that in detail.
Well, I think mandatory payroll confiscation is not a source of financing. Social in a world of cost to company, benefits come out of salary. They don't come over and above salary. Unfortunately, these laws are written by civil servants whose views that benefits are over and above salary. That was corporate India 25 years ago. Now CFOs have no other pocket to pick. All employee costs go to one cost head. This is very important from a worm's eye view, because at every job fair that we go to, the kids say haath wali salary or chitti wali salary. And 35% of salary has to be confiscated for kids with less than 21,000 rupees per month wages. While if you have 30,000 or 50,000 rupees a month, I only have to confiscate 5% of your wages. So it's a funnily regressive thought world of the legislation that benefits will be paid over and above salary. Actually, what happens in the real world is that CTC is an agreed upon number, and then benefits come out of that. So and also this system is so inefficient. EPFO is the world's most expensive mutual fund. It charges 400 basis points. Most mutual funds, especially gilt weighted mutual funds, charge 25 basis points.
Yes.
So it's not only expensive, it's inefficient. There are 100 million EPFO accounts, but only 50 million pay every month. The other 50 million are dormant accounts like yours. Lata Venkatesh was Lata V, then it was V Lata, then it was, we all, in a pen and paper world, we had multiple ways which our name was written. It's not linked to Aadhaar. So I think that unless we stop this 35% salary confiscation by making employee provident fund voluntary, because employee provident fund, which belongs to the employee. I think employer provident fund, I don't mind, because the optics of reducing employment provident fund are so difficult. Make employer provident fund from 12 to 13%. But reduce employee provident fund, make it voluntary, create competition for EPFO, let us pay to NPS, create competition for ESI, let us buy any IRDA health insurance program. I think you will see at least 30, 40, 50 million people move into formal employment. And why I obsess about formal employment is employed poverty. Because the only way we're going to get out of employed poverty is wages being paid by high productivity employers, and formalization is a proxy for high productivity. Formal employers have access to credit, they have access to training, they have access to better employers. Right now, we're stuck in this low-level equilibrium where out of the 63 million enterprises in India, only 25,000 have a paid-up capital of more than 10 crores. So if you don't have pay the wage premium, you'll never have the productivity. But if you don't have the productivity, you can't pay the wage premium. So I think it is very unfortunate when people focus on the problem as jobs. Because if you think the problem is jobs, you'll throw money from helicopters, you'll mandate 3-day work weeks, you'll take away people's JCB and give them spoons to dig with, which is I'm worried about this budget because some of the wrong narratives, or at least in my mind, the wrong narratives are that welfareism was not done enough. Actually, my reading of this election results is welfareism may be running out of its course, and the only tools you have are jobs and skills.
No, you may be right, because there is a race to the bottom now that state governments have started preparing for their elections. There is a genuine fear that this welfareism is getting out of hand. Manish, that's very important. I didn't know 21,000 salary below 21,000, 35% is appropriated and much less for above. This is, absolutely an eye-opener. And I hope this flick of the pen happens in the budget. But, on the larger issue of, job creation or employment creation, this capex, even construction these days, even road construction, is not as labor intensive as it used to be. So how do you make manufacturing labor intensive? Do you think PLIs should focus on how many of jobs created or labor intensive industries?
I mean, I think, we'll never get to the 45, 33 or 28, which were the peaks of the labor force of Britain, UK and China. But 11% of manufacturing jobs is the wrong number. So I think clearly single labor, and I think that, 50% of India's foreign direct investment since 1947 has come in the last 5 years. But the 40 factory refugees, I hope Xi Jinping doesn't get a fourth term. I hope he gets a life term, because he is our biggest ally in fact, manufacturing jobs. But they have moved skills and infrastructure in their mind from a dagger in the heart to a thorn in the flesh. I think the only dagger in their heart now is the regulatory cholesterol, which obviously is around social security, but is around the criminalization, around the labor laws. So I think we have such a unique opportunity to create manufacturing jobs. The PLI is really a bribe to, people to shift their factories from China to India. I think we should try that. We must recognize that, it has the potential to get out of hand if you keep expanding it to multiple sectors. I mean, 2 lakh crores, 3 lakh crores, 5 lakh crores is the max that we should make the total allocation to PLI, because the challenge with these kind of schemes is that every scheme sort of every industry, every company will try and rebadge itself to take advantage. Absolutely. So I think PLI shifting from investment and output to employment is obviously a good idea. But I really think the role of the government is not to set things on fire. It is to create the roles of spontaneous combustion. If we can create the conditions for spontaneous combustion and, moving to labor codes, you can't comply with 100% of India's labor laws without violating 10% of them. There's 17 definitions of workers. There's 22 definitions of wages. So there is no way that you can operate across this country in multiple industries without sort of having some labor inspector show you how you're violating the labor laws. So instead of 4 labor codes, a single labor code, a move to simplicity. I mean, you can't idealize China moving 700 million people from farm to non-farm employment without recognizing that it was a fertile habitat for employers.
Yes, fair point. What combustion did you say it is?
Spontaneous combustion.
Okay, spontaneous combustion. Now, that's sounding pretty close to Shashi Tharoor, okay? But anyway, those are very great ideas and don't require much expenditure. It's more in terms of changing the law, or as you say, a flick of the pen that itself can formalize a lot of jobs or create the environment for more formalization of jobs. Manish Sabharwal, always a pleasure speaking with you, and we hope we can have you on Budget Day as well.
See you soon. Take care.
Thanks a lot for that. Now, I have a couple of more minutes before I can wind up the show. So let me point your finger at a very important, much-awaited Reserve Bank paper on what is the natural interest rate for India. Now, they have put out that paper on the website yesterday in the bulletin, and it says that India's natural rate is currently 1.4 to 1.9%. Now, why am I saying this is important? All economists want to know what is the natural real rate. Now, the natural real rate is the difference. First of all, the real rate is the difference between the nominal interest rate, which is the repo rate, minus 1-year inflation, current inflation. So, now, according to the Reserve Bank, the nominal interest rate is the repo rate, 6%. The 1-year inflation, next 1-year inflation that Reserve Bank calculates is 4.5%. So the difference between the two is the real rate. What it means is if you get, say, 6.5% for your money, but inflation is eating away 4.5%, what is the real money you have made? Only 2 percentage points. That is the real rate. Now, what is the natural real rate for India? The rate at which growth is at potential and inflation is at target. That is the natural rate. And the Reserve Bank has calculated with various models that the natural rate for India is at the moment 1.4 to 1.9%. Now, what this means is 1.4 to 1.9, the midpoint would be about 1.7. So if repo is if inflation is at 4.5, add 1.7 to it, about 5.75 to 6 is the maximum we can expect the rate to fall to when inflation goes to 4%. That is the message. So not very deep rate cuts are there. When the repo rate is way above the natural rate, it means RBI is trying to tighten, which is what it is trying to do now because inflation is at 5.08. That's the current latest inflation number. When it comes to 4, it will keep the natural rate at 1.4 to 1.9%. Now, the other thing that the Reserve Bank points out is potential output. What is the potential output growth of the economy? The natural rate of growth. It says that in Q4 it was 7%, and the potential output growth at the moment lies again in a big band between 5.9% and 8.3%. There is not much explanation for why such a wide band, but I suppose it's all because of statistical uncertainty and because of the kind of world we live, climate changes, etc. So India's potential output growth is a wide band, lies somewhere between 6 and 8%, a little north of 7% perhaps if you take the midpoint. Now, why is the natural rate wide? The Reserve Bank paper lists several reasons. First is there are 4 ways of arriving at it. So each model gives you a different number. And therefore, this wide band. By one model, they get 1.4. By one model, they get 1.9. And then there are measurement issues. There are estimation issues. Statistical estimation is always an approximation. So the paper points out that, for instance, they had calculated the natural rate during the COVID period, that is Q3 of FY22, October, November, December of 2021. They had estimated it at 0.8 to 1%, the natural rate. But then later on, we got a higher GDP number when it was revised. So then the natural rate has got revised up for that period to 1.2 to 1.4%. What determines natural rate? It's, long-term things like dependency ratio, demographic advantage, how many people have aged, what is the persistent fiscal deficit. All this go into creating or calculating the natural rate of interest. In India, the natural rate is likely to rise because there is a rising demography, young demography. They will save more, invest more. You need more capital investment for them. You can see the capex growth in the Indian budgets. All this leads to a higher natural rate. That's the sum and substance of the paper, but it is very important, and you will see it being quoted repeatedly by economists when they assess the Reserve Bank's monetary policy. With that, I'll wrap up this edition of Bazaar. Chartbusters Sky.
Well, let's talk about the O2C and oil and gas business in terms of preview. Let's start with O2C. Now, remember, last quarter was very strong in terms of the O2C margins, but this time around, Singapore margins, they have fallen on a quarter-on-quarter basis on weaker cracks for key products. For instance, something like a diesel crack, it has fallen to $14 per barrel versus $21 per barrel. Even kerosene and ATF cracks, they've fallen to $13.5 per barrel versus $20.8 per barrel. And weaker GRMs on a quarter-on-quarter basis will lead to lower O2C margins this time around. The petchem margins, however, will be resilient. In fact, there is modest improvement which is expected as well. But overall, if we go by the EBITDA expectations, these are put up by Kotak. It is expected to decline 12% on a YOY basis and 20% on a sequential basis. If we talk about the refining margins, though the company doesn't report it, it is seen to decline at 18% on a YOY basis and 26% on a sequential basis. Now let's talk about the oil and gas business. This has been continuously doing well. This time around, there will be a decline in EBIT marginally because of lower realizations and lower production as well. So overall, EBITDA is expected to increase by 35% on a YOY basis, a mild decline on a sequential basis. Volumes will be up 43% on a YOY basis. They will decline by 2% on a sequential basis. Gas prices, they have declined generally. So it's a decline of 3% on a YOY basis, absolutely flat on a sequential basis. So decent numbers coming in from the oil and gas business.
Reliance Retail, the growth driver of the business, likely to drive growth this time around as well. But the only important thing to watch out for would be the impact of the general elections and the massive heat wave on consumer sentiment itself. But nevertheless, because the company has been expanding its store footprint and footfalls are increasing, that would aid growth, and the EBITDA margin would be impacted positively by operating leverage itself. So year on year, Kotak estimates a near 11% growth in the top line of the retail business, around 77,700 crores in terms of this quarter's revenue, and the EBITDA grows a shade higher at around 11.5%. The number you're looking at is close to 5,750 crores. What it means is that the margins would show a slight improvement closer to 7.5%. But remember, this is the first quarter of FY25. FY24 was a record-breaking year as well, where the retail business revenue crossed 3 lakh crore, the profits crossed about 10,000 crores, and the overall retail store footprint also moved near 80 million square feet. Importantly, the company launched a couple of new formats as well. They are among the top 25 retailers of the world. And remember, their stated policy is to be among the top 10 retailers of the world as well. So how do these new formats, the likes of Tira, Yusta and Swadesh, pan out in FY25 is something that we'll be watching out for. And more importantly, the most important trigger of demerging or value unlocking in the retail business. IT giant Infosys surges 3% and is the top Nifty gainer on the back of blockbuster first quarter earnings. The management also raises their FY25 growth outlook to 3 to 4% from the earlier range of 1 to 3%.
Persistent Systems is down more than 5% after margin disappoints in the first quarter. The constant currency revenue growth, however, was strong, above estimates at around 5.6%.
JSW Infra also slides close to 6% as profit declined 7% on the first quarter on the back of maintenance shutdowns. Margin has also dipped from 61% last year to 50%.
Ceat was lower in trade by close to 3.5% after delivering mixed set of numbers. The company reports decent revenue growth. However, the margins are down for the third consecutive quarter due to increase in input costs.
VST Industries zooms more than 14% as the company says the board will mull to issue a bonus along with their results on the 25th of July. Hello and welcome. You're watching us here on Chartbusters on CNBC-TV18. I'm Manglam Malu. With me as always, Nigel D'Souza. We'll talk about the markets at large, but first up, let's talk about the earnings. The stock on our radar is Havells India. The company reported a mixed quarter. Revenue was higher than expectations on a year-on-year basis. Margins in the non-Lloyds part of the business was a slight miss. We have Anil Rai Gupta, who's the CMD of the company, joining in now to discuss these numbers in detail. Thanks a lot, Mr. Anil Rai Gupta, for joining in and talking about these numbers on the whole. But let's start with Lloyds. That was, one of the stellar performers of this quarter itself, backed by, good seasonality, etc. as well. Now, with EBITDA margins in this quarter being close to around 3% the street is now looking at structural profitability of Lloyds. So if you could give us a sense of going forward, what is the kind of investment that you would make in Lloyds? And will there be structural positivity? If yes, what are the kind of margins that you're gunning for here?
Well, I think we've always said that Lloyd requires long-term investments, and that's what we have been continuing to do, R&D, manufacturing, brand building, distribution reach. So those are the fair, investments that we have made and will continue to make in Lloyd, because we believe that it's a very large industry. Air conditioners is highly underpenetrated and it's at an inflection point of fast growth. So we'll continue to make these investments. Structurally, also, we believe that Lloyd has been making strides towards achieving efficiencies in manufacturing. So we believe that, and plus the brand perception, brand building, which will give us the right kind of pricing in the market as well. So we believe that we are on the positive trend, but we'll continue to make investments for fast growth in this business.
So the bottom line, Mr. Gupta, is that Lloyd continues to stay profitable, right?
I mean, quarter on quarter, it can vary because of seasonality, because still, even today, 70-75% of the revenues come from air conditioners, which is a seasonal product. But overall, structurally, there'll be a far better improvement over the past years.
Okay, that's good to hear then. If you have to niggle about these numbers, one factor would be the street was anticipating a little better margin profile. Do you believe on, put all your business together, Lloyd has turned it around, a couple of verticals did better, some of them a little bit softish. Double-digit margins should be what we should be working with, say in the vicinity of around 11% or thereabouts on an average for the year?
We actually look at, Lloyd's, which is the investment business, and Havells separately. But Havells, we do believe that, depending upon quarter on quarter, otherwise we gun for at least 13 to 14.5% margin in Havells standalone. And Lloyd, as I've already explained, is now towards a positive journey. Again, quarter on quarter can vary, but it is on a much better position than what it was in the last couple of years.
All right, so 13.5% margins in the Havells business, and Lloyd's, you are looking at investing while structurally it has turned positive. Let's talk about a couple of other segments as well. The ECD business, that showed a strong growth for almost 20.5% as well because of small domestic appliances and strong growth in fans as well. And this at the time when you've also tied up with a company, Jumbo Group, for kitchen appliances in the UAE. Wanted to understand the scalability of this vertical out here. How big are you expecting this business to be going forward?
Well, if you look at the fans business, which is a large part of this business, structurally, we believe that it is, highly penetrated category, but there is premiumization happening in this business. There is a high degree of newer retail as well as the online business, which is coming up. Exports is a big opportunity. So overall, ECD, if you think, and small domestic appliances, our market shares are still small, and we can gun for much bigger growth there. Other than that, there are other segments in electrical consumer durables, water heaters, where we are the leaders in this business. We have the air coolers, which is also a fast growth business. So we believe that ECD has a good potential for growth in the coming times. Last couple of years, because of consumer demand, it has been a bit tepid, but I think going forward, ECD will register good growth.
Okay, all right. Mr. Gupta, in the cables and wires business, the growth was a little bit lower actually in comparison to a nearest peer, Polycab, which we just spoke to. But as per you, what kind of a market share shift was there? But from here on, I'm looking at a couple of brokerage roads, and they believe that you're perfectly positioned now to go ahead and pull back a good amount of market share because your emphasis on R&D, digitization, brand positioning as well will help you on that front. So where's your market share and how do you see it headed?
Well, overall, if you look at cables and wires segment, we have underground cables where we do believe that the new capacities coming up at our new facility in South will help us gain market share. But also, a sizable part of our business also comes from the wire segment, where it's a residential product, and the uptick in the real estate demand should help us grow in that segment. So we are looking at higher growth as well as market share expansion in cables and wire segment. Of course, when we are talking about the digitization, the overall R&D efforts, that's for the entire business of Havells and Lloyd, and that's a continued investment. We believe that we are the highest spenders of R&D in our industry. We have a large base of R&D engineers of over 800 people. So with that, investments will continue in the entire business.
Right. So finally, before we let you go, we're first quarter in this financial year, in the middle of the second quarter as well. You have the visibility for pre-festive buying and all the other things that are happening. If you could give us a total roundup of what is it that you're looking at in terms of volume and revenue growth for at least this year across all segments, and what would that mean in terms of increased ad spends as well, which have been higher than what we saw on an average in the last 4 years rather?
Well, we usually don't give guidance, but on a general basis, I would say the first quarter has been a strong quarter. And with that, we are quite hopeful for the next few quarters to be a stronger growth for the business. And that's why we'll continue to invest in our ad spends. And, usually they remain between 3.5%, and that will continue in the coming times as well.
All right. And you obviously have expanded manufacturing capabilities and looking to spend a lot more on capacity enhancement as well. But that's all the time that we have on our show today, Mr. Anil Rai Gupta. We will keep continuing our conversation as we speak every quarter, post your numbers as well, and get in some more details on this CapEx plan and what you anticipate in terms of growth coming in from here as well. Wish you and your team a very good luck. Right, let's get you some ideas for profit coming in from our colleagues at Money Control Pro now. Neha Dave joins in with a stock that she's been tracking.
Today's stock idea is State Bank of India. SBI's operating performance has been very strong and the bank managed to deliver return on asset of about 1% in FY24 despite huge one-time expenses. Loan growth has been healthy for the bank and deposit growth has lagged advances growth, but which is in line with the industry trend. While there are concerns over weak deposit growth in the banking system, SBI is relatively best placed with credit to deposit ratio, that is CD ratio at 68% as of March end, which is significantly lower than the banking industry's CD ratio. Moreover, SBI carries excess SLR investment in government securities amounting to rupees 3,70,000 as of FY24 end. Management has guided credit growth in the range of 13 to 15% in FY25 and expects margin to remain stable. Asset quality has been trending better for the bank and its slippage ratio fell to record low in FY24. While further improvement in credit cost is unlikely as it is already on a lower side, future earnings growth will be driven by better operating efficiency. Cost to income ratio can moderate going forward as wage expenses will normalize. Now talking about the valuation, the bank is trading at around 1.3 times core book value estimated for FY26, which is reasonable considering that return on asset is above 1% and return on equity has touched 20%. While earnings growth will normalize in FY25, stock upside will be driven by expansion in valuation multiple. Long-term investors wanting to play rising economic growth and picking off interest rate cycle should keep the stock on their radar.
Okay, all right. Thanks a lot for that. Well, for the time being, we slip in a short break. But on the other side, we have the management of Karur Vysya Bank who's waiting for us. Stay tuned.
Listing is something that would move the stock to.
Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 3150. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we are expecting a weaker growth on the back of lower gross refining margins and muted growth in the Geo and retail business. Geo is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So, yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
Big US tech companies have huge cash balances, so they're getting 5% where they would get before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment-grade corporate sector. The CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment-grade bonds do not mature until...
Welcome back. You're tuned into Chartbusters here on CNBC-TV18. Well, the next company on our radar is Karur Vysya Bank. The lender reported a good set of numbers. To help us discuss what went on in the past quarter and what's the way ahead, we're joined by Mr. B. Ramesh Babu, who's the MD and CEO of the company. Hi, Mr. Babu. Good morning and always good to see you and sir on the show. Well, let's get a couple of basic numbers first out of the way. What is the loan growth you're aspiring to grow in this year? As well as if you could tell us what is the margin trajectory from here on?
Fine. Thank you very much. Good morning to all of you. The loan growth, what we have guided during last quarter for the whole year is around 14%. So though it can go up pretty well, because we thought that the deposit growth may be contained. So that's why to balance between the deposits and advances, we thought around 14%. But we made some sort of a structural changes within the loan growth. So we have moved more towards the RAM vertical, wherein if you can look at it, this quarter also, on an average quarter on quarter, it is 6%. It has come that way. Year on year also 20%. Where the yields are better, it is granular and more secured. So that's why rather than focusing on the corporate, we have moved towards the retail RAM, that particularly agriculture as well as retail and MSME, that's going well. And coming to the margins are concerned, we gave an indication that the first 2 quarters, we will try to maintain around 4% plus. And I'm happy to share that this quarter we are at 4.13 and the trajectory we propose to maintain. But at the most, even a worst case scenario, it comes to when the rates come down from the RBI side and the deposit rates will have to go up. We thought that the worst case scenario, it may land at 3.7 by the end of this quarter. So that's why on an average around 3.8 for the whole year, we will be able to maintain, if at all those things happen.
All right, we take that point. 14% loan growth and around 4% NIMs for this year may for the entire year be at around 3.8% as well. But you spoke about growth coming by via your RAM portfolio. What's interesting is that structurally you've reduced your corporate exposure from close to around 45% of your book. You were looking to target it to be around that 21% odd itself. So for this year itself, if you could break up that loan growth into how much will come in from RAM and how will all your other parts of the portfolio perform, including unsecured?
Yeah. Unsecured, let me tell you, it's a very minuscule portion. It comes to around 2.5% of the total book. Even if it grows also, at the most, we may grow up to 5%. So that's a major portion of the unsecured. Coming to the RAM, so our intention is as it is to 80-20 to maintain that. So corporate at the most may hover between 18 to 19% and rest will be RAM 81. Out of the RAM also our preference is major to the commercial. So where we have a lot of presence is there in the area where we are operating. The margins are also much better there. Next comes the retail and next comes the agriculture. These three will work in this order and the corporate actually it is around 18 to 19% we would like to maintain a part of our portfolio.
Got it. All right. Sir, if you could tell us the quantum of the technical write-off pool and the expected quantum of recoveries that we can see from here on?
The technical write-off pool is absolutely, if you look at it, sometimes it's a deceptive number. The reason is when the industry was growing, projects and all these things, lot many loans were given 2012, 13 and all. Those things, if you go to various courts and other measures also, the recovery may be around 5 to 10%. So that way, those big accounts, the recovery percentage may be pretty low. So that way, as it is, if you can see the recoverable portion of the technical write-off, if you look at it, it comes to around 2,500 crores we can think of. So we have made a lot of efforts into that one. That is the reason this year you are able to see some sort of a good growth. Last year also, technical write-off pool has given a good number. And we feel that next 1 or 2 years, these numbers will be pretty good because internally, again, structural changes we have made and a lot many measures we have taken to get the money from these pool and all. So the next 2 years, we feel a lot of flow can be expected from that.
So you're saying the recovery will be around 2,500 crores, is it, from the technical write-off?
No, I'm talking about the pool will be 2,500 crores, which can be recovered.
And 5 to 10% will be recovered.
Correct. No, on an average, around 400 to 500 crores per year can be recovered in next 2 years.
All right. Got that. Take that point. And finally, before we let you go, let's wrap it up with some of the, asset quality and ratio sort of guidances that you earlier would give. I remember you wanting to take your, ROAs up to closer to 1.7%. You've achieved that. Where does that go from here on? And even the asset quality, you were looking at NPAs less than 1%. You're way less than 1% now as well. So your asset quality guidance, ROA guidance, along with the annual slippages and credit cost guidance, if you must.
I agree with you, but 1.7 for the quarter. But there are many unknowns are there in the coming quarters. That's the reason we gave a guidance of around 1.65 for the whole year. So NPA, net NPA is also we are at 0.38 now. That's why we said that below 1% we will be maintaining that one, though it will be in these ranges. But Mangalam, if you can look at it, last 15 quarters, more or less what we have guided, we are on track as per the guidance. Not only on one parameter, business growth, profitability and asset quality. We were at 0.32 ROA in 2020. Now we are at 1.7, which can be sustained. So that's why what we did is, instead of ups and downs going on, we wanted to sustain the entire growth what all is coming up in all three parameters. That to some extent we could succeed.
All right, we take that point. You have been guiding for a certain number. More or less, you have not only met that guidance, at most occasions you've also beat that guidance, and you maintain that guidance so that you can perhaps sustain it at current levels, taking into account all the vagaries of uncertainties that may come by as well. Wish you all the best for the next financial year and hope to speak with you in the next quarter as well. As the management of Karur Vysya Bank, let's take a short break, come back, focus on the markets and a lot of stock-specific action on the other side.
So those, I think, are the two key, those are the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So the key is, so maybe it's going to be a 3-year capex cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point we have to take a view on whether all this investment is going to be is going to lead to monetization. Frankly, I have no view on that.
Neither do we.
But at some point in early 2025, one's going to have to take a view. But it's not just, it's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. Okay. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether it's going to become monetizable. I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there. But also, frankly, if you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy. And actually, even in an Indian portfolio, if you want to hedge the risk that oil suddenly goes up, because obviously this Middle East situation could... I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is energy, and these energy stocks pay good return, dividends. They're defensive, but they could be like tobacco stocks. From a US perspective, Donald Trump will be risk-on for equities, because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar.
He wants a weaker dollar, yes.
Yeah, but I also just think...
Welcome back. We moved to the low point of the day, which is actually something that we're not really used to. The markets are down closer around 130 points. The Nifty Bank is down close to 300 points. The problem pocket is the broader markets, though, because the Midcap index is now down close to around 2%, and you have only 350 stocks that are trading in the green. Well, we've run out of time on this show of Chartbusters, so we'll wrap up. That's it from Mangalam and myself, but the team of Trading Hour will take all the action forward.
the US fiscal situation is essentially out of control. And we have neither political party remotely interested as at the moment in fiscal retrenchment. So in my view, you should assume it will remain get more and more out of control until the markets revolt against it. The defense sector I first heard about 3 years ago, but in terms of my portfolio, I've missed the defense stocks, but the problem in India is what not to own. Right. So my portfolio has been basically built on where the performance of my greed and fear portfolios come from the last year, I would say in property, energy, and infrastructure. But the missing part of my portfolio is defense. So let's say there's a sudden resolution of this conflict. Maybe the defense stocks will correct, and that will be an opportunity to add.
Please rectify that for us.
And then another emerging area in which I'm not invested in, but I mean it's definitely getting more and more attention, is the contract manufacturing sector.
Right.
I believe you call it EMS.
Yes.
So this is an example of another emerging sector.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Good morning. Welcome to Trading Hour here on CNBC TV18. Contrary to a lot of expectations of the Nifty hitting 25,000 earlier in the day, we are seeing a bit of red on the screen in today's session, which is, of course, the final trading day of the week. That the bulls are fighting to hold on to some of the weekly gains that the index has made so far in this week. 24,660 is where we are. The important level on the downside, though, of course, is going to be yesterday's low, which was around 24,500, from where the Nifty had reversed and then had that 300-point recovery from the lows of the day. But as the benchmark is holding on to some bit of losses, the losses are not as extreme, and that is because of IT, and Infosys is the one that is leading the pack. The ADR was 8% higher, not quite the rub-off that you are seeing on the Indian listed entity. The stock is just around 2.5% higher as we speak. The brokerage commentary was fairly positive as well. Price target hikes coming across the board. Ratings are more or less left the same. So Infosys now above 1800, 3% higher. But the broader market screen is showing a bit of pain this morning, and the mid-caps and the small-cap indices are the one that are trading with significant losses, and they have been underperformers almost through the week, and that has been the case for the broader markets. The small-cap index is down over 2%, the mid-cap index is down 2% as well, and if you can pull up some of the earnings reactions as well, and you would see the kind of moves that these stocks have seen in the broader markets. JSW Infra, the numbers were a bit of a miss on expectations, 6.5% lower. The top loser closer on the mid-cap index as we speak. 313 now on JSW Infra, 6.5% lower. Persistent Systems is the other one. We'll have the management speaking to us later in the day, but that stock too down 6% after the margin miss that the company reported, and there are also concerns with regards to the margins now. Almost 6% lower as well is Persistent Systems. Now there was a bit of a recovery from the lows of the day, but that has got swiftly sold into as well. Some of the other earnings reactions, Dalmia Bharat as well. The numbers were okay as far as what Nigel was highlighting, but the stock down 5% as well. Dixon Technologies continues to see some bit of correction, and of course some of the defense names that have been in focus after the downgrades that have come in from Nirmal Bang earlier this morning. HAL, Bharat Dynamics is down almost 5%. So BHEL is also trading with losses of around 4%. So sell-off continuing in the PSUs. The index trading with small bit of losses. The broader markets are seeing a bit of pain in today's session. Time to say hi to Reema Tendulkar.
Hi, Hormus. It's a little scary looking screen, right? When you look at the broader markets, you look at the advanced decline ratio and the way you are seeing, the mid caps and small caps capitulate. But we've got a management waiting by. South Indian Bank, and those shares are up nearly 3%. The net profit is up 45%. Deposits have seen an 8.5% year-on-year growth. We have with us PR Shishadri, the MD and CEO of the bank, joining in. Thank you very much, sir, for joining in. While there's a big jump in the net profits, as we pointed out, the stock is doing well. There's one number which is a bit concerning, and that's the increase we've seen in the slippages. Quarter on quarter, your slippages have gone up 20% and stand closer to 350. What led to that? What were the big accounts, which went bad this time? And what can you guide on slippages going forward?
Thank you very much for having me on the show. Slippages, we seem to have a cyclicality in slippages. So when I look back in history, I find that the first quarter tends to have slightly higher slippages than other quarters. And in this quarter, whilst it was low, slippages were lower than first quarter of the prior year, they were still higher sequentially from the prior quarter. We had no single large ticket loan slipping, so no corporate slippage during the quarter. Most of the slippage was on the small business and agriculture side. So there's nothing material to report. I mean, in the sense that we think that this is business as usual. It's just a little bit of seasonality playing through. Recoveries continued to be reasonably strong. We came in at about 309 crores of recoveries. So slippages did exceed recoveries for the first time in some time. But having said that, we think that the situation should correct and reverse itself as we go forward.
Right. Mr. Shishadri, good morning. Thank you for joining in. And you mentioned that some of the stress came in from the smaller businesses and the agri side. Do you see that as a trend that is likely to persist, considering the monsoons have just begun now and there might be some recovery going forward? You mentioned about seasonality as well. Do you expect that slippage number to recover as FY25 goes by? And what you can guide on the asset quality as well, because that was flat compared to the March quarter. So do you see that number trending down as well?
From an asset quality perspective, if I may answer the second question first, asset quality perspective, we think that the trend that we've been displaying over the last year and a half will continue. And we think that both gross as well as net NPA numbers should continue to go downwards. And we are hoping that we are closer to the 1% mark, maybe 1.1, 1.15 at that level on the net NPA number by the end of this financial year. With respect to slippages by themselves, I don't see any trends here. It's just that, Q1 for us tends to be the quarter with the highest slippage, and that seems to be seasonality that we have demonstrated over the years. And that's essentially because of the nature of how this organization works. And we think that, as we go forward, slippage numbers should moderate back to the levels that we normally see. Therefore, we are not, at this juncture, concerned in any business line to say that there's any form of trend that is emerging, actually.
Okay. When you say slippages should get back to normal levels, we're talking about 300 on a quarterly basis. And also, if you could give us that number there. And also on margins, we've seen a drop in your net interest margins quarter on quarter, year on year. What's the outlook on NIMs?
Again, answering the second question first, NIMs, we were at 3.26% or thereabouts for the quarter. We are, managing NIMs on two fronts. One is by ensuring that our cost of borrowing remains reasonable. So our quarter-on-quarter sequential increase in cost of funds was only six basis points. So I think we are doing a fairly good job there. And we are trying to increase our NIMs by ensuring that we change the product mix on the asset side. So we're currently approximately 42% of our book is corporate. And we are trying to change that mix to bring that down to about a third and get higher yielding assets, both from MSME as well as retail, to take the slack as a consequence. So if you're able to do that, we think the NIMs will actually widen from where we are today, but that process will take time. And we are hoping that in the medium term, we can get this to about 3.5 or thereabouts.
Right. Mr. Seshadri, I wanted to speak to you about your deposits. They were up around 8.4% year on year and around about 1.5% sequentially. In normal terms, you'd consider that as slightly weak. And you're also hearing reports of a lot of people, the deposit withdrawals coming in to be put into the equity markets. Of course, this is all reports that are being circulated. But what are the steps that you're taking to mobilize more deposits, especially considering that there is so much competition out there? And you might want to say that your depositor is almost spoilt for choice. So what steps are you taking to ensure that that deposit growth figure returns to double digits, or are planning on doing so?
From a deposit perspective, actually, we had a very, very good quarter. Our CASA balances on a sequential quarter-on-quarter basis grew approximately 6%. These are average balances. So I think we are an outlier when it comes to CASA balance growth. What we are doing is we are increasing engagement with our customers. We do have approximately 8 million customers. And at the branch level, we are trying to ensure that we engage with them as intensively as possible. And that's beginning to pay off for us. On retail deposits, given the fact that our asset growth, we've been ensuring that we are in the 10 to 12% range. We really don't need more deposits, so we are ensuring that our price control on the deposits is very, very tight. So as of today, we are priced actually significantly lower than some of our larger peers in this market and still growing at 8%. So we think that we have a solid deposit franchise, and were we to require more deposits, we think that we can bring it in. And I think we've demonstrated that on the CASA front. There has been very substantial growth on CASA, which we're feeling really good about.
One final question, Mr. Seshadri, and your loan growth has remained healthy, if I can say that, around about 11%, if I'm not wrong. Yeah, 11% year on year. What's your outlook on the loan growth going forward? And if I can ask you, are you being slightly conservative when it comes to growth? And what's your outlook on the loan growth front for the rest of the year?
So we've been telling people that we want to grow between 10 and 12% for the year. Our challenge is not in growing the book. Our challenge is in rebalancing the book. So that we can grow our NIMs. So from our strategic perspective at this point in time, our focus is more on profitability and ensuring that we can get greater revenues for the same balance sheet size and for the same amount of risk that we are running. And therefore, we are prioritizing the change in the balance sheet mix over growth. So consequently, we wish to grow between 10 and 12% for the year, which is where we think we have a sweet spot from a liability pricing perspective.
All right, Mr. Seshadri, we leave it at that. Thanks a lot for joining in, sharing with us your outlook on the road ahead for FY25. Wish you good luck for the rest of the year as well. That was the management of South Indian Bank. Pretty confident about the road going ahead. The stock also doing well for itself, was up 3.5% when we last spoke of. And so a good reaction to the earnings coming in there for South Indian Bank. But time for a short break here on Trading Hour. Up next, Reliance Industries is expected to report its first quarter numbers later this evening. We'll get you all the key expectations on the other side. Stay tuned.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter-century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups.
Welcome back to Trading Hour. The broader markets are witnessing some significant selling pressure right now. 90 stocks on the mid-cap index are trading with losses and 91 on the small-cap index are trading with losses as well. Almost 2,000 stocks on the NSE are currently trading lower compared to just 320 that are advancing. The Nifty Metals Index is the one that is leading the losses, though almost 2.75% lower as we speak. All 15 stocks on the index are trading lower. NMDC is leading the charge there on the downside. NMDC, SAIL, Ratnamani Metals, all of them are trading with significant losses of anywhere between 3 to 4% as we speak. And the pain in the broader in the small cap index has intensified as well. MCX is down 6%, and that stock had seen a 5-day gaining streak before today's fall. So it's witnessing some bit of profit booking from higher levels is MCX, 6% lower there. Also not doing well in today's session is CIE Automotive, which was earlier Mahindra CIE, of course, and that is a result reaction, 5% lower there as well, almost 580, slightly off the lows of the day, but still trading 4.5% lower. But the focus today is on the big boy, and that is Reliance Industries, which is expected to report its results later this evening. The street is looking at a modest rise in EBITDA on a year-on-year basis. Now, Sonia is joining in with a detailed rundown of the earnings preview. Sonia, over to you.
Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 31.50. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we're expecting a weaker growth on the back of lower gross refining margins and muted growth in the Geo and retail business. Geo is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So, yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
Sonia, thanks a lot for that update. Now, a key driver of the growth for Reliance in the last few quarters has been the retail business. So what are the expectations from there? Mangalam is joining in with a lowdown on that. Mangalam.
Reliance Retail, the growth driver of the business, likely to drive growth this time around as well. But the only important thing to watch out for would be the impact of the general elections and the massive heat wave on consumer sentiment itself. But nevertheless, because the company has been expanding its store footprint and footfalls are increasing, that would aid growth, and the EBITDA margin would be impacted positively by operating leverage itself. So year on year, Kotak estimates a near 11% growth in the top line of the retail business, around 77,700 crores in terms of this quarter's revenue, and the EBITDA grows a shade higher at around 11.5%. The number you're looking at is close to 5,750 crores. What it means is that the margins would show a slight improvement closer to 7.5%. But remember, this is the first quarter of FY25. FY24 was a record-breaking year as well, where the retail business revenue crossed 3 lakh crore, the profits crossed about 10,000 crores, and the overall retail store footprint also moved near 80 million square feet. Importantly, the company launched a couple of new formats as well. They are among the top 25 retailers of the world, and remember, their stated policy is to be among the top 10 retailers of the world as well. So how do these new formats, the likes of Tira, Yousta and Swadesh, pan out in FY25 is something that we'll be watching out for. And more importantly, the most important trigger of demerging or value unlocking in the retail business by separate listing is something that would move the stock to.
Mangalam, thanks a lot for that update. And Reliance Industries currently trading with some losses in today's session. It's seen a good up move in the last 1 month ahead of earnings. The stock was up almost 7% in the last 1 month, currently trading 1.5% lower at 31.30. But time for a short break here on Trading Hour. Up next, we discuss market technicals. Mitesh Thakkar joins in on the other side and also shares with him his top trading bets.
Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
We did lose an American hero that day. We wish that he were with us tonight. But his memory will live on forever in the hearts of his family, his community.
All right, well, as a bit of a change of guard, I'm here in place of Rima. The market, of course, continues to reel under pressure. That's been the big headline, and there's no let-up in that selling. Look at that, 145 down on the Nifty, and the mid-cap screen is bleeding almost 1,200 points now. So some, cool-off profit-taking definitely underway. Mitesh is with us, so let's get some ideas going. Mitesh, what do you make of today's decline, and what would the trades be? Are you, betting on anything on the way down? Mitesh, I think,
yeah.
We can hear you now,
Yeah. I think the index, we called for some correction, saying that early in the 10 o'clock show, I suggested that even if people haven't exited, I think good time to exit, because now the hourly and the 2-hourly charts are looking negative, and I think there could be a slightly bigger pullback. It looks to be playing out that way. 24,530, 550 is the first support zone. And below that, in the worst case scenario, I think 24,400, 350 zones could be tested. So some more pullback can happen. Therefore, looking at some shorting opportunities, particularly in the metals name. So I think that's where some kind of weakness is arising. Look at Tata Steel, that's a sell. Keep a stop at about 164.5 and look for targets of 152, 151 on the downside. And the other stock is RP Industries. I think that's also turning negative. So sell here with a stop at about 700 for targets of 650.
Mitesh, thanks a lot for joining in, sharing with us your views on the index and your top trades as well. By the way, pull up Paytm, and that stock has recovered from the lows of the day after it reported its first quarter results. The losses, though, have widened on a year-on-year basis. The loss now at 839 crore for the June quarter compared to a loss of 357 crore it reported in the same period last year. Some flashes on your screen as well with regards to their earnings call, where the management has spoken about the fact that their revenue and profitability is expected to improve going forward. And I guess that is somehow rubbing off on the stock as well, recovered from the lows of the day. And they are awaiting approvals as well to start onboarding of the new UPI users. There's a lot of hype on that Paytm IPO. I remember 2150 the IPO price. It's still not seen those levels. It's now almost struggling at around 450. But some optimism being shown by the management after all the RBI action and all the scrutiny that has taken place all through the year.
It's been a roller coaster, and more down than up for the Paytm shareholders, especially the ones who got in at the IPO time. That's one stock. Looking at some others, let's check out where the pressure is in the broader market, because as we're talking about it, it's really a mid-cap led fall, and the number of declining stocks is now over 2,000. So where is the money coming off? Some of the tire names like JK Tyre are under pressure. Then, of course, the entire metals complex, PSU, non-PSU. Metals is a down space. I guess that has to do with the fact that globally markets are in a risk-off mode. Look at something like SAIL or NALCO. On the large cap screen, we were talking about JSW Steel, Tata Steel, all those stocks were also down. So metals definitely on the lower side. Manappuram is losing about 3.5% on good volumes. So these are some of the major names on the way down. Lemon Tree Hotels is another one. IRB Infra, L&T Finance. So these are the pockets where there's price and volume action on the way down. Besides that, just some more names. I mean, look at the fall on Cummins now. 5% down on Cummins. Persistent continuing to react to those numbers, down about 6.5%. Jupiter Wagons is a long list. Amber is down about 5% as well. So mid-caps really reeling under the pressure.
Real estate is another pocket that is the biggest sectoral loser today. 3% down now on the realty index. All 10 constituents trading with losses as we speak. Macrotech is the top loser on the index. They're 4% lower now on Macrotech. Oberoi Realty numbers come out later this evening, so 3.5% lower there as well on Oberoi Realty. Almost 4 stocks trading with losses of between 3 to 4%. Soba, Phoenix Mills, DLF, Oberoi Realty, all of them trading with losses of anywhere between 3 to 4%. But time for a short break here on Trading Hour. Up next, we discuss the fundamentals of the market. Varun Locha of HDFC Securities joins us on the other side. Stay tuned.
That he loved. This November, we have a choice. It's a choice between one team that wants to build this country up and another that wants to tear this country down. It's a choice between people who are proud of America and people who are ashamed of America. And ultimately, it's a choice between America last and America first.
So expect a steady quarter from Reliance Geo this time, a 2.9% revenue growth, which will be driven largely by volume growth, that's subscriber addition, while the pricing or the ARPU increase is expected to be 0.1 to 0.2%. These are the numbers: 26,712 crore by way of a top line, EBITDA margin seen at 52.5%, while the profit number is around 5,430 according to our poll. Two key metrics to track. One, subscriber addition. How many subscribers come on Reliance Geo quarterly? Expect a number between 9 to 10 million. While ARPU, the average revenue per user, has been flat for the last 3 quarters. This quarter, expect a minor tick up to 182. But Morgan Stanley says that the Q1 numbers assume less importance because the price hike benefit comes in only in Q2 and Q3. According to them, the benefit to the ARPU...
Back with us here on Trading Hour, the Nifty remains where it is, 150 points lower. The broader markets continue to struggle, but the Nifty is trying to be supported by Infosys and ITC, the two stocks that are ensuring that the Nifty downside at least is capped. Time for some market fundamentals now, and Varun Rocha from HDFC Securities is joining us now. Varun, good morning. Thank you for joining in. In your very recent note, you have mentioned that risk-reward is turning increasingly unattractive and you are advising to remain cautious on the road ahead. And now a lot of people would ask you that what should you be buying? But we'll flip the question a little and say, if you're saying that the risk-reward is getting unattractive, which are the pockets where it is happening so?
Yeah, good morning. So, so in this recent note, we again highlighted that, there is a sort of euphoria or over optimism building in, especially in mid and small caps. But at the same time, even in a lot of large caps, we have seen significant re-rating and stocks trading ahead of fundamentals. So actually, I think more than the market cap, it's to do with certain segments. Obviously, industrials, cap goods, some of the PSU names, were more prominent in the list of names which are trading at significantly rich valuations. But again, when we say PSU, some of the really large PSUs with good free float, they are still trading at reasonable valuations. But a lot of the, low free float PSUs, more thematic sort of companies, they have significantly re-rated, and we believe risk reward is unattractive there. So, I think those are some of the pockets where there is clearly overvaluation sitting, whereas 2 or 3 pockets where valuations were relatively okay was one, banks, second was IT, especially large cap IT, and third was consumer staples, where relative to history and relative to rest of the market, these segments were looking slightly better from a risk reward perspective.
Varun, hi, good to have you on the show today. Just wondering whether Havells or Polycab, whether these stocks are under the coverage. Both are important mid-caps the market looks at and tracks widely, and both have missed expectations in the quarter gone by. Any thoughts here? And also sort of, single out for us any other important mid-caps in your portfolio where earnings have either come or something that you're really watching out for, important to watch mid-caps from your perspective.
Yeah. So Havells we do cover. We have an ad rating out there. Consumer discretionary, especially consumer durables, we have been positive in the last 3 to 6 months. So along with consumer staples, that's been one sector where we have turned more constructive in the past 3 to 6 months. Again, given the relative risk reward, and we believe that the demand conditions seem to be bottoming out even for consumer durables. But Havells had a very strong run from 1400 to 1900 within 3 to 6 months. So right now we don't have much upside left on our target price, but we have a ad rating. Polycab we don't cover. Crompton Consumer is another consumer durable play where we are positive among the mid-cap names, and even Orient Electric. So consumer durables as a space, we are positive. Consumer staples, as I said, we are positive. So names like, Marico, Britannia, Dabur, which are actually large caps, but the second rung large caps after ITC and HUL, that's the segment which we are positive on. As I said, looking more at certain pockets and certain sectors, not, again in IT, mid-cap IT is something which we have not been too positive on off late, but large cap IT we believe offers better risk reward, and therefore we have been shifting more towards that side in the last 3 to 6 months. So it's very sector specific.
Interesting you brought up IT. I was going to ask you just that, whether the excitement has already been captured in the stock price. I mean, the rally started building just before the numbers, right? TCS, Infosys, most of these stocks were up. What are your top picks, and whether you still think that there is more headroom left after the Q1 performance?
Yeah, so you're right that a part of the upside has already been captured, because you have to keep in mind that it's not that we have seen significant improvement in in the demand conditions in IT, just that we are now seeing clear signs of things bottoming out, which was looking like the case 2 quarters back as well. But then we had a scare in between after Q3, Q4 numbers, and now we seem to be again getting a sense that things are bottoming out. But if you look at the growth for even next year, still FY 25 and 26, the sector is not going to do anything more than 8 to 10% on earning growth levels, which means, after this 20-25% kind of run up, which we have seen in last 1 month in some of the even large cap IT names, the absolute upside looks limited. But at the same time, with improving demand conditions, the downside also looks fairly limited in case of IT, given the quality of businesses, the cash flow they throw, and the valuations at which they are trading at. Some of the large cap ITs are trading at more like 20 to 25 times 1 year forward PE. So I think absolute upside, we might have captured 60 to 70% of that within last 1 to 2 months. But I think still it's a sector which is looking fine on a relative basis when we look at overall market, because there is a lot of overvaluation sitting in other pockets compared to IT.
Varun, you spoke of PSUs. I wanted to zero in on that a little, and you spoke particularly about the defense PSUs. And one of the stocks that you have highlighted in your report also is HAL. And not to talk, you may want to talk HAL specific, but the entire defense theme as a whole, they've seen a kind of run up which is, it's hard to justify, because stocks are up almost 200-300% in just the first 7 months of the year. And he recently had a domestic brokerage also downgrading these names, saying that even at the most aggressive earnings estimates, it's still very difficult to justify the valuations that they are at in. Would you rate the defense as one of those sectors where people should look to take money off the table? Because of course there is plenty of money already made, but over a longer term perspective, what's your call there?
So won't be able to talk on HAL specific, given we don't have a rating on the stock. But on the defense sector, and what we have highlighted in the note is a whole host of stocks where we have not seen meaningful earning upgrades, but the stocks have ran very hard in the last 6 month, 12 month, 18 month period, and where valuations are now significantly above long-term averages. Even if we were to ignore long-term averages, some of these stocks are trading at 40 to 50 times P, which seems fairly high, even if we have a long runway of growth, because there are going to be execution slippages. The margin profile of these companies is volatile and changes, from order to order. So it's difficult to forecast a very long-term sort of a picture, while they are going to compound at probably 10 to 15%, given the way defense spending is expected to continue to remain healthy. But we believe a lot of those positives and next several years of growth is already built in. So so what we are advising is caution on some of these segments. Railways is probably another such segment where we have seen significant re-rating and a lot of stocks trading at 40, 50, 60 P. Despite the long runway of growth, we believe at those valuations, once you buy, the probability of making sizable returns in the future gets diminished. So with that perspective, we are advising caution on some of these segments.
All right, got it. Good talking to you, Varun, today. Thanks very much. You have a good day and a good weekend, and we look forward to connecting again soon. Need to take a break. When we come back, an interesting discussion lined up. Jyoti Gupta of Nirmal Bang Institutional Equities is going to be joining in. Nirmal Bang has recently taken a very guarded call on the defense space. They have downgraded the sector, saying valuations are too high. We will get into that conversation in just a minute.
To 18%. But watch out for the net impact, because there is downtraining, there is subscriber churn which takes place. So keep your eye on the net impact of the price hike, which we've seen very recently.
Well, let's talk about the O2C and oil and gas business in terms of preview. Let's start with O2C. Now, remember, last quarter was very strong in terms of the O2C margins, but this time around, Singapore margins, they have fallen on a quarter-on-quarter basis on weaker cracks for key products. For instance, something like a diesel crack, it has fallen to $14 per barrel versus $21 per barrel. Even kerosene and ATF cracks, they've fallen to $13.50 per barrel versus $20.8 per barrel. And weaker GRMs on a quarter-on-quarter basis will lead to lower O2C margins this time around. The petchem margins, however, will be resilient. In fact, there is modest improvement which is expected as well. But overall, if we go by the EBITDA expectations, these are put up by Kotak. It is expected to decline 12% on a YOY basis and 20% on a sequential basis. If we talk about the refining margins, though the company doesn't report it, it is seen to decline at 18% on a YOY basis and 26% on a sequential basis. Now let's talk about the oil and gas business. This has been continuously doing well. This time around, there will be a decline in EBIT marginally because of lower realizations and lower production as well. So overall, EBITDA is expected to increase by 35% on a YOY basis, a mild decline on a sequential basis. Volumes will be up 43% on a YOY basis. They will decline by 2% on a sequential basis. Gas prices, they have declined generally. So it's a decline of 3% on a YOY basis, absolutely flat on a sequential basis. So decent numbers coming in from the oil and gas business.
Reliance Retail, the growth driver of the business, likely to drive growth this time around as well. But the only important thing to watch out for would be the impact of the general elections and the massive heat wave on consumer sentiment itself. But nevertheless, because the company has been expanding its store footprint and footfalls are increasing, that would aid growth, and the EBITDA margin would be impacted positively by operating leverage itself. So year on year, Kotak estimates a near 11% growth in the top line of the retail business, around 77,700 crores in terms of this quarter's revenue, and the EBITDA grows a shade higher at around 11.5%. The number you're looking at is close to 5,750 crores. What it means is that the margins would show a slight improvement closer to 7.5%. But remember, this is the first quarter of FY25. FY24 was a record-breaking year as well, where the retail business revenue crossed 3 lakh crore, the profits crossed about 10,000 crores, and the overall retail store footprint also moved near 80 million square feet. Importantly, the company launched a couple of new formats as well. They are among the top 25 retail.
Welcome back. The cool-off continues in the market. The sector on which we will now train the spotlight is going to be defense. Now, Nirmal Bang has come out with an update, and they have actually downgraded the defense sector in their first quarter earnings expectation note that they have put together, and they cite super rich valuations as the reason behind this. In fact, I'm looking at some of the ratings now. A lot of the stocks under their coverage are now either accumulate or outright sell. For instance, Mazgaon Dock has become a sell for them. Paras is a sell. And a couple of others as well. I think this is perhaps BHEL and a couple of others as well. They were quite bullish on Astra Microwave, but that seems to have now become an accumulate as well. So what's behind this new call after 3 months? Well, let's ask the guest who's joining us on the show. We have with us Jyoti Gupta of Nirmal Bang Institutional Equities. Jyoti, good to have you on. And I remember our conversation, right, when you came out with that initiation report about 3 months back. And we were discussing this at that time, that the story is well intact and yes, there's an opportunity and indigenization is happening, but our stock's getting overexcited. What has made you change your stance in 3 months?
Thank you, Subi, for having me here. So actually, while we remain positive, the entire run-up that has come is based on positive sentiments and retail flows. While we remain structurally positive in the sector, we believe the valuations have run up far ahead of the fundamentals. And therefore, we advise caution. And if you look at my report, our valuations are based on 2 standard deviations, mean, and for most of the companies. And yet the companies currently are trading above these levels, which I believe to some extent may not be sustainable. That's the whole.
Jyoti, good morning. Thank you for joining in. I wanted to ask you off that as well, right? Because 3 months prior, most of these stocks had still had a very significant run, say the likes of Mazgaon Dock or Cochin Shipyard, the shipbuilders in particular, and now they've had an even bigger run. And you mentioned that most of this has been based on order book, the order book visibility. I was checking about some of these valuations as well, and most of them are way above their 5-year averages, even a few months prior as well. So what has changed in these last 3 months that prompted you to change your stance? Because the stocks had moved previously as well.
So, mainly what I see is that, and that was my initial statement as well, was that what you see the run-up is based on order books, and it continues, to remain on the order book. I want to see execution. In fact, one of the reasons I'll cite, look at HAL, what has happened. Not that I am negative on HAL, or not that I'm saying that I have downgraded the sector, but I am still very positive on the companies, and we believe that, what we really need to see, the metrics are still not, factoring in cyclicality and efficiency, which is what is lacking. And that's the whole reason why I see, and my downgrade is purely based on valuations. I am still very, very structurally positive on the sector.
Please go ahead.
Now, what we see is still the order book. I'm not seeing much visibility on the execution side. I want the execution to at least pace, maybe let's say by the 4th quarter, and I will currently be on the sidelines and wait for that to happen.
Right. Fair enough. Jyoti, what I wanted to ask you was that now defense as a sector as a whole is a very long gestation period sector. You mentioned that you want to see more on the execution front, which is fair. And most of these orders that these companies are winning, recently Garden Reach won an order which was around 840 crores that was supposed to be executed by 2028, 2029. That execution period will take a while to materialize, right? So what does one do until then? Do you see that there is a much needed correction due in these names just because execution is a big risk, which I guess was also a big risk back then as well?
So basically, my numbers already have factored in all these, big, large order books. And when you talk of Garden Reach, frankly speaking, I think, and what I understand as well, that most of the orders which Garden Reach will get will be executed by L&T. So I just based on the order book, and see, gestation is definitely there. But beyond that, if there's, like, for example, in HAL, we were expecting that 6, which is in the news, that the 6 LCAs are supposed to be delivered. Now, even that looks a little, somewhere it looks delayed. That I feel should not happen in the case of other companies as well. So mainly, when it comes to order books, everything, our numbers are actually priced in. I don't see any surprises beyond these numbers right now.
Jyoti, finally to sum it up, I'm looking at the stocks where you have at least an accumulate rating. You don't have a buy on anything. You have an accumulate on Astra Micro, Bharat Dynamics, BEML and Data Patterns. So What is the advice to people if someone is, trying to get in now and be in the defense sector for the long term? Then out of these stocks, which one looks like the best bet to you?
See, long term, I am positive on HAL. I continue to remain positive on HAL even today, while it is still right now. Reason is, again, if you have seen last 2 days, what has happened in HAL is even when I started, I said key things in HAL is your engines, your landing gears, which is again, we're dependent on international companies. We need to build in capabilities domestically, and if that doesn't happen, these executions are going to get delayed, which is what we're seeing in the 6 LCAs, which is supposed to happen in FY25. So, these timelines are very key to the defense sector. Second is on BEL. While it is a sell, I am still positive on that, because again, this is, any order that comes to MDL, HAL, or BDL for that matter, all the electronic, equipments and all will be done by BEL. So while it is positive, but again, execution is what needs to pick up pace. We haven't really downgraded our earnings forecast. And the other thing which is very important is if there is a change in US presidency where, the Republicans are less prone to defense spending compared to Democrats, and, they're more inward-looking policies, of course, that is going to impact the global defense spending as well. And the tighter budgets, again, are going to adversely affect the defense spending. So, there's so many things to it and to the sector. So, while I'm positive on HAL, BEL again, but at present, at the current levels, I don't see, I think correction is really important in the sector.
Right. Execution is the key. Jyoti, thanks a lot for joining in, sharing with us your views on the sector as a whole. Jyoti Gupta of Nirmal Bang there on the defense sector. Time for a short break. More on the market and specific stocks on the other side. Stay tuned.
And remember, their stated policy is to be among the top 10 retailers of the world as well. So how do these new formats, the likes of Tira, Yusta and Swadesh, pan out in FY25 is something that we'll be watching out for. And more importantly, the most important trigger of demerging or value unlocking in the retail business by separate listing is something that would move the stock too.
Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 3150. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we are expecting a weaker growth on the back of lower gross refining margins and muted growth in the Geo and retail business. Geo is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So, yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
Big US tech companies have huge cash balances, so they're getting 5% where they were before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment-grade corporate sector. The CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment-grade bonds do not mature until after 2029. So those, I think, are the two key, those are the the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So the key, so maybe it's going to be a 3-year capex cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point we have to make a decision.
Back with us on Trading Hour, and the indices continue to trade in the red as we speak, but Infosys has moved to the high point of the day, 3.2% higher now as we speak. We started off the show when the stock was around about 2.75% higher, so slightly building on those gains as well, and that is the stock that is lending some big support to the Nifty. But the losses have intensified in the metal sector. The Nifty Metals Index is now down 3.6% as we speak. The top sectoral loser, all 15 constituents of the index are now trading with losses on the metals index. Are not good developments coming in from China, and that is weighing on the sector in a big way. And the realty index too has sold off even more now as the show has gone on, 3.5% lower there as well on the Nifty Realty Index. And that sector as well, all 10 constituents of that sector trading with losses. The Midcap Index is down 2.25%, as is the Small Cap Index. The Auto Index is down almost 2%. So barring FMCG, which is flat, and barring IT, which is courtesy Infosys, the screen is pretty much red.
Oh, yes, absolutely. I mean, it continues to be a fairly weak day, you'd have to say that. Let's look at some of the movers and shakers in terms of the mid-cap. So we've been talking about a lot of the losers. Can we spot any winners? VST Industries is one, 16% higher. There is, I think, also the expectation that there will be a bonus that the company could consider. I think there's along with the results meeting, and that's suddenly getting everybody very excited around VST. That's one. What else? I mean, not much actually. There's Team Leads, which is up about 5% or so. But the list really thins out after that. Karur Vysya Bank after the numbers. Not too bad, 2.5% on the higher side. But otherwise, yeah, mid-caps down 1,200 points. And the Nifty is now down about 170 as well. With that, let's move on. In conversation with CNBC-TV18, Rajiv Chhabba, CEO Emeritus of JSW MG Motor India, says that they are planning to launch 5 new cars in the next 15 months. Speaking to Parikshit Luthra, he adds that the company has seen 35% growth in EV sales in just with the 2 EV cars in the portfolio. As we take a break, let's listen into excerpts from this conversation.
I think in MG 1.0, before the JV, we focused on making a great foundation based on good products, technology, good customer experience, community service, and employee satisfaction and good network. I think the team did a good job, and then foundation was laid, and we kept growing every year more than the industry. Now in this 2.0, we want to grow faster. And the first job of this JV was both the partners wanted to make up on time and approve products. So we already approved 5 products in such a short time of 4 months, and the 3 mass segment products and 2 premium products, and we are going to launch that in the next 15-16 months. So that's a great news. So most of the growth should come from the new products. Also, at the same amount of time, I would say that we are doing pretty well on our existing portfolio, especially the 2 EVs, that is EV and Comet. I'm happy to say that in the last quarter, where the industry was doing 2-3% more than similar period last time, our EV sales went up by 35%. So ZSEV and Comet, we are doing almost 2,000 cars a month, which is a spectacular improvement given the condition of the industry. So we are quite upbeat. Yeah, dealers are a little bit nervous because we are going through the expansion program also, right. And then it's a transition period. So, we need to do a better job of taking care of our dealers at this point of time, frankly, because competition is tough, but overall damn good.
All right. So I'm going to ask you, you're speaking about 5 new products that have been approved, 3 in the mass market segment, 2 in the premium. How many of these could be EVs? And when are we looking at the first launch? Would it be as early as this festive season?
So we will start with this festive season. and majority of the products are going to be new energy vehicles, and I will leave it there.
All right, so it could be electric, it could be hybrid, or it could be alternate fuel.
So yeah, so new energy vehicles, include strong hybrids and EVs. So we are working towards that.
What's the sense of the kind of growth JSW, MG Motor India are targeting in the whole of FY25 going forward?
See, I think we have a pretty interesting and a very exciting journey ahead of us. When we have done this JV, both the partners are clear on one thing, which is accelerated growth. So we want to increase that in a spectacular way, hopefully, and that's why we are increasing the capacity of the plant right now from 100,000 to 300,000. And when we are saying capacity should be 300,000, it means we need to have the products to fill the plant. So in the next 4 or 5 years, our idea would be to achieve 300,000 volumes, majority of that in new energy vehicle and with a healthy bottom line. So that's what our plan is.
My final question, what kind of growth in your portfolio do you expect from electric vehicles alone? You're saying that you're just because of 2 cars, you're seeing a 34% growth in your EV portfolio. When you complete FY25, what percentage of your sales will be electric?
I will not be surprised if it is more than 50%.
On whether all this investment is going to be lead to monetization. Frankly, I have no view on that.
Neither do we.
But at some point in early 2025, one's going to have to take a view. But it's not just. It's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. Okay. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether it's going to become monetizable. I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there. But also, frankly, if you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy. And actually, even in an Indian portfolio, if you want to hedge the risk that oil suddenly goes up, because obviously this Middle East situation could. I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is energy, and these energy stocks pay good return dividends. They're defensive, but they could be like tobacco stocks. From a US perspective, Donald Trump will be risk-on for equities because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar.
He wants a weaker dollar, yes.
Yeah, but I also just think, because basically the US fiscal situation is essentially out of control. And we have neither political party remotely interested as at the moment in fiscal retrenchment. So in my view, you should assume it will remain get more and more out of control until the markets revolt against it. The defense sector I first heard about 3 years ago, but in terms of my portfolio, I've missed the defense stocks, but the problem in India is what not to own. Right. So my portfolio has been basic.
A fresh bout of selling causes a bigger dent in caps with the declines widely outnumbering advances. Realty, metals and energy are the big drags while IT and FMCG still see small gains.
A ramp up in large deal. Strong India business and a welcome pickup in the BFSI segment drives a strong growth surprise for Infosys, which also raises its guidance for the year. The stock gains.
Persistent Systems sees a sharp fall on posting a dip in profit margins, while lower than expected volumes due to a shutdown at JSW Steel's unit dents JSW Infra's revenues and profits.
Reliance Industries is expected to clock healthy revenue growth, but a decline in gross refining margins for the industry could impact profitability. The street, however, is more focused on possible clues to the listing of its retail and telecom arms.
Hello and welcome. Good afternoon. You're watching us here on Halftime Report. I'm Mangla Malu. With me, as always, Ekta Batra. It is a time where we're seeing some bit of sell-off on the markets. A 165-point cut on the Nifty from record highs yesterday. The pain in the broader market is a lot more, with a near 1,200-point decline that we're seeing on that index, and more so if you look at the advanced decline ratios. 2,000 stocks on the upwards side, with about 300 stocks which are gaining. So from record highs, we have seen some bit of consolidation. Currently seeing a bit of fear, maybe ahead of the big events, which are the budget next week and the big results that we're looking at, Ekta.
Hi, Mangla. Well, not used to it, right? Seeing that red on the screen. So yes, definitely. The Midcap index is down around 2% at this point in time. Let's see whether there's any kind of buying at lower levels. Like Mangla mentioned, we do have the budget, which is coming upon us next Tuesday. So that's probably where we are seeing some amount of profit taking. And not to mention that the US markets were lower overnight as well. The Dow also snapped its 6-session winning streak. So maybe that could be something which added an additional amount of pressure. But just want to add that the big star for the entire week and for today continues to be the entire Nifty IT index, which is up around 2.8% on a week-to-date basis. And on a week-to-date basis, Infosys obviously is the star for today because of its numbers, but nonetheless, it's up around 5.9% on a week-to-date basis. LTI, Mindtree, TCS, HCL Tech, all of these stocks have rallied anywhere between 2.5 to 3% odd, and we'll be getting more cues from Wipro, which releases its numbers today. So that seems to be the core focus. But let's talk about one particular company. Sandstar's 510 crore IPO has opened for subscription today. The IPO comprises of a fresh issue of 397 crores and an offer for sale of around 113 odd crores. Through the IPO proceeds, the company plans to more than double the capacity at its Dhule plant and will repay borrowings worth around 100 crores as well. To discuss more on the IPO, we have with us the two companies' joint MDs, who are also brothers, Sambhav Chaudhary and Shreyans Chaudhary, in the studio to take us through the details. And it's important to mention that it's in fact subscribed. The IPO is subscribed in the first hour itself. So tell us a little bit, before we talk about the business model, which is quite interesting, just wanted to understand the repayment of 100 crores in terms of debt out of that 510 crores that you're raising. How much do you have in terms of debt on your books right now? How much do you have in terms of cash? How much is going towards repayment? And what's the eventual goal for debt reduction?
Thank you so much, first of all, Mangalam and Ekta, for having us here. On the debt side, we have a total debt of approximately 140 crores on the books, out of which 35 is long-term, and the balancing figure would be a short-term debt. And out of the IPO proceeds, we plan to repay approximately 100 crores towards the debt repayment. And going forward in the next year, the company is going to be completely debt-free. We are generating approximately, in the last financial year, we've generated approximately 90 crores of positive cash flows in the company. And we hope to continue that as well.
All right. When I look at the business that you're doing, the third largest manufacturer of maize-based specialty products and ingredient solutions, you basically sell to a lot of the food processing agencies, etc. At the same time, you don't have any long-term contracts with the people you source your maize from. Do you have long-term contracts with your customers? Because it seems like a commoditized business where someone can come undercut the prices, etc. So in light of that, what exactly is your moat out here?
So the company is primarily driven into sales to food. Almost 60% of our revenues is coming in from sales to food, FMCG or processed food industries. So the entry and exit barriers are very high to these industries. The company is having a very good name for itself in the overseas markets. As you can see, almost 400 crores or 36% almost total revenue coming in from exports market. A lot of new applications are coming in that seem to be driving. So there is a lot of value addition and a lot of second generation derivatives that we manufacture. So we are not very directly exposed to any volatility in terms of raw material prices. It is fairly easy for us to pass on any prices. As a company prudent policy, we do not enter into any long-term contracts. Our buyers typically come and buy on a monthly or a quarterly basis.
Okay. All right. You know, what's interesting is that you mentioned that you export to around 49 countries and you have around 33% of your sales coming in from exports. Tell us, how is that vertical growing vis-a-vis the domestic market? And within the exports, what do you see as the key driver of growth? Within domestic markets, what is the key driver of growth?
So globally, a lot of new applications are coming up within the plant-based specialty products that we do. If you see globally on the Western Hemisphere, there is a boom towards plant-based foods, plant-based clothing, leather, shoes, etc. Even on the personal care space, we see now companies shifting to these plant-based products that we are manufacturing rather than a talc or the more lesser friendly bodies applications. So one is, of course, these all new applications that are driving. Plus post-COVID, we have seen a lot of interest towards our industry for India. A lot of large companies wish to set up their supply chain within India. So on an overall picture, this is all driving the demand globally.
But how much is the vertical in exports growing? How much is the vertical in domestic growing? What's the growth rate?
We were like 36% on the export number. Going ahead with the expansion and the demand that we see post doubling of the capacity that Sandstar has already started, we hope to maintain the same share. We see that kind of demand going ahead as well within the export market.
Let's talk about the capacity expansion itself. 181 crores is what you are, earmarking for capacity expansion. I look at your gross block, which has increased over the last 3 years already, and that's led to a revenue jump as well. So what are typically the asset turns that you have on a business like this? And with this near 200 crore capacity addition, what could the incremental revenue look like?
So, I mean, we've positively maintained a very nice asset turnover, probably of around 5 to 6, which is also one of the best in the industry per se. And with the expansion of around 200 crore rupees, out of which 20 crores have already been spent on the expansion, and out of the IPO proceeds, 180 crores would be spent on the upcoming expansion. We plan to maintain a similar asset turnover ratio or even better.
So, if I have to extrapolate those numbers, last year you did revenues of close to around 1,067 crores, additional 200 crore capacity. When does that come on stream? And with this 5-6 times turnover, when do you reach that 2,000 crore mark, by 2,000, 2,200 crores?
So, I mean, we plan to complete the expansion by June 2025.
Okay.
The financial year 25-26 will have 9 months of that expansion. So, hopefully, in the 25-26, we aim to double our revenues from the existing.
Okay.
With the expansion coming in, because we are doubling the capacity from 1,100 to 2,100 tons.
Okay, so these 49 countries that you're exporting to are mainly semi-regulated countries?
In our products, because these products we need on a very daily basis, there's not much regulations. We don't see any import restrictions or even for say export restrictions. So we don't see any regulations within our space for these.
Okay, so it's easy. Just what about the developed countries? Say, for example, US, Europe, your exposure to, say, countries such as that, as well as maybe Australia, because regulatory, barriers would probably be more there.
Yeah, so because of the demand avenues that we and then because our plants are very proficient in terms of producing a very high quality, the plants are automated, and a very good food safety certification quality system that we have in place. So, so there is acceptability for these products now post the plant audits, of course, that happen. So there is a good acceptability for these products within the Western markets also. We've exported to the Americas as well in the last financial year. So new markets and new geographies are opening up for us.
Who are your competitors in India? What is their size? And, what are the margin triggers? Because again, like I said, this is a commodity. Buyers need this product daily, and you guys need to buy from your suppliers daily or on a very regular basis. So the ones who typically give you the best price is something that will win.
No, so what really happens is, the raw material input might be a commodity, but the products which we are manufacturing are more towards, we work very closely with our customers to get the plants approved, audited, And I mean, typically FMCG customer would have a lot of audits going on in the plant. So the barriers to entry for these kind of products would be very high, though the input raw material might be commoditized. Also, I mean, you know, the audit time would take anywhere between 6 months to 12 months per se for any of the FMCG companies to do that.
So who would your competitors be and what are the margin triggers?
Our competitors would be Gujarat Ambuja Exports and Gulshan Polyols.
Okay, and what would your global competitors be, just to get a sense in terms of the kind of share that you probably have globally? Who are you competing with on a global scale?
Yeah, so as per the Frost & Sullivan industry study, it's a $70 billion global industry for the plant-based, maize-based specialty products that we make. And some of the larger names that exist and that have a play in this industry include the like of Cargill, Louis Dreyfus, Archer Daniel Midlands.
Okay. Any kind of M&A or expansion strategy that you would have on an inorganic basis within this space?
I think we're open to that, but as of now, we don't have any thing in place, you know. But as and when the opportunity arises, we would definitely be open to that.
I may sound like a broken record out here, but margins, that's what I want to know. Because on 1,000 crore top line, you're doing barely 100 crores of EBITDA. What is the kind of margin trigger that you have? Because when you're doing 2,000 crores, you know, what should one pencil in?
So majority of the product, the expansion are all coming in on the derivative side, the second generation derivatives that we mentioned of. Some of the products are even going into pharmaceutical applications. So going ahead, because of this positioning, we do anticipate margin improvements, EBITDA expansions.
How much? 200 basis points, 300 basis points?
Hopefully, because we've also made, the company has also made some recent investments on renewables, on solar as well as biogas based electricity. So those are all, and plus along with the capacities of scale that we are going to achieve at 1750 tons per day, my Dhule plant is going to be probably the single largest plant in India outside China. So, so all these levers are going to aid towards capacity EBITDA expansion going
Just
ahead.
to understand that point better on margins, what are your global peers' margins in the same business? If you could give us a comparable rate in terms of what the peak is, what the low is, and where you are.
So on an industry level, the EBITDA would range between 10 to 15, 16%. So this would be a broad range.
Okay. And last year on the EBITDA of 100 crores, your cash flow from operations was just about under 30 crores. How is that ratio likely to be going forward?
So, I mean, we made some investment in the renewables. You know, if you see the debt on the company, it is really, really small, the long-term debt. On a revenues of approximately 1,200 crore rupees, we have a long-term debt of only 35 crore rupees. So, a lot of internal cash has been generated to invest into the expansions which we are doing.
But that would be cash flow from investments or cash flow from financing. I just wanted to understand about the CFO point.
Right.
But running out of time, we will continue this conversation, maybe press you for a lot more numbers when you guys list. So that's the management that we have of Sandstar. The IPO has been subscribed, guiding for near doubling of revenue over the next couple of years with improvement in margins as well as they focus on expanding their capacity from the IPO proceeds that they have. Take a short break, come back, talk about a lot of the other stocks which are moving down in trade.
Where the performance of my green and fair portfolios come from the last year, I would say in property, energy and infrastructure, but the missing part of my portfolio is defense. So let's say there's a sudden resolution of this conflict, maybe the defense stocks will correct and that will be an opportunity to add.
Please rectify that for us.
Yeah. And then another emerging area in which I'm not invested in, but I mean it's definitely getting more and more attention, is the contract manufacturing sector.
Right.
I believe you call it EMS.
Yes.
So this is an example of another emerging sector.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Infosys is a stock which is gaining in trade today and is the top contributor to the Nifty on the positive side, even though the Nifty is currently sitting with a cut of almost 140 points. It was on account of large deals, a strong India business and a welcome pickup in the BFSI segment that led to a strong growth surprise coming in for the company. In fact, they've also raised their guidance for this year to about 3 to 4% from 1 to 3% itself. So important to listen into what the management had to say post the numbers in terms of the growth outlook for the company going ahead. Let's hear them out.
The way we see what's going on in the market and our guidance, first, we had a strong performance in Q1 on volumes as well as the point that we made on financial services in the US. Second, we had a very strong performance on large deals in Q1, which gives us more visibility into this financial year. And third, we completed the Intech acquisition, which also helps us in this guidance.
Last multiple quarters, we have moved to the agile hiring base. That basically means we hire freshers both from the campus, off the campus. This quarter, we had a 2,000% net decline, which is lower than the previous quarters. Our utilization is already at 85%, so we have little headroom now left. So, as we start seeing growth, we will look at hiring. We are looking at hiring 15 to 20,000 freshers this year, depending on how we see the growth.
Okay, so that's the top brass of Infosys talking about their numbers. But let's move on. JSW Infra is down in trade today on the back of muted Q1 numbers. Vivek is here to tell us about the fine print.
Well, that's right. So JSW Infra has had a soft start as far as FY25 is concerned. What's actually happened is that revenue is up 15%. This was aided by volume growth of around 9% on a year-on-year basis. The cargo handle volumes came in at 27.8 million tons. Where did the miss come about? The company that handles significant volumes at Dharamtar as well as Jaipur port, these two port volumes were lower than what the consensus was anticipating on the account of a maintenance shutdown that JSW Steel's Dolvi plant was undertaking. However, what has aided the volume growth, incremental volume from acquired assets, increased capacity utilization at the Paradeep Iron Ore and Coal Terminal is what has aided the volumes. Now coming down, as far as the EBITDA is concerned, EBITDA was down by 6% on a year-on-year basis. EBITDA margins, 50.2% versus 61.3% on a year-on-year basis. Effective tax rate this quarter was higher and profitability was down 7.2%. Now, when you're talking about what brokerages have to say, depending on whether or not they had the maintenance shutdown in their expectations going into this particular quarter, the street is divided. BNP Paribas actually has a buy rating. They're quite positive. They say that given the fact that the company has done so many acquisitions, remember Q1, the company has announced the acquisition of Navkar Corporation's majority stake. So they believe Q2 and H2 onwards there can be significant volume ramp up, and on the back of that they believe that the 10 to 12% volume growth guidance that the company has given, the company may actually be able to beat that. On the other hand, Kotak Institutional Equity actually has a sell rating. They are saying that volumes are flattening out on a year-on-year basis. Non-captive volumes housed in assets with limited capacity continuing to drive volume growth. So this is something, a bit of a mixed view, but it's a soft start nevertheless to FY25 as far as JSW Infra is concerned.
All right, Vivek, thanks a lot for that. Let's talk about our special segment, Value Plus. on the show right now, and the stock on our Value Plus segment is VST Industries. It's a 17% up move that we're seeing on the stock. It's a fresh record high. And the reason why the stock has been buzzing around so much in today's trading session in particular is yesterday post-market there was the announcement that came in from the company on the exchanges saying that the board will consider a bonus along with its results on July 25th itself. So that has the stock excited. But despite that, we have to see a couple of things which are taking place in the tobacco end right now. Godfrey Phillips, a stock which has nearly doubled from the start of this year, is up almost 98% in this year. For the last 12 months, we've seen a bigger move on that one. VST Industries is not too far away as well. So if you look at VST Industries, in this year itself, it's up 40%, including today's move. And ITC has been a relative underperformer there with an up move of just about 3.5%. But, VST, a couple of things happened in the last quarter. If you look at the volume growth for the cigarette business for Godfrey Phillips, ITC and VST itself, pull up both Godfrey Phillips and ITC, you would see that Godfrey Phillips has seen a much better volume growth, whereas VST Industries in last quarter itself turned around on the volume front on a favorable base. All the other companies have been growing much faster. So turnaround for VST is something that the street is betting on this time around, because they may then have to claw back the market share that they ceded to other players like Godfrey and ITC as well. So if you look at the VST volumes once again, you would see that over the last 6 quarters, we've seen 5 negative performances, and it was just the last quarter where they turned positive in terms of volume growth. The triggers for tobacco industry in the first quarter in general would be higher pre-buying by dealers ahead of the budget. Typically ahead of the budget, dealers stock up products so that they don't get impacted by any increase in excise, at least for the stock that they hold in their books. And remember, 16% hike in national calamity contingent duty took place in the budget last year. So the street is hoping this time around there won't be any hike. Even if there is, it won't be as high as last year itself. Triggers for VST Industries in particular would be the appointment of Sanjay Wali, who's ex-Godfrey, as the COO of the company last quarter. So management change would work for them. They've initiated the process of monetizing their Azambad property, which will be completed in this year itself. So that adds additional other income to their overall books. And their marquee investor, Radhakishan Damani, had increased the stake in the company by 3% in the last quarter. Their total holding stands at around closer to 36% itself. Despite the up move, the bigger up move that took place in Godfrey took Godfrey's valuation much higher than VST. So as things stand in the tobacco industry right now, ITC is trading at 26 times, Godfrey at 32 times, VST at 20 times itself, with triggers in place. So let's see where this one goes from here.
Okay, all right, Mangalam. Thanks very much for that. So maybe there is a valuation upside for VST along with the volumes turning around. We need to take a short break. But up next, Manish Ramani will join in with his trading calls for this Friday. Stay tuned.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Way to celebrate our own 25th year, with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21.
Welcome back. You're watching us here on Halftime Report. Perfect time to get you, what's taking place in the F&O space in midday. In the markets itself, look at it, there is been a bit of a sell-off. The Nifty is down about 165 points. They're lower not only by the Nifty Bank, but it's the broader markets which are a little bit of bigger concern. The Midcap index is now down almost 2% and it was underperforming in yesterday's trading session as well. If you look at the advanced decline chart as well, both these lines have been fairly apart for most of today's trading session, and the distance has been maintained. 2,000 stocks declining, 354 stocks advancing itself. What are the stocks that we need to keep an eye out on for the index itself from here on? Infosys is contributing on the way up after good results coming in. Reliance reports its results most likely post markets today. HDFC Bank tomorrow. So together, these are heavy weights of the index. Infosys, what happens, whether we see a follow on Monday or not is the big question. And for Reliance and HDFC Bank as well, what happens on Monday would be an important imponderable to track. But that's about Monday. Then we have big triggers for next week, which are the union budget on Tuesday. And then on Thursday itself, we will have the July series expiry. So there would be a fair amount of volatility in the market, which is expected from current levels itself. Ahead of expiry, a lot of active options that we have on the index. 24,700 call, pretty active on the Nifty with 200 rupee premium telling you, around 24,900 to 25,000 may face a bit of psychological resistance. Let's see where that goes, because we're seeing an equal amount of writing on the 24,800 call and the 25,000 call as well. And ahead of big events, we do see some purchase at lower level puts too, and that's exactly what's taking place. So if you look at the 24,500 put, there has been some action for a premium of 200 rupees telling you 24,300 thereabouts could be some bit of a support for the index. 24,200 put as well, fairly active with a premium of 80 odd rupees. Very stock specific market as well, so a bunch of stocks which may be in focus. Vodafone Idea may actually enter F&O ban given the open interest action on that stock today. And the other one that I'm looking at is GNFC, which may exit F&O ban. Remember, there are 11 stocks in F&O ban ahead of expiry next week.
Okay, all right. Manglam, thanks very much for that. Manish Hathiramani of Deen Dayal Investments joins in to discuss the markets now. Manish, hi, welcome to the show. Well, not usual to see so much red on the screen, but how would you approach it? Would you probably buy this dip that you're seeing?
Good afternoon, Ekta. Well, not really. I wouldn't buy right now because I feel 24,900, which we had mentioned as a target last week, is really the resistance which is there for this week. And that is where we are really reacting. If we are able to significantly, I think 25,500 should be the next plausible target. Immediate short-term support is at about 24,300, while the medium to long-term support is way down at 23,100.
Okay, all right. And what about stocks?
Well, after a lot of buys and few weeks of buy calls, I'm now looking at 2 sell calls this week. The first one is on Hindalco, which is for a target of 630, stop loss of 705. 675 to 700 has seen large sell volume, especially in blocks, which has led the stock to break the support of 675. The stock is even resisted on the upside at 700, which is a testament to the downside. The second sell is on GAIL, which is for a target of 210, stop loss of 230. This stock was in sideways zone between 230 and 235, which is broken down, which makes it a good valid sell candidate. Volumes are supporting the move as well.
All right, Manish, you gave us the upside target on the Nifty, which is close to 24,900, where there is resistance. Now that we are seeing a decline and you say there is no fresh long zone, what are the levels that you're looking at the lower level?
Well, the real support right now is 24,300. And unless we don't hit that, we continue to be bullish. The longer term supports are still way lower at 23,100.
All right, take that point. Thank you so much for joining in and giving us your call on the index as well as a lot of individual stocks. No fresh longs right now. 24,300 is a better level to buy as per Manish, and at the same time, a couple of sell calls that he's given on stocks. But let's move on. Building a legacy from the ground up actually takes vision, perseverance, and the right kind of support. And that's exactly what our new show is. HSBC presents CNBC-TV18 SME Champion Awards, which celebrates this encouraging journey of one such incredible Indian enterprise called Natural Remedies. But what were the key ingredients that fueled this remarkable growth from a small team to a big global exporter? Let's hear directly from Mr. Anurag Agarwal, who's the MD of Natural Remedies.
My name is Anurag Agarwal, and I am Managing Director at Natural Remedies. Natural Remedies was started by my grandfather and my father way back in early 50s. It's been a wonderful journey. I have completed almost 39 years with Natural Remedies. From an institution with around 25 people, now today we are close to 1,000 people. Today our products are available globally. We are exporting these products more than 30 countries across various continents. And we are proud of our contribution. We have a research center which is approved by Ministry of Science and Technology. Almost 12 to 15% of our growth every year comes from the new introductions. We have divided innovation into categories where there is a separate team which works for the future innovation and a separate team which works on the immediate needs of the organization. Finance support has been available to us from various institutions. Since we are an export-oriented organization, funds have been made available to us through the various government schemes at a very reasonable prices. So we feel deeply supported there. So I can see the changes which are happening, and we are happy with these changes. Today, our international business contributes to close to 30% in our total turnover. We plan to take it to 50% in the next 4 to 5 years. Human evolution is the most critical component to mitigate any risks or changes which are happening in the market. And the better we make ourselves, the more fitter we are to respond to the changes and the difficulties which we may encounter going forward in our life.
TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
So expect a steady quarter from Reliance Geo this time, a 2.9% revenue growth, which will be driven largely by volume growth, that's subscriber addition, while the pricing or the ARPU increase is expected to be 0.1 to 0.2%. These are the numbers: 26,712 crore by way of a top line, EBITDA margin seen at 52.5%, while the profit number is around 5,430 according to our poll. Two key metrics to track. One, subscriber addition. How many subscribers come on Reliance Geo quarterly? Expect a number.
Welcome back. Well, the other big trigger today in terms of earnings is Reliance. We will be reacting to that on Monday because it will be post-markets. It is expected to report its results later today. The street is looking at a modest rise in EBITDA on a year-on-year basis. Sonia is here with a detailed rundown.
Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 3150. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we are expecting a weaker growth on the back of lower gross refining margins and muted growth in the Geo and retail business. Geo is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So, yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
All right, take a short break, come back. On the other side, we'll focus on the markets and a bunch of stocks which are moving around. At the bottom of your screen, the ticker team keeping you alert.
Big US tech companies have huge cash balances, so they're getting 5% where they were before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment-grade corporate sector. The CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment-grade bonds do not mature until after 2029. So those, I think, are the two key. Those are the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So the key, so maybe it's going to be a 3-year capex cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point, we have to take a view on whether all this investment is going to lead to monetization. Frankly, I have no view on that.
Neither do we.
But at some point in early 2025, one's going to have to take a view. But it's not just, it's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. Okay. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether it's going to become monetizable. I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there. But
on the sidelines of the Indian vegetable oil, event, we do have with us Manisha, who did speak with Malaysia's plantation minister, Johri bin Abdul Ghani. She quizzed him about his interactions with the Indian edible oil stakeholders and more. In fact, it's a very interesting conversation. We should listen into that.
India is an important market for palm, with 1.4 million population, 1.4 billion population. We almost control 36% of the palm oil vis-a-vis edible oil requirement in India. And with the growing middle income population in India, it's a huge potential in India. And this is where we want to make sure that, we want to have the first mover advantage to introduce to India about the sustainably production of palm. I mean, we want to bring our Malaysian sustainable palm oil into India to explain to all the Indian players that with this sustainability formula that we bring, that will take any product that they produce, a consumer product, to go anywhere to the world, because the world will accept that. So this is where we want to make sure that we will comply with all this sustainability requirement by the world. As a country, Malaysia, we have committed that we want to make sure that as a country, our forest cover must not less than 50%. So we will make sure there's no more deforestation. Today we stand at 54% of forest cover. You must make sure that there's a traceability of all our products, that when they go out from Malaysia, they must have that traceability, and then they must have a legitimate title when they plant the palm oil. And number 4, we must make sure that we comply with international labor practices under the ILO guidance.
Mr. Minister, we do understand that both the countries are quite thick when it comes to especially edible oil.
Yeah.
There are various policies being made right now. What is your sense on 1, the Indian policies, 2, the Indian demand, which is ever growing, and 3, the sustainability or the food security part of it?
So you must understand that the key factors that we want to play our part here is that India is always stressing on food securities. So likewise, a certain agriculture product that we buy from India, like for example rice, onion, we also concerned with our people. So if we can collaborate together, both need each other, then we can make sure that all our palm oil will be. We will ensure there's enough supply of palm oil for India.
Okay. There is various other things also happening. You've talked about climate change and sustainability and deforestation, of course, but geopolitics, currencies, so many elections happening world over. How are you working with all of this macro changes?
We need to address every company differently, because we need to know exactly like India, for example. The agenda is to make sure that enough food to take care of 1.4 billion. Then how do you play your role in order to work and collaborate with India? And if you go to any other smaller countries, their requirements are different. So this is where we need to make sure we are very agile in our policies, and we must make sure that, at the end of the day, if you want to have a long-term relationship, it has to be a win-win situation.
I also want to ask one more question. This is an era where we have seen, we have so many FTAs and trade conversations and, those kind of things happening. Where do you stand within that?
Yeah, I prefer to deal, country by country FTA, because from there, both of this country will be able to have a win-win situation. We can know specifically how to adjust, and if something that it doesn't work, we can sit down. It's much easier to work. rather than, you share with so many countries. That will sometimes, it will not benefit a certain country, and certain country when we do the dealing, it's not a win-win situation. But however, there's a certain matters that we need to look as a group, that everyone benefit vis-a-vis other region. For example, if you talk about ASEAN, for example, or Asia, then we need also to make sure that, we protect our market vis-a-vis European, for example. So this is something that we need to work together.
Right. So we've talked about palm oil. One final question I'm going to squeeze in. You also are the Minister of Commodities. How are you looking at the overall bigger game here?
The bigger game here is actually we must always spend, put a lot of effort to increase the yield instead of increase the land usage. So by doing that, we will be able to save the world. We can do business, we can grow our economy without sacrificing, the environment.
True. You met the industry last evening. There's been a big meeting, I understand, hours and hours. What is their feedback to you?
They're very excited. They're very excited with us, and we're also very excited with them. There's a lot of opportunity that we need to explore.
Okay, so that's the update on the commodity space. We need to take a short break. Just keep your eye out on the markets because there's a worsening which has taken place in the advanced decline ratio as we speak. So the Midcap index is now down around 1,049 points, but the advanced decline ratio is worsened to the low point of the day, and you can see that the gap is just widened. We have around 930 stocks advancing to over 3,000 stocks which are declining on the Bombay Stock Exchange. For the Nifty, 169 points shaved off, and the Sensex over 400 odd points. We'll wait by to see what the global markets throw up in terms of a European opening as well. But as of now, we need to take a short break. On the other side, we'll focus on Nazara Technology, which has acquired the remaining stake in paper boat apps. We'll be talking to the management team.
If you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy. And actually, even in an Indian portfolio, if you want to hedge the risk that oil suddenly goes up, because obviously this Middle East situation could. I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is energy, and these energy stocks pay good return dividends. They're defensive, but they could be like tobacco stocks. From a US perspective, Donald Trump will be risk on for equities because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar.
He wants a weaker dollar, yes.
Yeah, but I also just think, because basically the US fiscal situation is essentially out of control. And we have neither political party remotely interested as at the moment in fiscal retrenchment. So in my view, you should assume it will remain get more and more out of control until the markets revolt against it. The defense sector I first heard about 3 years ago, but in terms of my portfolio, I've missed the defense stocks, but the problem in India is what not to own. Right. So my portfolio has been basically built on where the performance of my greed and fear portfolios come from the last year, I would say in property, energy, and infrastructure. But the missing part of my portfolio is defense. So let's say there's a sudden resolution of this conflict. Maybe the defense stocks will correct, and that will be an opportunity to add.
Please rectify that for us.
Yeah. And then another emerging area in which I'm not invested in, but I mean it's definitely getting more and more attention, is the contract manufacturing sector.
Right.
I believe you call it EMS.
Yes.
So this is an example of another emerging sector.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
last 25 years, CNBC TV18 has closely followed. Welcome back. Well, a CNBC TV18 news break is confirmed. Nazara Tech is set to acquire 48.42% stake or remaining stake in paper boat apps. Remember, Rachna brought you this news first on 28th of June. Well, Rachna, congratulations on the news break and give us more on what you're picking up.
Well, thank you, Ekta. As you said, it is a CNBC TV18 news break confirmed. We had earlier reported that Nazara is likely to buy remaining stake in Kiddopia, which is paper boat apps, for a consideration of about 300 crores, and now it has been confirmed by the company. Now, as we had reported earlier, that this deal would give founders of paper boat apps, which is Kiddopia, Anupam and Anshu Dhanuka, an exit. Now, let's take a look at Nazara and Paper Boats Association. It all started in 2020 when Nazara bought about 51% stake in Kiddopia for a value of about 80 crores. And now 48.42% stake, to be exact, will be bought off for about 300 crores, giving the founders an exit. Now, Nazara has been on an M&A spree pretty much this year. They have acquired a lot of companies like Comic-Con, Freaks for You, all in a bid to expand their presence in youth media and esports space. But Kiddopia deal is a bit different because they already owned about 51% stake in the company. Now, this would mean that they will now have an absolute and full majority control on the company, on the subsidiary, which could mean a lot of revamp is expected within the company. Now, Kiddopia has a subscriber base of about 2.5 lakh with a revenue of about 220 crores and an EBITDA of 55 crores as of end of FY24. So this could mean a lot of new changes coming in for Kiddopia as the founders will now exit the company and all the control will now lie with Nazara Tech and Nitish Mittal Sen.
Take that point, Rachna. Congratulations on breaking that story. But for all the questions, what happens to Kiddopia going forward? We are now joined by Nitish Mittal Sen, who is the joint MD and CEO at Nazara Tech, to discuss this acquisition in detail. Thanks a lot, Nitish, for joining in. The first obvious question is that when you first acquired this company, it was at a net valuation of close to around 150, 160 odd crores. In the next 4 years, when you bought the remainder, the valuation has jumped 4 times, close to around 620 crores as per this round. What caused this significant jump in valuation where the underlying business did not grow as much? And where are you funding this from? Because I look at your numbers, the cash and equivalents that you have on your books are close to around 155 crores. So will you be taking debt to fund this?
Sure. So a couple of points there. One is when we acquired the majority stake, 51% in 2019, the business of this company was around 20 to 25 crores annually, compared to about 220 crores now. So it's almost grown 10 times in the last 4 years versus the valuation that we paid, which is about 4 times. It's also important to understand that the 620 crore value that we prescribed to this company, the Kiddopia company or the paperboard company actually has 155 crores of cash as of March end. So net of cash, the value actually is closer to maybe about 450, 460 crores, which I believe from a Nazara perspective is extremely value accretive to our shareholders, as well as the potential for us to grow the business now. We have specific ideas how we can, in recent quarters, some of the issues we faced in terms of growing the subscriber base. We have some very good ideas that we hope to implement in the coming months, which will hopefully show a new spurt of growth. In terms of the cash question that you had, Nazara today has cash equivalents of nearly 1,100 crores. The 155 crores you are mentioning is actually the cash on the balance sheet of paperboard apps.
Okay. All right. So just wanted to understand, you're saying that the business for Kiddopia has grown from 20 to 25 crores in terms of business revenue in FY21 to around 220 odd crores currently?
That's right.
Okay. What about the subscriber base? And if you could compare the numbers on an FY23 to versus 24 basis for us, because we do understand that there's been some amount of sluggishness which has taken place in the business. So if you could just share what the subscriber rate was in terms of addition FY24 versus FY23, as well as the revenue and EBITDA levels, and whether there's been pressure in this business.
So FY23 revenues for paperboard was 220 crores versus FY24, which was 219 crores. And our EBITDA actually improved in FY24. We were at FY23 about 35, 36 crores, which increased to 56 crores in FY24. That said, the subscriber base was flat for us, largely driven by pressures on the user acquisition on Apple in the US. But like I was saying, I think we've found other ways that we can work around this. And one of the reasons we've taken full control of this company is to be able to execute fast some of the ideas that we have. We think just the US market is much, much larger than what Kidopia is operating today. And it's really become a very loved franchise with kids in the North American market. We also think the India market can be a very interesting opportunity and is one of our growth strategies for this business. I think over the next quarter, we will launch India first model for Kidopia, which also we hope to grow over this year.
So the stagnating revenues at around 200-220 crores over the last 3 years with, net profit being anywhere between 30 to 40 crores as well. Where does this number scale up to, say, 2 to 3 years from now, after you've done all the strategies of fast-paced growth and changes that you aspire to do here?
I mean, I wouldn't want to give a guidance, but I think, anything less than double in the next 3 years, or at least double in the next 3 years is what we should really aim for, and my team should strive for.
All right, and quickly because we have you with us right now, there was a GST demand notice that came into 2 of your subsidiaries. Was close to around 1120 crores. What's your comment on that? And what are you doing to, mitigate that risk?
So this is part of the ongoing GST issues for the real money gaming industry, which we're well aware of. And, I think over 1.5 lakh crores of GST demand have been put on it. So I think Nazara is a relatively small player in that space. And of course, the 1,000 crores sounds like a large number, is a large number also. But in context to the overall industry, it's still not very large. The subsidiaries have their own managements and boards which are looking into the matter, and they will take the right call. But generally, if you look at the whole status of this current issue, it's really awaiting hearing at the Supreme Court. So I think we will see how that pans out. The other thing is the industry is anticipating that with the recent inclusion of, clause.
Right.
Anyway.
All right, we've completely run out of time, but we're going to continue this conversation. Thanks very much for joining in and speaking with us. So that's Nazara Technologies. We need to wrap on the show. Business Lunch up next. The centre of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Way to celebrate our own 25th year with new milestones being achieved on the large street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
What does it take to build?
A fresh bout of selling causes a bigger dent in mid-caps, with declines widely outnumbering the advances today. Real estate, metals and energy are the big drags, while IT and FMCG see small gains.
A ramp up in large deals, strong India business and a welcome pickup in the BFSI segment drives a strong growth surprise for Infosys, which also raises its guidance for the year. The stock gains.
Persistent Systems sees a sharp fall on posting a dip in the profit margins, while lower than expected volumes due to a shutdown at JSW Steel's unit dents JSW Infrastructure's revenue as well as profits.
Reliance Industries is expected to clock healthy revenue growth, but the decline in gross refining margins for the industry could impact profitability. The street, however, is more focused on possible cues to listing of its retail and telecom arms.
Hello and welcome. You've tuned into Business Lunch. I'm Nisha Podar and with me is my co-anchor Sonal Bhutra. So Sonal, today is that day of consolidation and also the big event of budget is just around the corner and market is assessing its position and taking a cautious approach ahead of the big event of the budget. So at the current moment, 0.8% down on Nifty 50. About 190 points have been cut from Nifty 50 to stand at 24,600 levels. When we talk about Sensex, it's closer to about 500 points drop. Bank Nifty is in line with the key indices, 0.75% drop over there. But the biggest cut is really coming in mid-caps. They're seeing clearly a sell-off with 2% cut in mid-cap index. And that's not surprising looking at the market strength where declining stocks far outnumber the stocks which are advancing in trade. Clearly, it looks like the sentiment as well as some nervousness ahead of the big event in the next week. A handful of counters only in the green on Nifty 50, mainly from the IT sector, Sonal.
And it's all about results, right? The individual names which are reacting to the kind of numbers that we have been receiving. But yes, it's a 300-point cut from the highs that we are seeing on the Nifty. Mid-caps, the second day running that we are seeing a big cut there. 2% gone on the mid-cap index, and it's the metal names. Those are the ones which are putting a lot of pressure on the Nifty right now. 3% down on Nifty metal. That is the top loser in terms of sectoral losers as well. CPS index has come in for some profit booking. So yes, it's an overall global sentiment that we are working with ahead of the big budget, as Nisha was pointing out. Markets assessing their positioning because we've already seen a big run-up ahead. So let's begin the show by focusing on IT giant Infosys. The stock is the top Nifty gainer on the back of a stellar set of numbers reported in the first quarter. The company has also hiked its FY25 growth outlook to 3 to 4% from the earlier range of 1 to 3%. Reema Tendulkar is here with the numbers.
So Infosys is still holding up in the green despite the big rally that we've seen. This is a stock which is up 28% since the beginning of June, and Q1 numbers are justifying the rally. Strong beat on revenue, strong beat on margins, and the company has gone ahead and upped its full year revenue forecast to 3 to 4%. Bernstein says the company has delivered its strongest beat in the last 10 quarters. Nomura says Infosys is our top pick. They've raised the target price to 1950. Jeffries says, in context of the Q1 beat and the performance, the FY25 guidance also seems conservative, especially when you see the strong deal wins. And Goldman Sachs, too, says that there are upside risks to the increased guidance.
All right, Reema, thanks so much for getting us the analysis on Infosys numbers. In fact, we also spoke to the management of the company and hear out on all their growth outlook going forward. Take a look.
The way we see what's going on in the market and our guidance, first, we had a strong performance in Q1 on volumes as well as the point that we made on financial services in the US. Second, we had a very strong performance on large deals in Q1, which gives us more visibility into this financial year. And third, we completed the Intech acquisition which also helps us in this guidance. Last multiple quarters, we have moved to the agile hiring base. That basically means we hire freshers both from the campus, off the campus. This quarter, we had a 2,000% net decline, which is lower than the previous quarters. Our utilization is already at 85%, so we have little headroom now left. So, as we start seeing growth, we will look at hiring. We are looking at hiring 15 to 20,000 freshers this year, depending on how we see the growth.
All right, that is the word coming in from the Infosys management. But big boy Reliance is expected to report its results later today. The street is looking at a modest rise in EBITDA on a YOY basis. Sonia Shenoy joins us with the detailed rundown of the earnings preview. Sonia. Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 31.50. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we are expecting a weaker growth on the back of lower gross refining margins and muted growth in the Geo and retail business. Geo is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So, yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
All right, Sonia, thanks so much for getting us what's expected from the big boy Reliance Industries. Those numbers are expected this evening. With that, we'll slip into a short breather on Business Lunch. When we return, we'll tell you all about the latest news and developments of the day. Stay tuned.
Startup platform. It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs.
Welcome back. You're still tuned into Business Lunch on CNBC-TV18. Well, let's talk about the global news and key developments in the US presidential election. Pressure continues to mount on sitting President Joe Biden to back out of the presidential race. Reports suggest that top Democrats Chuck Schumer and Nancy Pelosi have raised their concerns with the president over the Democrats losing ground in the House and over Joe Biden's ability to contest for another term. Former President Barack Obama also reportedly told allies that Biden's chances of re-election is diminishing and he needs to consider the viability of his candidacy.
All eyes will be on the US elections. That's a big event later this year. And Donald Trump, on the other hand, has accepted the Republican presidential nomination before an audience of thousands on the final day of the Republican National Convention. Now, this comes just days after he had survived an assassination attempt, remember, and CNBC's Dan Murphy has more details on the developments.
Donald Trump formally accepting the Republican Party's nomination for president. It was an acceptance speech that began with scripted remarks but trailed off into a campaign-style rally, with Trump going off script, ad-libbing, cracking jokes and running well into overtime. Trump actually exceeded the record for the longest convention acceptance speech, according to NBC News. Of course, the president made a number of pledges. He said he would end the inflation crisis, the immigration crisis, lowering the cost of energy, lowering taxes, and raising interest rates. Here's part of what he said.
I will end the devastating inflation crisis immediately, bring down interest rates, and lower the cost of energy. We will drill, baby, drill. We'll end lots of different things. We'll start paying off debt and start lowering taxes even further. We gave you the largest tax cut. We'll do it more.
And in a show of support for the former US president, pro wrestler Hulk Hogan made a dramatic appearance on the stage. Addressing the crowd at the RNC, he passionately condemned the recent assassination attempt on Donald Trump and then tore open his shirt to reveal a vest that displayed the words Trump and Vance. He then rallied the audience, chanting the words, "Let Trump mania run wild again."
All right, lots of action there in the US ahead of the elections, and it's getting more and more interesting as we get closer to November period. Now it's time for a break then on Business Lunch, but when we return, we'll put the spotlight on the Reserve Bank of India's natural interest rate that is finally out and tell you what this means for the economy. More on this after a very short break.
Stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
So expect a steady quarter from Reliance Geo this time, a 2.9% revenue growth, which will be driven largely by volume growth, that's subscriber addition, while the pricing or the ARPU increase is expected to be 0.1 to 0.2%. These are the numbers: 26,712 crore by way of a top line, EBITDA margin seen at 52.5%, while the profit number is around 5,430 according to our poll. Two key metrics to track. One, subscriber addition. How many subscribers come on Reliance Geo quarterly? Expect a number between 9 to 10 million. While ARPU, the average revenue per user, has been flat for the last 3 quarters. This quarter, expect a minor tick up to 182. But Morgan Stanley says that the Q1 numbers assume less importance because the price hike benefit comes in only in Q2 and Q3. According to them, the benefit to the ARPU could be as high as 16 to 18%. But watch out for the net impact because there is downtrading.
Welcome back. You're watching Business Lunch. Now, Reserve Bank of India's much-awaited natural interest rate for India is finally out, and it places India's natural rate currently at 1.4 to 1.9%. Now, the natural rate is a real interest rate. It is calculated as nominal interest rate minus the inflation. Economists define natural rate as that real rate that which growth is at potential and inflation is at target. Lata Venkatesh will explain all of this and the impact of these numbers. Lata.
Well, the natural real rate of interest, which the Reserve Bank has in mind, was something economists were very much waiting for, and that was announced in the July bulletin. The 1.4 to 1.9%. Now, what is this natural rate of interest? First, we should know that it is a real rate of interest. What is real interest? Suppose you're getting 7% in a bank. Okay, 100 rupees becomes 107 at the end of the year. But inflation is 5%. That is eating away 5 rupees. So what is your real interest? It's only 2 rupees or 2 percentage points. Now, that is the real rate. What is the natural real rate? It is that rate in the central bank's mind or in the central bank's estimation at which the economy is growing as per its potential and inflation is at the target. In India's case, inflation should be at 4%. Now, in India, at the moment, what is the actual real rate? The actual real rate is repo rate, 6.5%, minus 1 year inflation of Reserve Bank, that is forecast at 4.5%. So 6.5 minus 4.5, the current real rate is 2 percentage points. And what is Reserve Bank telling us? That the correct natural rate should be 1.4 to 1.9. Which means the Reserve Bank's policy is tighter than the ideal rate. Why is it tighter? Because inflation is not at target. Inflation, last number we have is 5.08, whereas the target is 4. So the Reserve Bank has kept it tight. When does Reserve Bank or any central bank move the interest rate below the natural rate? When inflation is below or growth is below target, right? That's the meaning of the natural rate. The other thing that Reserve Bank tells us in the important bulletin paper is what is India's potential rate? What do you mean by saying the growth is at potential? They are saying that they have calculated that for the fourth quarter, that Jan, Feb, March quarter, which just went by, the potential output growth is 7%. And for the moment, currently, the potential growth of India is between 5.9 and 8.3. Not very useful. It's a very wide band, but that's because there are a lot of uncertainties. Not much is explained in the paper about this band, but the Reserve Bank gives a lot of explanation why even the natural real rate is a big band, 1.4 to 1.9. Why such a big band? They say that there are various ways to calculate. The paper itself gives 4 models. Filtering as well as, historical way of calculating, Taylor rule, various ways. So by one rule you get 1.4, by one rule you get 1.9%. The key point is that, you have to balance ultimately. This is a theoretical construct and the Reserve Bank has to use its discretion. They also point out that the natural rate depends on even statistical estimation, which can only be approximate. For instance, during the COVID period, that is the third quarter of FY22, October, November, December of 2021, the real rate, the natural rate was fixed at 0.8 to 1%. But now that has been up to 1.2. Why? Because on hindsight, we found that the GDP at that time was not so bad. It has been, the forecast has been revised upward. So because of all these uncertainties and statistical issues, the natural real rate tends to be a wide band. And then, of course, the paper goes on to explain how do you arrive at the natural rate? What are the factors, drivers that influence the natural rate of interest? It depends on many things. It depends on the saving investment trends. It also depends on how the demography is If it's a young demography like us, people tend to save more, invest more. That pushes up the natural rate. There are also other factors like now there will have to be climate investment, green transition. There will also be investments because of AI. All that also pushes up the natural rate of interest. The important point is that we will now keep using this natural rate of interest. You will hear it many times every time the monetary policy of the Reserve Bank is assessed.
Okay, that is so interesting, and it's like an economics lecture. Lata, thank you so much for joining us and making sense of what the report says. With that, we'll take a short break for now. But up next, flights, airports and stock exchanges across the globe and in India report outages. We'll tell you more on this after this short break. Stay tuned.
Churn which takes place. So keep your eye on the net impact of the price hike which we've seen very recently.
Well, let's talk about the O2C and oil and gas business in terms of preview. Let's start with O2C. Now, remember, last quarter was very strong in terms of the O2C margins, but this time around, Singapore margins, they have fallen on a quarter-on-quarter basis on weaker cracks for key products. For instance, something like a diesel crack, it has fallen to $14 per barrel versus $21 per barrel. Even kerosene and ATF cracks, they've fallen to $13.50 per barrel versus $20.8 per barrel. And weaker GRMs on a quarter-on-quarter basis will lead to lower O2C margins this time around. The petchem margins, however, will be resilient. In fact, there is modest improvement which is expected as well. But overall, if we go by the EBITDA expectations, these are put up by Kotak. It is expected to decline 12% on a YOY basis and 20% on a sequential basis. If we talk about the refining margins, though the company doesn't report it, it is seen to decline at 18% on a YOY basis and 26% on a sequential basis. Now let's talk about the oil and gas business. This has been continuously doing well. This time around, there will be a decline in EBIT marginally because of lower realizations and lower production as well. So overall, EBITDA is expected to increase by 35% on a YOY basis, a mild decline on a sequential basis. Volumes will be up 43% on a YOY basis. They will decline by 2% on a sequential basis. Gas prices, they have declined generally. So it's a decline of 3% on a YOY basis, absolutely flat on a sequential basis. So decent numbers coming in from the oil and gas business.
Reliance Retail, the growth driver of the business, likely to drive growth this time around as well. But the only important thing to watch out for would be the impact of the general elections and the massive heat wave on consumer sentiment itself. But nevertheless, because the company has been expanding its store footprint and footfalls are increasing, that would aid growth, and the EBITDA margin would be impacted positively by operating leverage itself. So year on year, Kotak estimates a near 11% growth in the top line of the retail business, around 77,700 crores in terms of this quarter's revenue, and the EBITDA grows a shade higher at around 11.5%. The number you're looking at is close to 5,750 crores. What it means is that the margins would show a slight improvement closer to 7.5%. But remember, this is the first quarter of FY25. FY24 was a record-breaking year as well, where the retail business revenue crossed 3 lakh crore, the profits crossed about 10,000 crores, and the overall retail store footprint also moved near 80 million square feet. Importantly, the company launched a couple of new formats as well. They are among the top 25 retailers of the world. And remember, their stated policy is to be among the top 10 retailers of the world as well. So,
welcome back. Well, let's talk about a big global story. Flights, airports, stock exchanges and other organizations across the world, including India, are in disarray following a global issue with CrowdStrike antivirus protection software installed on Microsoft systems. Services at London Stock Exchange have been disrupted, while a number of brokers in India have also been impacted. Notably, Sky News in the United Kingdom has also gone off air following technical difficulties. This morning, viewers were left with a static message apologizing for the disruption to the service at 6 a.m. when broadcasting was meant to begin. Danish is joining us now to tell us more on how the aviation sector is being affected. Danish, what are you picking up?
Well, a global outage in Microsoft's Azure cloud services has affected airlines globally. In India, 3 airlines have been affected by the global outage, and these are Indigo, SpiceJet and Akasa. These are the airlines which use a particular software called GoNow software, which is used for check-in and other procedures. So this particular software is linked with the wider Microsoft cloud. So this is why we are seeing an impact in India. So airlines in India have informed passengers in advance that the check-in time could be longer. And to tell you more about this, the global outage in India began exactly at 10:45 a.m. and post that we saw a little bit queues started building up in airport check-in counters. And as of now, to tackle this issue, the airlines in India are checking in passengers manually. On the other hand, if we talk about some big airports like the Sydney airport and Berlin airport, these are suspended flight operations temporarily because of the global issue that we are seeing. As far as Microsoft's statement is concerned, a few hours back it said that they're investigating an issue which is impacting users' ability to access various Microsoft 365 apps and services, and they expect this to gradually improve as the day progresses. And just an hour back, they came out with another update in which Microsoft said that their services are still seeing continuous improvements while they're taking mitigating actions. As far as the other global aviation watchdogs are concerned, United States Federal Aviation Authority and UK Civil Aviation Authority have also issued advisories on the global IT outage. So as far as India is concerned, we are not seeing a major issue as the airlines are now manually checking in passengers.
All right, Danish, thanks so much for giving us some very important details on this outage. Meanwhile, the Indian stock exchanges, the BSE as well as the NSE, have clarified to CNBC-TV18 that operations are running as normal and that there is no impact of the global outage linked to Microsoft's technical issues there. So that's a clarification really coming in. So Sonal, all looks good at the moment, but yeah, some flight disruptions. It's the new age problem, it seems.
If we go all digital, that is something that is expected to happen, right? But with that, we've completely run out of time on this edition of Business Land. Stay tuned. Midcap Radar comes up next.
The likes of Tira, Usta and Swadesh pan out in FY25 is something that we'll be watching out for. And more importantly, the most important trigger of demerging or value unlocking in the retail business by separate listing is something that would move the stock too.
Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 3150. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we are expecting a weaker growth on the back of lower gross refining margins and muted growth in the Geo and retail business. Geo is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So, yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
Big US tech companies have huge cash balances, so they're getting 5% where they were before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment-grade corporate sector. The CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment-grade bonds do not mature until after 2029. So those, I think, are the two key. Those are the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So maybe it's going to be a 3-year capex cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point, we have to take a view on whether all this investment is going to lead to monetization. Frankly, I have no view on that.
Neither do we.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Karur. It's a red-looking Friday for our own markets. We have a lot to track, but it's time we start with the top headlines and then discuss everything on the show.
That's right. The broader end of the market seeing quite a bit of selling pressure. A fresh bout of selling causes a bigger dent in mid-caps, with declines widely outnumbering advances, while IT sees small gains. Realty, metals, along with oil and gas are the big drags.
IT stocks well off opening highs. Persistent Systems sees a sharp fall in posting a dip in profit margins. Stock down over 5.5%.
Chennai Petro is trading lower by 14% after the stock goes ex-dividend today. The dividend declared was 55 rupees a share, and the share price adjusts for the same in today's trading session.
Dalmia Bharat falls despite strong operational beat. JPA deal falling through causes capacity target guidance to be delayed.
Capital goods stocks remain under pressure for the third straight session. ABB India, Cummins and Siemens are now down between 7 to 10% in the last 3 trading sessions.
All right, those are the top headlines and a lot of stocks in focus, but mid-caps, of course, those are the ones, that is the one pocket which continues to underperform, down 1.8%, markets at the day's low, and that continues to be the case across all the sectors, barring IT, which is in the green, courtesy Infosys, of course, after that good set of numbers that the company reported. But there are a lot of factors, global factors that we are talking about, and ahead of the budget, maybe the markets are assessing what kind of positioning they want to take. So yes, whatever longs that we saw are just getting unwinded now.
You're absolutely right. That's the sense that we're getting from market participants as well. Now, this is the show Midcap Movers. Hormaz is at the wall, standing by with all of the top midcaps that are moving around in the session.
From a sea of green to a sea of red now, and there are plenty of stocks that are in the red. We'll start out with the top losers, and Dixon Technology is leading the pack there. And it's been quite a bit of decline that we've seen in the last few sessions for Dixon. 5% lower today as well. Cummins is down 5.5%. MCX down 4%. CG Power also not having a good day in today's session. Some earnings reactions coming in. Persistent Systems is the one, 6.5% lower now, near the lowest point of the day. JSW Infra, Paytm was down when the results were out, but some positive management commentary has taken the stock in the green. And Dalmia Bharat also 3.5% lower after the results. Metals are having a bit of a meltdown in today's session. The metals index is the top sectoral loser. All constituents of the metals index losing anywhere between 3 to 4%. The same pressure is being felt in real estate as well. Some money being taken off the table, all constituents there as well, trading with losses of anywhere between 3 to 5%. Phoenix, DLF, Sobha, all of them seeing cuts in today's session. The PSU sell-off continues as well. There was a bit of a rebound with RVNL is one of an outlier bucking the trend, but Chennai Petro now 14% lower, some bit of ex-dividend adjustment, but there is a significant correction there. BHEL, SAIL and HAL within the defense pack is seeing a bit of losses. And lastly, some stocks that are bucking the trend in today's session, other than RVNL, Elcon Engineering has now turned negative, but then other than that, there is Tata Tele and Cyient as well that are trading with gains today. Back to you guys.
Okay, Elcon Engineering is also has to be adjusted for a split that was announced. So today was the X date, so that adjustment has to be made yet. But we spoke about Persistent Systems in that list. Hormaz, thank you so much for joining us. It is under pressure, posted Q1 numbers. Their revenue came in above street estimates, but profit declined and margin contracted sequentially. My colleague Rima spoke to Sandeep Kalra, the CEO of Persistent Systems, and began by asking about the one-off adjustments to the margin. Let's listen into that conversation.
Roughly, they will be in the range of about 150 to 200 basis points if we adjust for all of these things. Because look, if you are growing at 5.6% quarter on quarter, you are also winning larger deals where you are doing transitions which are there, you're doing vendor consolidation which are there. So it's not just a simple mathematics when you're running a company that you basically say, okay, this here and so on and so forth. So it's basically a longer range play where you are winning newer contracts, you are baking in all of those transitions, you're baking in all the optimizations, and then you're looking at a longer range. How do you claw back the margins?
Do you think, there is a possibility, or is the company winning deals by being more aggressive? Is that why maybe your margins are under pressure? Or do you think you've been winning it at the same margins as before?
So it is a fact of life in IT services industry. When you're winning larger deals, when you're doing vendor consolidation, the first 2-3 quarters, when you're even transitioning, the margins take a hit. And that's there for every one of our peers. And so I don't think there is anything, as I said before, to be overtly worried about. And I think there are so many good things that are happening in the company, and we stand by our aspiration of delivering industry leading growth with the profitability same as the last year. So I don't think there should be much concern there.
Okay, so let's talk about the good things then, right? Your revenue growth at 5.6% is the best that we've seen in the last 7 quarters and industry leading, as you pointed out. Is there a turn in the sentiment? Because this is the best in the last nearly 2 years now.
So look, there is small turn in the sentiment. I wouldn't say that this is because of the turn in the sentiment. The turn in the sentiment is people are expecting that over the next quarter to 2 quarters, starting September, maybe there's a rate decrease that happens from an interest rate perspective. And so there are positive green shoots in terms of discussions, not in terms of order wins because of a positive turn there. It's more about proactive proposals from our side. It's more about us scaling up, delivering more value, bringing platform-based solutions based on AI and so on. That's where we are winning. And just for the record, while we talked about the margins, etc., this is the 17th sequential quarter of growth, which is the highest in the Indian IT industry. The last record for that, from what we know, is 16 quarters at best, including the likes of some of the largest multinationals. So from that perspective, Persistent has delivered consistently based on our capabilities, based on our proactive proposals, based on our platform build, the AI play that we have, and that's what is holding us in good state.
Just in the near term, how is Q2 shaping up? Do you think growth will be similar to Q1?
You know fairly well we don't give forward-looking guidance, but I'm sure any smart person can look at the order wins, convert that into revenues, look at our total contract value wins that we have been announcing. So if anyone translates our ACV, the annual contract value bookings, to revenue, adds the multi-year deals that we have won, the answer is there. Balance will let the quarters pan out.
Okay. Some of your peers are calling out green shoots, particularly in BFSI in North America. And BFSI has done very well for you, a 7.5% growth. And even the run rate has hit $100 million. Talk about BFSI in particular. What has changed in the last 3 months for you? And what do you expect? What is the visibility on BFSI growth?
Right. So BFSI for us has panned out very well. It is based on both winning new business in existing accounts, some large accounts that we have, and opening newer accounts at scale against some of our tier 1 peers in the industry. So what is happening is, on one side there is demand that is kind of starting to slowly move the needle. The other side is where companies are looking for, or the customers are looking for, partners who are bringing fresh thinking, who are bringing a platform-based delivery approach to services, not just human-based approach, so that they can save money from business as usual, deploy into next generation capabilities as Gen AI. And that's what has helped us in some of the largest customers and prospects, both in North America and even in regions like Australia, New Zealand, and India. So that's where we are seeing bigger wins, better wins against peers our size and bigger.
You said there's a small turn in the sentiment. Where exactly are we seeing it? Which category, which geographies, which verticals?
Yeah, so from an overall perspective, if I look at it, North America is the biggest market for us. And thankfully, North America is seeing a little bit more positive sentiment than the Europe side of it. Europe is yet to, at least for us, emerge as a bigger green shoot. So if you look at our growth, it's coming predominantly on the back of the growth in North America, growth in places like India and Australia. That is what is leading for us in terms of the growth side.
Okay. Coming back to that point about margin and the fact that FY25 margins will be similar to FY24.
Yeah.
Now, Q1 has had a drop of about 50 basis points. Q2 will have a wage impact, which will again further take away from your margin. So can you take us through the math on how you will be able to end the year with flat margins, and what will be the negative hit on your margins due to wages next quarter?
Sure. So let me give you the simple answer first, and then I'll do the maths. The simple answer is on the wage front, 150 to 200 basis points is the impact from a negative, margin perspective as we increase the wages. And thankfully for us, we have been genuine to our employees. We have not deferred the wage increase. A lot of our peers have. If we did that, we could have maintained our margins by 150, 200 basis points, but that's not the right way to do business. So 150 to 200 basis points negative due to that. But look, what we did smartly was we initiated cost optimization initiatives. We did a mark to market of our employee benefits, mark to market of our various policies to the best in class. And that's what we have done in the quarter one. We have taken certain hits in the quarter one so that as we get into quarter two, we are able to absorb some amount of this wage hike, hit that we will be seeing on the margins. So our endeavor is to deliver better than what would have been normally hit due to the one times or the wage hit that we have taken. As we move ahead, the cost optimization initiatives that we have put in place, the revenue enhancement that we are seeing, all of that will pan out well. Our quarter four exit from a margin run rate should give us the cushion to bring the overall year at near 14.5% plus or minus, and then give us a run rate which is much better than that for the next few years to come. So structurally, we have done what we need to do, and we are on that path to improve our margins, as we have been saying on our earning calls and even in our media interactions.
Well, some important clarity coming in as far as the margin trajectory for Persistence is concerned. Let's now slip into a short break. When we return, we will discuss the market technicals with Sudeep Shah of SBI Securities. Stay tuned.
In 2025 was going to have to take a view, but it's not just, it's more than just building up AI infrastructure, because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. Okay. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether it's going to become monetizable. I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there. But also, frankly, if you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy. And actually, even in an Indian portfolio, if you want to hedge the risk that oil suddenly goes up, because obviously this Middle East situation could. I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is energy, and these energy stocks pay good return dividends. They're defensive, but they could be like tobacco stocks. From a US perspective, Donald Trump will be risk on for equities, because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar,
He wants a weaker dollar, yes.
Yeah, but I also just think, because basically the US fiscal situation is essentially out of control, and we have neither political party remotely interested as at the moment in fiscal retrenchment. So in my view, you should assume it will remain get more and more out of control until the markets revolt against it. The defense sector I first heard about 3 years ago, but in terms of my portfolio, I've missed the defense stocks, but the problem in India is what not to own.
Right.
So my portfolio has been basically built on where the performance of my greed and fear portfolios come from the last year, I would say in property, energy, and infrastructure, but the missing part of me.
Welcome back to Midcap Radar. We have Sudeep Shah, Head of Technical and Derivative Research at SBI Securities, who joins us for a technical check on the market. Good afternoon, Sudeep. Hope you're doing well. How are you looking at markets currently? Are we facing exhaustion at higher levels?
Good afternoon, Vivek. Absolutely. See, after a stupendous up run in the last several weeks now, we are seeing some kind of a fatigue at higher levels, 24,750, 24,800. Although on a daily basis, we are retesting that level, but from higher levels, there is some kind of a supply which is coming. And a lot of that could be attributed to the volatility ahead of the union budget, which is slated next week. So I feel overall the setup is still bullish, but there's some resistance at higher levels. So the strategy should be to add longs at lower levels, closer to 24,530, 24,550, which is an important support zone. And if you see the derivative data also, 24,500 put writers are quite strong still. So we feel that this zone of 24,450 to 24,550 could act as a strong support. And from that zone, we could see a good rebound from lower levels. And about 24,750, once we see a close above this level, then Nifty could head up to 25,000. So the strategy should be to build long slowly. 24,550 and 24,450 will be the overall support.
All right. By the way, the Midcap index has made a substantial recovery, around 370 points from the lows of the day. So it's down 917 points right now. So just watch out for that one. Sudeep, tell us, what would your individual technical picks be in this case?
Good afternoon, Sonal. See, individually, stock-wise, we like Infosys. Now, Midcap IT has made a good move. If you see the charts of Infosys, it has now crossed its prior swing resistances also in the last several months. And we feel from the current levels, this stock could do 3,000, 3,050 kind of levels on the upside, given its structure. So on the downside, the stop loss would be 2810 zone.
Okay. Sudeep, any more, or you have just Infosys for today?
No, only one, because we feel it's better to just be a bit on the lighter side.
Completely understand that. Thank you so much for joining us, Sudeep. Let's now slip into a short break. We'll get you more on the market and stock-specific action on the other side. Stay tuned.
Defense. So let's say there's a sudden resolution of this conflict. Maybe the defense stocks will correct, and that will be an opportunity to add.
Please rectify that for us.
And then another emerging area in which I'm not invested in, but I mean it's definitely getting more and more attention, is the contract manufacturing sector.
Right.
I believe you call it EMS.
Yes.
So this is an example of another emerging sector.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over
the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global.
Welcome back. You're still tuned into Midcap Radar and some more recovery on the Midcap index. It's down 880 now. Just a few minutes back, it was down 970. So there is a visible recovery that we're seeing in that particular index. Just watch out for that one. From the broader markets, Paytm is the one which is doing well in trade, reacting to management commentary post Q1 numbers. Abhishek is joining us for the earnings fine print. And what difference did the management commentary really make this time, Abhishek?
Well, to begin with, Paytm has reported their highest ever quarterly net loss this time around, but it was in line with expectation, especially if you take a look at the preview numbers that Motilal Oswal had put out. So total income is down 33.5% YOY and about 32% sequentially. EBITDA loss is at 545 crore. Now, Motilal Oswal was expecting an EBITDA loss of 490 crores. So contribution profit is at 755 crore. Now, again, Motilal Oswal was estimating contribution profit of 640 crores. So contribution profit margin is at 50.3% versus 56.8%, and they have reported a net loss of 840 crore, which is in line with analyst estimate. That is again Motilal Oswal estimating a net loss of 840 crores. In the con call, the management said that they expect revenue and profitability metrics to improve from here onwards. They have strong balance sheet with cash in the balance sheet being at 8,100 crores. They expect Jan 24 run rate with respect to subscriber addition to be there in their balance sheet by Q3 FY25, and they are awaiting approvals for adding new UPI users who want to be the leader on merchant payment system. So positive commentary coming out of the management has seen the stock surge in trade today. Back to you.
Thank you so much for that, Abhishek. But Abhishek, we believe you've also been tracking Fed Bank Financial Services. It's reported its Q1. How does it look?
Fed FINA, the Q1 looks to be on the weaker side. Asset quality has seen some deterioration over there. So to begin with, in terms of PNL, NII growth is at 40.5% YOY and about 18.6% sequentially. They have done well with respect to net interest margin. Other income is down 11.2%, and that's impacted the net income. So net income is up only 13.4% quarter on quarter. OPEX or operating expenses grew by 39.5% YOY. And 9.6% sequentially. Operating profits are up 43.5% YOY and 18.6% sequentially. However, the provisions, they are up 230% on a YOY basis and about 98.5% sequentially. And profit they have reported is at 70.2 crores, which is up 30.3% on a YOY basis and about just 3.8% sequentially. So if you take a look, the asset quality gross NPA ratio has increased to 1.97% versus 1.66% in the previous quarter, and net NPA ratio has increased as well to 1.6% versus 1.3% in the previous quarter. Back to you.
Thank you so much for that, Abhishek, for putting light on both Paytm as well as FedFina. The other stock that I'm tracking is actually RVNL. If you could pull up the intraday chart of RVNL, in the last hour, there's been quite a bit of a spike. The reason for that is, the company has informed the exchanges that it has gone ahead and signed an MOU, a Memorandum of Understanding, with an Israeli company known as United Construction Limited Israel. What is this particular MOU for? Both of the companies will be cooperating and doing joint works in Israel. And these works, or all of these projects, would be in the field of railways, of infrastructure as well as power, where RVNL will be going ahead and giving their expertise to the Israeli counterpart. At this point of time, there are no further details in terms of what kind of orders they've received. It's just an MOU, but it's an interesting development from RVNL, and the stock is reacting quite positively in today's trading session.
Yes, it's been a big outperformer, and that continues to be the case. The stock is already up 250% this year and adding on another 8% today. With that, we'll do one thing. We'll take your leave on this edition of Midcap Radar with the news that the Nifty is still down 180, but there's some recovery that we are seeing on the Midcap index. Stay tuned. Your stocks when we return.
Celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18, weeknights at 7 p.m.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
So expect a steady quarter from Reliance Geo this time.
Hello and welcome to Your Stocks in the Mumbai News Studio. I'm Ekta Batra. Well, it's turning out to be a tough session for us today. We have recovered from the day's low, but nonetheless, we still have the Midcap index, which is down around 800, 900 points as we speak, and the Bank Nifty, which is down around 273 odd points. The Nifty as well as the Sensex, both of them in the red, showing cuts of around 0.6 to 0.7% at this point in time. But as usual, we have a lot of queries. It's a lively market nonetheless. We're still fluttering around record highs, so we can't ignore that. We do have a lot of queries, especially in lieu of today's sell-off. So we have Shaina Mukaddam, independent market expert, and Vaishali Parekh, head of tech research at Prabhudas Leeladhar, to answer all of your queries. Ladies, welcome to the show. Vaishali, let's start with you. It's been a down day. We haven't seen it very often for our markets. But nonetheless, how would you approach it?
Very good afternoon, both of you. And yes, after a very long time, we started a very strong opening. But yes, market is getting a bit nervous ahead of the budget day. So technically speaking, we were expecting, we had our projected target of 24,950, and we did pretty much close to that. And from here on an intraday basis, I would say 24,550 acts as a support. So I think we are well within the range for today. As far as Bank Nifty is concerned, not much to say. It's the SBI among the banking stocks which is outperforming and showing a lot of strength. But Bank Nifty on the whole continues to have a range of 52,000 as support and 53,000 as resistance. So that's how the major indices levels are.
Okay, all right. Well, we do have a couple of queries now. We do have Chandrasekhar, who writes to us from New Delhi. And he holds 380 shares of Adani Total Gas, which he's bought at around 1,150. So he's sitting on a loss there. He wants to know what to do, the future prospects of this investment. Well, Shaina, we understand that you don't look at this stock, so I'm going to toss it over to Vaishali to answer the technicals and what she thinks of it.
The stock actually has really underperformed before the issues that the Adani sector had. So the high that was made was 3,900 levels, and now for a very long time it is consolidating. So only a positive thing is that it is maintaining its support on a 200-day moving average. So I would say now that he is holding on since such a long time, continue holding, keep a stop loss of 850 levels from here on, because once we see a momentum picking up and the stock moving about 980, I think it's ready to show some bounce back. So I would say now that he's held on for so long, continue holding with the stop loss.
Okay. Anything within the same space that you would recommend, Shaina?
Oh, well, in the power segment, I believe Tata Power looks interesting in terms of valuation, also in terms of the way they have controlled the debt, as well as their increase in capacity that they are planning in the renewable energy space and solar space. So yeah, that's one space in terms of, that's one stock in this space that I would like.
Okay, all right. Well, we do have Balaji now, who writes to us from Tamil Nadu, holds 2,000 shares of Utkarsh Small Finance Bank, which he's bought at around 55 odd rupees. So he's sitting on a loss there. And 500 shares of Bank of Maharashtra, which he's bought at around 65.85. He wants to know what to do, whether he should hold or sell these current investments. So right now, just about, breaking even on one stock and sitting on a minor loss. In terms of the financial space, do you think these two are good stocks to hold on to at these levels, Shaina?
Well, in fact, I would prefer another bank, like maybe a federal bank, over both of them. While Utkarsh has actually, it's a niche player, and it is a niche player in the western region, northwest region. But at the same time, I believe that in terms of valuation and growth, I would prefer federal bank at current levels.
Okay, you would prefer Federal Bank at current levels. Technically, Vaishali, what's your recommendation on this one?
Nothing is really happening in Utkarsh Bank. I think our clarity comes only about 53, 54. And at the same time, there is a strong support at 46. So right now, it continues to be in a range of 46 as support and 53 as a resistance. Unless and until we see a decisive move either ways, it's hard to tell. But I would say wait it out, because right now market itself is quite vulnerable. So I would say wait it out. Let's wait for some clarity. As far as Bank of Maharashtra is concerned, I think gradually we've seen good improvement in this stock, and well, the long-term trend is also intact. So I would say continue holding, because 60 acts as a support, and positional trading target comes to around 73 to 75 levels.
Okay, all right. We do have Prem Garg now, who writes to us from Thane. He holds 200 shares of Keynes Technology. Wants to know what to do with the prospects of this investment and whether he should book his profits or stay invested. So he's sitting on a good profit when it comes to Keynes Technology. What's your recommendation on this one, Shaina?
Well, he can hold it. I believe there is a bit of, it's slightly expensive on the valuation basis, but in terms of future prospects, I believe that there is a lot happening. So you can hold it, you can keep a stop loss, but you should hold it as of now.
Okay, so we should probably hold on to it. And what's your recommendation on this one, Vaishali?
There's no damage to the trend right now, but on a near-term basis, I would say keep 4,000. I mean, it's 398063. So I would say keep 3,800 as support. If that level breaks, then I think it could get into further corrective move. So that is how he should continue holding the stock.
Okay, all right. Given returns, handsome returns of around 55% in the past 3 months odd. So that's the word coming in on Keynes Technology. We do have Jinu George, who writes to us from Goa. He holds 3,500 shares of Cochin Shipyard. Just look at the profit that he's making on that one. He's bought it at around 880 odd rupees per share. He wants to know what to do, stay invested or book his profits. Around the budget, important question, because it fits into this entire defense portfolio, which is seeing a lot of traction. So from that context, what would your recommendation be, Shaina? Sitting on a massive profit, do you think it's prudent to take some off the table or to just hold on?
Well, it would be prudent to take some off the table, in my view, if you're a medium-term investor. I believe because of the expensive valuations, the stock is likely to see a bit of time correction rather than, any dent on actual performance. Even if we saw the full last year, FY24, while, they had a turnover growth of about 50%, their profits more than doubled. And this is likely to continue for quite some, like maybe couple of years, because, you have order book position, which is 5 times their current year revenue. So definitely as they improve the efficiency, I think, the performance will keep getting better. At the same time, I say maybe you can take a bit of profits as of now if you're a shorter term investor, because valuations have really become pretty expensive. If you look at it from whichever parameter, EV to turnover, profit, EV to EBITDA. So I think to an extent, you're making good money, you can take part profits and look at it, re-enter if you see any correction at any point in time in future.
Okay, all right. Well, what are those handsome returns of 677% in 1 year for Cochin Shipyard? That's the key question. I'm sure you have a lot of retail participants who are asking you this question, Vaishali, as well. What does one do with such kind of investments or such kind of gains that they've seen in retail stocks? Technically, how do you track something like this, which is, just gone through the roof? And what would your advice be to retail investors who are sitting on a huge amount of profit in specific stocks?
Exactly. My view matches with Shaina, because even on a technical front, there is some sign of exhaustion. And right now, as I said, market is quite at a make or break levels. So it's very hard to tell what will correct, what will not, because once one correction or a profit booking sets in, I don't think any stock can be, taken as an exception. So right now at a current juncture, I would definitely say one should book a partial profit, wait for some clarity to see the new round of momentum setting in or some corrective move at a support level. That would be ideal to re-enter, and that's how one can better the cost as well.
Okay, all right. Well, we do have the Jubilant Pharmova numbers which are flashing on your screen. The stock is up around 5% reacting to it. Margins have expanded to 14.5% on a year-on-year basis, and Q-on-Q as well, 14.5 compares to around 15%, so it's done well there. There is a one-time gain which has really aided the numbers this time of around 396 odd crores. So the reported profit is around 382 odd crores. And the gain is around 396 odd crores. So maybe the net profit is around 80 odd crores is what they've reported on an adjusted basis, which would be better on a year-on-year basis because it was 6.4 crores same time last year and versus a 58 crore loss last quarter. So it's been a good improvement in terms of the bottom line on a reported as well as adjusted basis. And the margins have improved as well for Jubilant Pharmova. Shaina, do you look at the stock?
I think there's a good rebound that's happened in terms of performance. As you mentioned, they were making losses. There was some restructuring that has happened. I think at current levels, for the shorter term, you may see some bit of, maybe consolidation after this jump that we've seen, this big jump now that's just happened post numbers. But I think after that also, I think we could see a bit of consolidation. But stock looks good from current levels for the medium term holder.
Okay, all right. Well, on that note, we need to take a quick break, but more queries on the other side. Stay tuned.
Growth, which will be driven largely by volume growth, that's subscriber addition, while the pricing or the ARPU increase is expected to be 0.1 to 0.2%. These are the numbers: 26,712 crore by way of a top line, EBITDA margin seen at 52.5%, while the profit number is around 5,430.
Welcome back. Well, we have Shaina as well as Vaishali to answer all of your stock queries, and we have a couple of numbers which are on your screen. Jubilant Pharmova, which is holding with a gain of around 5%. A couple of these metal stocks are really taking it on the chin this afternoon. Tata Steel, Hindalco, JSW Steel, all of these stocks are down anywhere between 3.5% to over 5% or close to 5%. So that's really the screen for you this afternoon. And the advanced decline ratio extremely weak on the Nifty as well. We just about have around 5 stocks which are advancing, and the remaining 45 odd stocks are declining on the Nifty. So that's what the screen is looking like, and that's what you can see in terms of the mid-cap space as well. But let's get in a couple of more queries. We have Ramesh Jain, who writes to us from New Delhi. He holds 25 shares of Delivery, which he's bought at around 380 odd rupees. He's just about, breaking even on his investment, wants to know what to do with this particular investment. Well, over to you on this one, Vaishali. Just about breaking even, but do you see further upside technically?
Well, there's nothing clear in the stock. It is on a downward trajectory. So right now, all I can say is that the indicators are showing that there could be a bounce back right now. So I would say 370 should be taken as a stop loss and wait for some bounce back coming in. Maybe first target could be 400, and above that, one can look for a target of around 430. So that is how I would look at this stock for now.
Okay, all right. What about you, Shaina?
Yeah, I would concur. One can continue to hold this Delivery, the stock. Basically, yields are improving. And we saw that last year was the first full year of profitability on the EBITDA level. In terms of capex also, I believe they are going to now limit their capex, trying to improve the yields on the existing facilities and some capex in the Bangalore facility. So I think overall this new age stock does look like, one can continue to hold for the medium to long term.
Okay, all right. Can hold for the medium to longer term. Aditya writes to us from Karnataka. He holds 50 shares of NMDC, which he's bought at around 253 odd rupees. And he's asking what to do. So he's sitting on a bit of a loss there because his buy price is around 253. Wants to know what to do, whether he should switch to any other stock. Well, Shaina, would you recommend a switch from NMDC to any other stock? And if so, which one? And, would it be a portfolio of stocks that you would recommend?
Well, the issue with NMDC is that the stock has actually started, in my view, to start looking like it is consolidating. If you saw 2 years back, iron ore prices were over $230, and now it has come down to about $100, round about that. And iron ore prices, while that they are remaining a bit soft because of the subdued demand from Chinese buyers. At the same time, it seems to be consolidating in these levels. So I would believe that it is better to hold, as of now, and keep a stop loss. And, if the bounce happens, then I think you would get a decent return from, the investor is a bit disappointed with his buying price. So maybe he will make some money. Do keep a stop loss and then hold it for the medium term. And it sort of will move in the way iron ore prices move.
Okay, all right. I'll follow the iron ore prices. But Vaishali, technically?
Well, it's showing signs of weakness. So I think in all likelihood, this can go towards 200 levels. So depending on the time period that this person is wanting to hold, I would say, actually long term, because all these stocks are very cyclical. I don't think one needs to worry in a stock like NMDC and all. So in my opinion, if it's for a long term perspective, if the stock goes towards 200, one can add more.
Okay, all right. Well, on that note, we need to take another break with the news that we have the markets which are under pressure. Now the Nifty showing a cut of almost 1%. So it's been an aggravated loss that we've seen just in the past couple of minutes. Advanced decline ratio has been extremely weak and is holding at that ratio of around 1:3. But I suspect that there could be a further worsening based on just what we're seeing for the frontline indices. So the Nifty down over 220 odd points. We have the Sensex, which is at the low point of the day, down around 583 odd points. Take a break and be back.
Key metrics to track. One, subscriber addition. How many subscribers come on Reliance Geo quarterly? Expect a number between 9 to 10 million. While ARPU, the average revenue per user, has been flat for the last 3 quarters. This quarter, expect a minor tick up to 182. But Morgan Stanley says that the Q1 numbers assume less importance because the price hike benefit comes in only in Q2 and Q3. According to them, the benefit to the ARPU could be as high as 16 to 18%. But watch out for the net impact because there is downtraining, there is subscriber churn which takes place. So keep your eye on the net impact of the price hike which we've seen very recently.
Well, let's talk about the O2C and oil and gas business in terms of preview. Let's start with O2C. Now, remember, last quarter was very strong in terms of the O2C margins, but this time around, Singapore margins, they have fallen on a quarter-on-quarter basis on weaker cracks for key products. For instance, something like a diesel crack, it has fallen to $14 per barrel versus $21 per barrel. Even kerosene and ATF cracks, they've fallen to $13.5 per barrel versus $20.8 per barrel. And weaker GRMs on a quarter-on-quarter basis will lead to lower O2C margins this time around. The petchem margins, however, will be resilient. In fact, there is modest improvement which is expected as well. But overall, if we go by the EBITDA expectations, these are put up by Kotak. It is expected to decline 12% on a YOY basis and 20% on a sequential basis. If we talk about the refining margins, though the company doesn't report it, it is seen to decline at 18% on a YOY basis and 26% on a sequential basis. Now let's talk about the oil and gas business. This has been continuously doing well. This time around, there will be a decline in EBIT marginally because of lower realizations and lower production as well. So overall, EBITDA is expected to increase by 35% on a YOY basis, a mild decline on a sequential basis. Volumes will be up 43% on a YOY basis. They will decline by 2% on a sequential basis. Gas prices, they have declined generally. So it's a decline of 3% on a YOY basis, absolutely flat on a sequential basis. So decent numbers coming in from the oil and gas business.
Welcome back. Well, for the markets, it is under pressure. In fact, Vaishali, just wanted your thoughts because we are seeing a incremental amount of weakness which is coming in for the markets, and in fact, the Nifty is now shed over 220 odd points. What would your approach be towards a couple of these mid caps which are now selling off? We spoke about the metal space, but even the likes of TechM, Tata Motors, NTPC, Wipro ahead of its numbers. All of these stocks are showing cuts of anywhere between 2 to 3 odd %. ONGC, which has been a rank outperformer this year as well, is showing a cut of around 2 odd %.
So as I said first, on the whole, because Nifty is at a make or break level of 24,550 for an intraday basis, 550, 600. So I think taking that into consideration, we are seeing that, yes, there is some profit booking emerging. But if you talk about stock specific, for example, Wipro ahead of results, but I guess the trend is pretty much intact. And some bit of consolidation is what we are witnessing in ONGC and Wipro and things like that. But Tata Motors has shown some signs of weakness. Below 1,000, it's showing it all likelihood this can go towards 980, 970. So one has to be cautious at these levels.
Okay, all right. One has to be cautious at this point in time. We do have another query now. We have Reema Shah, who writes to us from Gandhinagar, holds 20 shares of ICICI Bank, which is bought at 987. Wants to know what to do. She's sitting on a profit right now of around 5,000 odd rupees, and she can hold it for a horizon of around 5 odd years. Well, it's more or less a portfolio stock, you would have to say. So Shaina, from that point of view, 5 years would be prudent for one to probably hold ICICI Bank?
Yeah, definitely. It's a portfolio stock, as you put it, with price to book even currently about 3 times. It's not expensive. You have the loan book growing by about 15%. You have NIMs above 4.3, likely to be between 4.3, 4.4%. So things are going well. And it's, one of the leading banks in terms of their retail portfolio. So definitely it's a portfolio stock one can hold for the long term.
Okay. And what about you, Vaishali, ICICI Bank?
I would say this bank right now, in spite of all the choppiness, is holding very well. So that shows the inherent strength. So now if it's for a longer time period, I mean, of course, even the monthly chart, etc., is showing a very strong trend. I would say such a stock should be a buy on dip strategy and keep adding to your.
Okay, all right. Well, we do have Rohit now who writes to us. Before that, I just want to address the Atul Q1 numbers. Revenue is up around 12 odd %. EBITDA has expanded quite significantly as well, up over 20% year on year. So EBITDA has come in at around 223 odd crores and margins close to 17% for that particular company. Atul in focus. But we do have Rohit who writes to us from Chennai, holds 10 shares of PI Industries at 3380. Wants to know what to do, whether he can stay invested for 1 year or look for better opportunities in this particular space possibly, or maybe even outside. Well, Shaina, I'm going to toss it to you on this one. What would you recommend?
I would recommend that he can switch from PI Industries. While the overall chemical industry has been going through a pain, the pesticide industry also, over the last 1 year, PI Industries has managed, to show growth in revenues to maintain its profitability. At the same time, I believe in terms of valuation, everything is priced into the stock. It's very expensive. If you look at EV to sales, it's 6 times. You look at PE, it's 30 times. For a chemical stock, which is likely to see the whole sector likely to see continuing slowdown for the next couple of quarters, 2-3 quarters, I think one can switch.
Okay, all right. And a quick word on this one, Vaishali. It's just about given returns of around 6% in the past year.
Technically, it is quite intact. The trend is also intact, and 3,500 acts as a very good support. So if chemical sector and PI Industries continues to move higher, I think this can go towards 4,200. That's a level to look at for booking profit. But however, my view gets negated if 3,500 levels break.
Okay, all right, fair enough. Well, on that note, that's all the time that we have on the show. But do remember to email us your questions. We'll address them with our experts. Stay tuned, closing bell up next.
Reliance Retail, the growth driver of the business, likely to drive growth this time around as well. But the only important thing to watch out for would be the impact of the general elections and the massive heat wave on consumer sentiment itself. But nevertheless, because the company has been expanding its store footprint and footfalls are increasing, that would aid growth, and the EBITDA margin would be impacted positively by operating leverage itself. So year on year, Kotak estimates a near 11% growth in the top line of the retail business, around 77,700 crores in terms of this quarter's revenue, and the EBITDA grows a shade higher at around 11.5%. The number you're looking at is close to 5,750 crores. What it means is that the margins would show a slight improvement closer to 7.5%. But remember, this is the first quarter of FY25. FY24 was a record-breaking year as well, where the retail business revenue crossed 3 lakh crore, the profits crossed about 10,000 crores, and the overall retail store footprint also moved near 80 million square feet. Importantly, the company launched a couple of new formats as well. They are among the top 25 retailers of the world. And remember, their stated policy is to be among the top 10 retailers of the world as well. So how do these new formats, the likes of Tira, Yousta and Swadesh, pan out in FY25 is something that we'll be watching out for. And more importantly, the most important trigger of demerging or value unlocking in the retail business by separate listing is something that would move the stock too.
Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 31.50. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we are expecting a weaker growth on the back of lower gross refining margins and muted growth in the Geo and retail business. Geo is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So, yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
big US tech companies have huge cash balances, so they're getting 5% where they would get before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment-grade corporate sector. The CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of...
Negative start considering the handover that we had from Wall Street. It's right across the board in Asia as well.
It's a blockbuster quarter from Infosys this time, and now Infy is the fourth IT company to report good set of numbers.
Year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year.
Many US stock indices hit new one-year highs before pulling back.
Citi, interestingly, has initiated a sell on the stock with a target price of 1575.
30 points higher, outsized impact from Infy, I'm assuming, but 24,822.
This market reminds me of Amar Akbar Anthony.
Growth for Persistent is very strong, but the street is a bit concerned about the margin performance.
I think the biggest gift that the government can give is just macroeconomic stability.
A fresh bout of selling causes a bigger dent in mid-caps.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, it's been that kind of a day after a long time, a sobering day when money has been coming off the table, not just in mid-caps, but in large caps as well. So we cannot say that we've managed to escape or ignore the global cues today. This is Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal Studios. I'm Surabhi Upadhyay, with me Nigel D'Souza, as well as Manglam Malu.
Hi, it's the second day running, I guess, where the mid-caps are actually underperforming. And ahead of the big events that we have, budget just being one of them. I was just looking at some of them. Today, post-markets, you have Reliance that reports numbers. Tomorrow, you have HDFC Bank reporting numbers. So you have two heavyweights reacting to results on Monday. Thereafter, on Tuesday, you have the budget. And then Thursday, you have the July series expiry. So all these events, the market at a record high, maybe a bit of sobering is good.
Well, I think, you're looking for excuses for the market to pull back. And today you have many, actually. Overnight, the cues were weak. You're getting into a budget. Normally, getting into a budget, history suggests that the market actually goes into the budget a little bit subdued, which didn't happen for the last couple of trading sessions odd. You had that technical glitch globally that's been affecting trade at various parts of the world as well. So if you wanted a reason, with plenty of reasons today. The good news, though, for me is at least yesterday's low is still held out. We have 50-60 points away from those levels, 24,500 odd. So it's a bit of a down day. I'm not too worried. I think the action continues in the large caps because we have a big event ahead of us. And that's par for the course, I would say. The strength that you're seeing, though, on SBI, that's telling you a story, right? Because SBI, all through the trading session, has been holding steady. Well, you have the Nifty Bank as well that's under some pressure, metals as well. SBI, even now, it's not yet moved into the red. It's as flat as can be. So that's one stock that I'm keeping an eye out on. Though tomorrow, the big cues are going to be coming in from Kotak Mahindra Bank and HDFC Bank as well.
Yeah, well, I have to say that after a long time, the way we are reporting on the market is changing. So we are going back to the dictionary to get the old adjectives out because, that dip has not really been bought on the Nifty as well. It's been a one-way slide and we have just not seen this kind of a chart in a long time. Let's see, 1 hour to go whether anything changes or not. But given all the events that are lined up, perhaps some caution is warranted. Barring some of the IT names, actually even Infosys, look at it, the pop is just 2%. It started almost 4-5% higher and now the gain is only 2%. Rest of IT is actually cooling off a little bit, barring LTI Mindtree. Some of the other names like TCS are down. You have ITC for a bit of support. But other than that, it's weak. Metals are very weak. Pull up all the metal stocks. Tata Steel, Hindalco, JSW Steel, beyond the Nifty, things like Nalco, Sale. Metals basically are a no-go area today for the bulls.
Well, I'm liking a couple of these paint names right now, the way they're moving, because Asian Paints was one of the bigger casualties in yesterday's trading session. The street may be putting behind the first quarter weakness, largely because The company's maintained its guidance for this year. The management had told us here itself that, in the second quarter at least, they're looking at 10 to 11% volume growth with improved margins as well. The band that they had given earlier was 18 to 20%. Now they've increased that to 19 to 20% with more likelihood of it being closer to 20%. And in the very near future as well, there could be a hike to the tune of almost 0.5 to 1% in terms of paint prices in the offing. And with all of this, the stock has been quite an underperformer. In fact, from its peak, it's corrected about 20-odd%. And I was looking at some data. All the financial years, right from 2009, FY 2009, every year, Asian Paints has given you positive returns, barring last financial year, where it was down about 10%. Now, this financial year so far, it's up about 3%. So it's coming off a lot of underperformance. Let's see what happens. They said that, early days to speak about competition, but they still haven't been disrupted. Is the street believing that maybe from here on, things will move up for Asian Paints or not? Is something I'll be watching out for. And alongside that, we're seeing a bit of an uptick on Berger and the likes as well. So all these stocks on our radar.
I recall having that chat with you, Mangalam, on the day of Asian Paints numbers. And I said, actually, the street is positioned for these numbers, for a weak set of numbers. And that's why yesterday, I think, after you spoke to the management, we saw a bit of a recovery. And today as well, the stock is holding steady. So good call on Asian Paints. The stock, going by the numbers, one would have thought it would easily fall 7-8% odd. But yesterday it was down a little bit. And today, in fact, it's almost back to the levels that we saw prior to the results. So that's the kind of move we're seeing on the leader from the cement pack. That's about that for the time being. We're at the low point of the day, 24,550 odd. Let's get in a quick technical check on the markets and how do you position yourself before you get into the weekend. Mitesh Thakkar joins us. Well, Mitesh, good afternoon. And it's that sort of a day, right? If you wanted a reason, you've got plenty why the market should pull back. And the Nifty is down 250 points odd, which is, we've been saying it's par for the course. What's the trade out here? What are the levels you're looking at on the downside? And if those levels break, then you'll be getting a little bit cautious.
Okay. Good afternoon, Nigel. I'm already cautious. I think, the reason being, I think the Bank Nifty indicators and the Nifty indicators are not showing any confidence on the upside. And we have an event approaching. So maybe there could be some profit booking before the event, which is today and on Monday. And that looks a quite likely scenario. But talking about the levels, I think the Bank Nifty has important support around 51,940, 950 zones. And the Nifty, I think corresponding levels are 24,420 to about 24,300. I think that entire 100-point band is filled with supports. But the indicator setup is still suggesting that, we could at least test them, and in some negative news case scenario, which happens if it comes with the event, then I think, we might be ready to go below them. So I'm not very comfortable. One, we have exited all long positions. Two, now exploring some shorting opportunities in the market. So that's the way we are approaching. Though in the shorting side, IT and FMCG is off the limits. I think, I would still want to buy them maybe at lower levels.
Oh, that's interesting.
On the stock side,
go ahead.
Yeah. On the stock side, I have a sell on Canfin Home. Keep a stop at about 865. Look for targets of roughly around 820. And the other one is a sell on Coal India, which I would recommend selling with a stop at about 497 for targets of 470.
All right. Shorting the market right now and a couple of stocks as well on his radar. Mitesh, we'll come back to you in just a bit. There are some comments coming in from the IT minister. They're saying that the METI is in touch with Microsoft and its associates regarding the outage right now. And the reason for the outage has been identified. Updates have been released to resolve this issue at the earliest. Infosys, however, is one of the stocks.
Sorry, on the issue of this outage, I was trying to read what's going on. It's a global issue. And the company that's associated with Microsoft, it's called CrowdStrike. And that's a service provider in terms of cybersecurity. And it seems that that's where the crash and the failure really has come in from. And by the way, since it's a listed company on Wall Street, in after hours trading, those shares are already down 14-15%. So it's a big issue. But let's see, maybe they'll get a handle on it and things will normalize soon enough.
All right, we do that. And we also have the numbers of Blue Dart at the bottom of your screen. 13% down on the net profit, even though there was an uptick in the revenue. So maybe it's a bit of a margin compression that we're seeing. The stock down about 5%. The street was hoping for some pickup in e-commerce. Seems like it hasn't happened in at least, the first quarter. Let's see how the festive season and all the other parts play out. Typically, Blue Dart does have some sort of correlation when it comes to the e-commerce business with something like a delivery as well. So pull up that chart as well. So the EBITDA is up for 5.8%. Margins have compressed by about 30 basis points. So the net profit decline may not be as big. Stock is lower. Delivery too is lower right now. We'll keep an eye out on what the reasons were for the net profit to decline 13%, even though we saw mild margin compression, not as much as the net profit would have you believe. Let's talk about the bigger gainer today, Infosys. Top Nifty gainer on the back of a stellar set of numbers coming in from the company in the first quarter. They also hiked their growth outlook to 3 to 4% from the earlier range of 1 to 3% itself. Rima joins in with the detailed analysis of those numbers. Rima.
So Infosys is still holding up in the green despite the big rally that we've seen. This is a stock which is up 28% since the beginning of June, and Q1 numbers are justifying the rally. Strong beat on revenue, strong beat on margins, and the company has gone ahead and upped its full year revenue forecast to 3 to 4%. Bernstein says the company has delivered its strongest beat in the last 10 quarters. Nomura says Infosys is our top pick. They've raised the target price to 1950. Jeffries says, in context of the Q1 beat and the performance, the FY25 guidance also seems conservative, especially when you see the strong deal wins. And Goldman Sachs, too, says that there are upside risks to the increased guidance.
All right, Rima, but we can't let you go at that. Persistent Systems as well has seen a sharp fall post that big dip that we saw in margins. Tell us more.
On Persistent, the street is a bit concerned about the margin performance. So reported margins have declined by 50 basis points to 14%. This is lower than street expectation. But even this 14% has some element of one-offs. And the one-offs are estimated to have boosted margins by 150 to 200 basis points. But there is no taking away from the fact that this growth has been very strong for the company at 5.6%, industry leading, a very, very strong top-line performance. But as I said, some concern on margin. And plus, the stock has been a big outperformer since the beginning of June. The stock is up 35%, outperforming Nifty IT, which has rallied about 24-25%, and plus the premium valuations.
All right, Rima, thanks a lot for that. That's about Persistent and Infosys. Just a word on Blue Dart once again. The profitability has been impacted more by non-cash expenses like depreciation, which have increased from about 99 crores to close to around 118 odd crores. The margins have compressed a tad bit. We've seen some sort of revenue growth, but the street would have liked a little more than that for Blue Dart itself. Explains why the stock is down by about 5%. Good time to get in Prakash Diwan now joining in. Prakash, so much to speak about. Individual stocks, the IT space, which has been doing well. FMCG has been resilient as well. And then a couple of these individual numbers that come by as well. Let's start with the IT pack itself. Infosys, Persistent, both Rima spoke about. Infosys has been on a tear. Persistent, the margins are a bit of a miss. What are your thoughts here?
Good afternoon, Mangam. So yes, what IT numbers are telling us is that everybody is trying to shore up in terms of its revenue growth. And of course, at some point there's some sort of a clawback on margins in terms of, whether the margins that we've seen in the last 2-3 quarters we can make some sort of a departure from there. Infosys has successfully done so. Persistent has not been persistent with the margin growth. So, and what is important is that we understand that some of these stocks ran up in anticipation of an improved environment, which probably is still not very clear. If you ask me, the 3 big numbers that have come through haven't yet given any kind of an affirmation on the improvement in the environment itself. Persistent, if you remember, there was a Bernstein report where some of these auto-related businesses, the ENRD businesses, were evaluated, and that was the time when it probably was at the same level, 4550 or wherever, but it saw a very rapid move in anticipation of some sort of a growth, but which has not come through. So the market is not willing to be very, very gracious about promise ahead, but they're very clearly markets looking at numbers which have happened and very clear visibility of the numbers in the next 2 quarters. So I think IT will go through this up and down kind of a mood. But my sense is you'll still have to wait for 1 more quarter, Manglam, for IT to actually start getting some sort of a capital allocation which makes it serious. Till now, it's really, we're flirting with some moves here and there, but it's really not something which is a secular trend that's coming back. So I would say be cautious, don't get excited just with one-off numbers. You could have an Infosys in the portfolio, continue building up on that or holding that up, but don't make any fresh allocations to IT on the basis of what we've seen till now.
Okay, all right. Prakash, I wanted your word, on which cement company. Any guesses? Which one? Dalmia. Absolutely. Yes. So let's do a quick analysis, and then I want to come across because, over the years, you have timed that pretty much bang on. So let's get to the numbers. Numbers look good. EBITDA much better than what we were working with. Margins as well, much better than what the street was working with. And the reason for the beat was realizations on a sequential basis. Well, they in fact, didn't decline as much as what the street. In fact, they were more or less flattish. That's point number one. Second factor was the cost came down drastically, both on a sequential basis and year on year. So both those factors put it together, the EBITDA number was much better. But why is the stock down? Well, a few reasons then. There is weakness in pricing, which continues. The cement exit price as of the last quarter, well, they are 3% lower than the average of the first quarter. So that's telling you pricing pressure will continue. Dalmia Bharat, though, on the pricing front, you'll say, why was their realization more or less flattish on a sequential basis? They altered their product mix. They also rationalized some part of their discounts, and that was the reason. Point number two, the other factor the street could be a little bit disappointed about is that by 2027, they were saying that the capacity goes to 75 million tons. Now they're saying not 2027, it'll be 2028. So some pushback out there. What are the other takeaways from their con call? Well, on cost, they're planning on reducing costs by around 150 to 200 million tons. They'll get high amount of captive coal. They are looking at renewable energy as well, and reduction in lead distance. That's the reason why they're saying that they'll be able to, focus on the cost side and reduce costs by 150 to 200 rupees per ton. On the JPA assets, actually, how much did it come in? Remember, there's a tolling agreement currently out there. So JPA assets contributed 0.4 million tons. So X of JPA, which is now not going to come in their fold, actually there was no volume growth whatsoever, but they're still in discussions with the regulators to see what can be worked out on that front. And the last factor is they say they're continuing going to grow better than what the sheet is working with. They say industry will grow by close to around 8% and they'll grow 1.5 times, which means that if you try to extrapolate that, they're guiding for around 11 to around 12%. Prakash, in the last 1 year, if I look at the chart of Dalmia Bharat and UltraTech Cement has seen a big re-rating. But Dalmia Bharat, even year to date, we're talking about this big bull market run, and Dalmia Bharat hasn't participated. In fact, it's low. I think my director will get that chart up. What's the word on the asset from here on, on Dalmia Bharat? Because valuation-wise, there is support. The problem is JPA is not going to come in its fold. Maybe that capacity addition is not going to be going according to trend. And the pricing pressure is definitely hitting them. Tell us.
Yeah. No, absolutely. I think that was a brilliant analysis, Nigel, as always. And, the reason why you recall about 4 months back, it said it's time to kind of switch out of Dalmia Bharat precisely for, some of these uncertainties that have started plaguing the company. One, they've not been able to organically grow, and the inorganic growth that they tried is also kind of a bit sketchy. Remember, we are in an environment where the big getting bigger is always going to be beneficial to those large players. If Dalmia Bharat doesn't scale up, it tends to lose a lot of market presence in that sense. Pricing is, of course, a challenge. Even if the industry grows at 8%, if they were to grow at 10 or 12%, which they are talking about, they'll need to reinvent themselves on certain counts. Right now, the benefit on margins is primarily attributed to lower raw material costs. There's absolutely no other efficiency build-up which has happened. Now, all these new talk about the solarization, some of those other things that they're looking at doing, and the project and this expansion coming through in only FY28 and beyond, I think you'll have to give it time. So let them get to the drawing board in terms of all of those. And if that were to start showing some signs of getting in place, you will see a re-rating happen. So why it's not outperformed the likes of UltraTech? Because it was already priced well. It did fetch a little bit of a better valuation. UltraTech caught up on some of those counts and actually has gone ahead. So it's as simple as that. It's a phase of the cycle of this business where it's probably going through a little bit of consolidation. Look at companies like JK. Now, JK Cement has come and started doing a lot of right things, which it was earlier not able to do because of whatever reasons, decision making and all of that. But today, the way they are poised, you will probably see a run there in terms of people realizing that they've got their act together on some of those very simple efficiency related matters. So this happens in every sector where leadership rotates, where the promise rotates, is moving from one to the other. But I would definitely look at the JK Cement in lieu of Dalmia Bharat now for at least a medium term.
All right, as in just on cue, Prakash, we're discussing the cement space. We understand the UltraTech numbers are out on the wires. Soon enough, we'll get some more analysis going on out there. The one number that we have at the bottom of your screen is the net profit, 1695 crores versus the CNBC-TV18 poll of 1728 crores. Doesn't tell you much. You have to look at the revenues, the EBITDA, and more importantly the volumes of Ultratech as well going forward. The revenue is largely in line, actually, 18,070 crores versus the CNBC-TV18 poll of 18,059 odd crores itself. The stock is mildly lower in today's trading session, though it has been lower from the start of the session itself. Not much change ever since the results have come. The EBITDA, that's a bit lower than expectations, 3,041 crores versus a poll of 3,319 crores itself. So what we have so far for Ultratech, net profit mildly below street expectations at 1695 crores versus a poll of 1728 crores, led lower by the EBITDA, which has come in at a little over 3,000 crores. The street was working with a number of 3,300 crores thereabout, and revenue has been largely in line, and that explains why the margin has missed estimates at 16.8% versus 18.4% as well. Nigel's going through some of these numbers, but Nigel, from the front line numbers that we have right now, the revenue, margins and EBITDA, what does it look like?
Well, these numbers are disappointing actually, Mangalam. If these are the numbers and this is no one-off, because there is a benefit that they've got of lower power and fuel cost, but that margin that was flashing on the screen, well, that's a bit of a disappointment. I'll tell you what, there's no cooling off on the freight and forwarding expenditure, not much at least out there. On the power and fuel cost, there has been some decline, but maybe the street was anticipating a little bit more of a decline out there. And what's gone up actually on a year-on-year basis is the other expenditure. So we'll require some clarity on that front. This margin number for the time being, that's a little bit worrying, because the top line is pat in line with what we are working with. We're waiting for the volume number. To give you a sense, we are working with volume growth of close to around 5.5 to 6% approximately, which is more or less in line with what the street was working with, but we're expecting pricing to remain weak. So just trying to get out further details on that front. There is some cooling off on power and fuel costs, but we'll have to wait for further details. I think we have got operations. Yes, domestic sales volume growth is around 6%, so no worry on the top line. Energy costs actually are lower by close to around 17% on a year-on-year basis because of the reduction in fuel cost. But the raw material costs, they rose by close to around 1%. That's attributable to the increase in cost of fly ash. So, that's the key reason why, in fact, these numbers could be a little bit softer. Volume growth in line. Maybe the realizations were under pressure, but it appears it's as much as expected. And maybe they have not got the benefit in terms of operating leverage on the raw material costs, which explains this miss out there. Well, let's get in Ronald, the Associate Vice President at Sharekhan, by BNP Paribas, who joins us. Hi, Ronald. Good afternoon. Good to see you. Well, volume number, no worries, but the margin picture is a little bit worrying, which our ticker team has put out there. Could you tell us your first take on the numbers?
Yeah, actually, we were estimating around 5.5% volume growth. So, volume growth, as you said, yes, in line with the estimates. But we are expecting around 18.8% operating margin, a little over 1,000 rupees EBITDA per ton. So that we need to check whether that has come in line or not. But overall, we have seen that Q1 has been weak in terms of, like in the earlier call also, there was a highlight that 2 to 4% volume growth was only there for the industry. So Dalmia and Ultratech, reporting 6% volume growth is good enough for Q1 in terms of, they have been trying to, gain market share, and that may have led to lower realization and a little bit, off it on the EBITDA per ton. But Dalmia's performance in terms of EBITDA per ton was better than expectation.
That's correct, but the street expects the best from the largest player, right? So I guess that's the reason why, in fact, the stock is pulling back a little bit. And as we were just talking about, the stock has as is rallied, I think, 25-30% just in the last 1 year. What's the view on the stock, Ronald? The stock is down 3% as of now. There seems to be some pressure on margins, and it will continue in all probability for the coming quarter as well, because pricing is still weak, as we know, and we're already in a seasonally weak quarter. So if the stock falls, say, another 2-3% from here on, would you be a buyer?
Yeah, definitely. Considering the strong pullback, the strong run-up they have seen, there would be, pullback. So, 4-5%, single-digit pullback should be a buying opportunity for the stock. Pricing environment will remain weak, as exit prices for Q1 are still 3% lower than the average Q1 prices. So, pricing environment will be weak. but all eyes would be there on Q3 in terms of demand and pricing. That being said, all the cement players are, trying to gain benefits from the operating cost per ton. So what is UltraTech's view in terms of, getting more out of OPEX per ton? Each and every company has certain targets of reducing operating cost per ton because the pricing environment may not remain favorable for, at least for H1 FY25.
Okay, all right, Ronald, thanks for that quick first analysis. Appreciate you being with us. That's UltraTech, disappointing, and the stock's dealing with it, 3% down. I guess, Nigel, you said it, right? That from the largest player, from the big giant, the expectations usually run higher, and there's a miss on that margin front.
I'll tell you the problems will be. The problem is that, the industry didn't grow that much, but UltraTech wants to grow better than the street. Something's got to give, right? And it appears pricing is giving away right now. The large, they want to get larger. The smaller guys are going to get gobbled up. But in the interim, there's going to be pricing pressure. So in the longer term, it's going to be good, all this entire talk of consolidation. But in the near term, everyone wants to stand their turf. They want to get, a high amount of the market share. And just one more quick word, we'll wait by for further details. But for the time being, just pull up the intraday chart of Orient Cement as well as India Cement. Plenty of buzz yesterday. As of now, I've not yet seen any mention of that. The street expected something or the other to come on both these two fronts. Officially, we know that, UltraTech has gone ahead and picked up more than 20% stake on India Cement. And yesterday, the stock was up close on 10%. As of now, there's no mention as yet, but we'll wait by for the press release. So that's why, in the last few minutes, the stock actually has come off the high point of the day. And no mention with regard to Orient Cement as well. Not yet, at least. That's the key word in there.
Well, cement, you never know. So much going on in that sector, right? So
sometimes I get nervous on a Friday evening as well. I just want to take it easy, and then suddenly,
as long as they don't announce on a Friday.
Nowhere, suddenly, I was happy that actually Ambuja went ahead and picked up Penna on a weekday. I think it was Thursday evening. So you get a little nervous because these deals are coming out of anywhere, and we know, I have my ear to the ground. I know a few deals are in the works, but I just hope
Monday to Thursday.
Monday to Thursday, all right. And definitely not next week because you have the budget and all these things as well. So
if the deal makers could just hold off a while longer. Okay, Prakash, before we let you go, a word on UltraTech if you want. And I wanted to ask you, there's a bit of a mini sale going on in the mid-cap market, which is a rarity these days. I mean, you've got Cummins coming off, there's Dixon down, quite a few, even some of the PSU players and some of the defense players as well. Anything you're buying in this sale?
No, so essentially, this was not a surprise. In fact, I would have expected this to begin from Monday itself, but it's probably taken a few more days. This is lightening of positions will be before you go into an event like a budget. What the budget is going to do is it's not going to make things very disturbingly bad or unfavorable. I think the budget is going to set the tone for the next few years and set some new direction for some new sectors to emerge. So while defense and power and railway, all of those themes kind of have done very well, the stocks need a little bit of a cool off. And you'll probably have newer opportunities coming, whether it's in waste management, water management, space, EVs. So there's lots that's possible. And I think markets kind of gearing up for that and sitting on cash to be able to take advantage of anything new that comes up. So, and of course, if there is consolidation, which probably begins with the small caps, moves to the mid caps and the large cap, it's healthier for the market because then you have sector rotation, which is not very drastic. So if that's gradual, next 2 months, it's probably going to be very good for people who want to buy long term. And I'm saying this till almost like September, you might see this kind of a thing where we are sideways or soft. So good for us who want to buy value and not necessarily participate in momentum. So I wouldn't be very surprised, but there's regular profit booking which is underway, and that's evident in the markets.
Take that point. Interesting, because Chris Wood also said that India is the only exception in the world where the small caps are doing a lot better than the large caps, where everywhere else there has been narrowing of the market strength or concentration in just a few large cap stocks itself. Wonderful speaking with you, Prakash, as always. Wish you a very happy weekend. In fact, before that, we'll also get you on for Reliance results and get your opinion on that as well. But for now, good break, and enjoy the holiday. Come back on the other side, we'll get chatting with Rajesh Kothari of Alf Accurate Advisors. He'll speak about the markets and a lot of individual stocks too.
Bonds do not mature until after 2029. So those, I think, are the two the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So maybe it's going to be a 3-year capex cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point, we have to take a view on whether all this investment is going to lead to monetization. Frankly, I have no view on that.
Neither do we.
But at some point, in early 2025, one's going to have to take a view. But it's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. Okay. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether it's going to become monetizable. I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there. But also, frankly, if you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy. And actually, even in an Indian portfolio, if you want to hedge the risk.
Welcome back. So not much changing on the screens. The same thing we're reporting, 240 down on the Nifty. And the Midcap index is still nursing a cut of about 1%. We have Rajesh Kothari of Alf Accurate Advisors joining us on this leg of the show. Rajesh, good to have you on. So the market's seeing a bit of a cool-off today, something that it doesn't usually do. But you tell us if there have been any changes in the portfolio since our last conversation and what your top bets or the biggest overweights are at this point in time.
Well, frankly speaking, no major changes. I think we remain bullish, extremely bullish on capital goods as a theme, and no change in that theme. In fact, as more and more global power shortages and the grid complexity, we hear more of that in Australia, in Europe, and now in USA. That means more benefit to Indian companies who have a competitiveness to supply to the world market. So I think the capital goods as a theme will continue. And I think probably in budget days, you will get more of that because the capex plans, be it railway, be it defense, or be it the power, and so on and so forth, will get further crystallized. So that's our first theme, and we remain fairly bullish on that. Our second theme is automobile and auto ancillaries. Again, this space is doing extremely well, and the more electrification, as I keep talking about from last several years, the more the content per vehicle, and that's better for the auto ancillary names. And the third, of course, is the consumer. That's a space which we have been adding weight from last 3 to 4 months, and that space is also doing reasonably well. So these are the three themes on which we are positive and have a good exposure across our portfolios.
Right, interesting. Capital goods, auto ancillaries, and consumer itself. We'll speak about the consumer space in just a bit. Rajesh, I was looking at a couple of these tobacco stocks as they're moving right now ahead of the budget. We have ITC, which is up around 1%. We've seen a decentish rally on Godfrey Phillips as well. I call it more than decentish because from the start of this year itself, the stock has almost doubled. And today, the big gainer is actually VST Industries. VST Industries is up in double digits at a time when the mid-cap index is actually down by almost 1,000 points. More stocks declining for way more stocks declining for the number of stocks which are advancing. So the stock is at a fresh record high. The company has told the exchanges that it will consider a bonus along with its results on July 25th itself. Now, what's interesting is if you look at all these tobacco stocks, ITC has been absolutely flat this year, just about 3.5% higher. VST Industries, including today's move, is up 40% and Godfrey Phillips has doubled. And in the cigarette industry itself, VST has actually been a bit of an underperformer when it came to volume growth. So we have, it was just the last quarter where the volumes turned positive. So if you look at the volume trend of VST Industries and compare that to the likes of, say, Godfrey Phillips or ITC, etc., you would see that the volume growth has been much slower than the other peers and they've been losing market share. But now, last quarter, things turned around and the VST volume growth has actually turned slightly positive. So there you have Godfrey Phillips and ITC. The chart of VST comes up for you as well. You would see it was just the last quarter that they turned positive. The key triggers of the tobacco industry ahead of the budget in the first quarter is usually ahead of the budget, dealers stock a lot of inventory because they're pre-buying ahead of any sort of possible increase in the taxes for budget. And this time around, the state is not going with too many expectations of a tax increase in the budget because it was just the last year where there was a 16% hike in, the NCCD. And typically, it does not happen for 2 consecutive years already. For VST Industries by itself, remember the last quarter, they appointed a COO in the form of Sanjay Wali, who was ex-Godfrey. So, that works for them. They've also initiated the process to monetize their Azambad property, which will be completed in FY25 itself. So, additional other income coming in the company's books this year itself, if that were to happen. And RK Damani, the marquee investor in the stock, increased his stake by about 3% in the last quarter itself. So his action in the stock or his action in the company will be also something that we'll be watching out for. I spoke about how the stock has moved, but remember Godfrey Phillips has moved much faster, as a result of which, if you look at the valuation picture, at the start of this year, Godfrey was at 16 times, VST was close to around 17, 18 times, with ITC around 24, 25 times. Now ITC is 26 times, Godfrey is 32 times, and despite the 40% up move, VST is still 20 times. So it's got valuation uptake, a bonus sweetener, and some fundamental reasons as well. So let's see how that goes about.
Okay, that explains the big move on VST today, 10%. It was actually 15, 16% in the morning, but still retaining an 11% up move on a day when the market is cooling off. Rajesh, I was looking at your portfolio. This is, I think, the India Opportunities PMS, right? Now, when we talk consumer, you don't have too many staples, not even ITC in your portfolio, but we see other discretionary plays like a Trent. If I can take autos as an extension of discretionary consumer demand, then you've got TVS, you've got Hero, etc. So give us your thought process. I mean, Trent, I'm sure it's worked wonders for you. But what about the rest of consumer, staples, etc.? Any change in stance there? A lot of people expect better numbers, rural recovery, and just market positioning to perhaps help this side of things.
So one thing is very clear. We do expect the rural recovery to happen in the current year, and there are multiple ways to play this rural. One is to play through, two-wheelers, OEM companies. The few names what you mentioned, we are holding for clients. Second is the auto ancillaries, which are also proxy. They are more linked to two-wheelers, apart from the four-wheelers, but there is a more content per vehicle, and that's another big chunk of a portfolio. And third is to play through the FMCG companies. And fourth is to play through the, the consumer durable companies. So these are the 4 ways to play the rural recovery. And in each of this basket, we are holding. So we are holding two-wheelers, we are holding auto ancillaries, we are holding, the staple companies, one of the largest FMCG company we own in our portfolio. And of course, we are also holding the consumer durable companies. So that's, so we believe that the consumption will continue to do well. Rural recovery after probably 3 years of very, very low base. I think rural recovery on a low base can probably surprise the market. And on top of it, as you expect the probably from budget related, a little bit of what I would say, some relief to the consumers or some relief to the low income strata demographic kind of thing, if that can happen, then can further aid to the overall rural economy bounce. So we are having a few companies on staples as well, as far as the consumer segment goes. Okay,
I guess because the fact sheet only has the top 20 holdings, perhaps obviously it's later down these companies would perhaps come through. Actually, let's talk about one of your biggest holdings, and that's from the financial space, right? HDFC Bank. You also like a couple of other banks, I think ICICI as well. But I think HDFC Bank is a big point of debate in the market right now. There's a camp that believes that its time has to come. It's just a question of when and not if. But then there's another camp which believes that perhaps the best is simply behind, and why waste more time waiting for the recovery here? Look at other parts of the market. Where do you stand on things? I mean, obviously you're positive. That's why you own it.
Yeah, so basically we were significantly underweight on this name, and then we started, increasing the weightage in last 2.5, 3 months. Of course, the one thing which is, everybody knows this name, but one important thing is the margin of safety. The valuations are in your favor. And as the overall loan book growth, as that starts coming back to the stronger numbers, like what it used to be 2.5, 3 years back, then the stock price performance ultimately will also deliver and will reflect the AUM growth. So I think the bank will do well, and therefore we own this. But we also own many other banks. So if you look at our overall total banking, we are still underweight. Benchmark is about 29-30%. We are about 25-26%. So we are still underweight the banking as a space. And we are monitoring it. There are a few affordable housing names what we have in our portfolio which are doing exceptionally well. So if you ask me again within banking and finance, one is the NBFC on which we are fairly positive. Private sector banks is the second fairly positive, and third is basically the others, which includes the platform companies which are like digital insurance business and so on and so forth. So these are the kind of 3 baskets to play through the entire banking and finance.
All right, take that point. Thank you so much, Rajesh, for joining in and giving us your view on a whole host of sectors. Meanwhile, as we speak, the bottom of your screen, you have the numbers coming in from BPCL as well. EBITDA is a lot lower than what the street was anticipating this time around. Margins are at around 5% versus the CNBC-TV18 poll of 6%. Stock is lower in trade as well. Some of the other internals also indicate that the volume growth this time around for the company has been close to around 3.2%, and the average gross refining margins for the quarter have been $7.86 per barrel. This compares with $12.64 per barrel year on year. So there has been a big decline in the gross refining margins as well, and mild foreign exchange loss of about 3.31 crore, very small in their overall scheme of things. But EBITDA coming in at 5650 crores versus a poll of 6170 crores explains why the stock is at the low point of trade.
It's been a sort of a, barring Infosys, a trail of not so great earnings, right? I mean, Asian Paints store market positioning was different, but just in terms of numbers, Havells, Polycab, Ultratech just a while back, now BPCL. So, not the best last couple of hours, 12 to 24 hours for some of these big earnings, Paytm included, of course, big loss over there as well. Anyhow, let's take a break. On that note, we'll come back on the other side and get you a lot more on the market. Of course, we'll get you all the chatter from the street. Nimesh will join in, and then some more trading ideas coming up with Mitesh.
Up because obviously this Middle East situation could. I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is energy, and these energy stocks pay good return dividends. They're defensive, but they could be like tobacco stocks. The defense sector I first heard about 3 years ago, but in terms of my portfolio, I've missed the defense stocks. But the problem in India is what not to own. Right. So my portfolio has been basically built on where the performance of my greed and fear portfolios come from the last year, I would say in property, energy, and infrastructure. But the missing part of my portfolio is defense. So let's say there's a sudden resolution of this conflict. Maybe the defense stocks will correct, and that will be an opportunity to add.
Please rectify that for us.
And then another emerging area in which I'm not invested in, but I mean it's definitely getting more and more attention, is the contract manufacturing sector. Right. I believe you call it EMS. Yes. So this is an example of another emerging sector.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming
to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were.
Welcome back. At the low point of the day, the Nifty is holding on to the 24,500 odd. By the way, UltraTech Cement has moved to the low point of the day. Just one quick word, those margins were weak. There appears there's a one-time branding expenditure. That's the reason why the other expenditure had spiked up. We don't know the exact quantum, but that's one of the reasons why the margins did miss. So we'll keep an eye on that front. And the other factor is the fuel consumption cost per ton. That is flat quarter on quarter, while for Dalmia Bharat, you had around a $9 decrease in the fuel consumption cost. So further clarity is awaited on that. But let's go to Nimesh. He can help us out with how is he reading the dealing room action. Nimesh, after a while, right? I mean, at 3 p.m. we ask you, Nimesh, what's going on? The markets are a little bit lower.
Yes, Nigel. In fact, there are multiple reasons today for the markets to have such a kind of a fall. The index is down 1%. The Midcap index has seen a bigger run. That index is down 2%, but a lot of individual names are under pressure today. I guess the big reason is the global outrage, which is impacting a lot of businesses, and it's impacting the financial markets as well. I understand a lot of retail investors are unable to participate and execute trades, whether at a brokerage level or at a platform level, and some are facing problems with the custodian level as well. So that, I think, is one of the big reasons why you're seeing a big knock in the broader market stocks today. From a flow perspective, from the larger FIs, even there I understand there is a bit of forced selling as well in the leverage names. So that explains that the mid-cap index is down 2%. But look at the momentum sectors. All the high beta sectors, including metals, real estate, PSUs, all are down between 2 to 3%, 3.5% as well. So looks like that's where the pain seems to be. Also remember, there is a lack of buying interest as well out of the big event, which is budget, which is next week. And in general, there is a bit of nervousness as well going into the big event because of the risk of maybe there could be something as regard to taxation. So even that's adding to a bit of pressure in today's market. But net, I guess a lot of retail investors have not been able to participate. And also there is a bit of forced selling, which has led to a big sell-off in the broader market stocks today.
All right, that explains the move, Nimesh. Thanks a lot for that. That's about the broader markets in general and markets on the whole, actually. But a lot of individual stocks on your radar. I mean, as we move into the results season, a lot of these promoter lock-ins and all these lock-ins begin. So does that still keep the deal street high when it comes to all the block deals, etc.?
Well, not block deals, but at least fundraisings, QIPs that are still pretty much on the cards. And even the non-promoter holders can keep selling blocks, right? So that's something which is going to continue. But in terms of individual names, the first stock is ITC. Surprisingly, just 2 days before the budget, to see a bit of confidence in a stock like ITC is a bit surprising. So that stands out for me. There are very strong buy flows at FIDS is what I understand. So it looks like some institutional interest is back on that stock. And remember, the record date for the demerger of the hotel business is still pending. So even that seems to be a trigger to watch as far as ITC is concerned. The second stock is Jyoti CNC. Again, well, the stock has been consolidating. Today, with the carnage, even that stock is down 6%. But now I understand there's going to be a large block deal very soon in Jyoti CNC. And the last one is Vodafone Idea. Surprisingly, in the last few days, despite good news, that stock has been under pressure. In fact, it shaved off almost 12-13% from the recent highs. And one of the reasons is that one of the leading domestic mutual fund was an aggressive buyer in the FPO. They seem to be booking out some profit in Vodafone Idea, and that's been the key reason why of late there is high delivery-based buying or selling, and the stock is under pressure because of that reason.
Okay, all right, Nimesh, got it. Thank you very much for all the buzz and all the chatter there on the stocks that you've picked up today. Well, let's go back and focus on BPCL. That stock's still nursing a loss of around 4.5%. There you go. The numbers are still on your screen. That EBITDA is way below estimates. Sonal is here with the fine print. Sonal, not quite what the street expected?
Well, yes, it's lower than what the street was working with. It was expected to be lower on a quarter-on-quarter basis because the marketing segment was supposed to see lower margins. Even GRMs globally have seen a big decline as well. Petrol and diesel cracks both are down on a quarter-on-quarter basis. Now, if you look at the internals, let's just talk about the headline numbers first. The revenues are down 2.6%, EBITDA is down 39%, margins have come in lower at 5% versus an expectation of 6% versus a poll of 8%. Net profits are down as well, just 29% versus a bigger EBITDA decline. That's because of two reasons. Depreciation, that is lower on a quarter-on-quarter basis, and taxes also are lower on a quarter-on-quarter basis. That's why the decline in net profit is lower than that of EBITDA. Now, if we talk about the internals, the refining margins are better than what the street was working with. They have come in at $7.86 per barrel versus a poll of $6.7 a barrel. Even the highest number on the street was around that $7.50 per barrel. So refining has done well here versus the street expectations, though it has declined on a quarter-on-quarter basis. So it looks like there's a bigger miss in the marketing segment. The marketing growth volumes have been lower than expectations. The refining throughput has been lower than expectations as well. So it looks like it's a volume-led miss this time around. We'll get more details in terms of what the inventory loss or profit was this time around. But this time around, the miss is largely led by marketing segment. Refining is slightly better than what the street was working with.
All right, Sonal, thanks a lot for that. That explains BPCL numbers. Refining has been better, whereas the marketing segment has been weaker. And the volumes out there have been lower than expectations as well. In the bottom of your screen, you also had some news and update coming in on Zydus Life. It's been a big mover. Some updates from the US FDA. One of their plants has gotten 2 observations as well. That stock nursing a cut of almost 3% right now. Nothing big. I mean, no different from what it was for most part of today's trading session. Good time to rather get you, trades for tomorrow or for Monday. Mitesh joins in for the reverse trade on Monday, buy or sell or buy as well. Mitesh, what's on your list?
I have 2 STVT calls. One is Voltas with a stop at about 1486 for targets of 1455, and Excite after a long time, is showing signs of profit booking. So Excite is a STVT with a stop at 545 for targets of 530.
Okay, all right, got it, Mitesh. Thank you very much for being with us today and through the week. You have a good weekend, and we'll connect again on Monday. Take a break right now. We'll be back with more market talk in just a bit.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter-century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV.
Welcome back. Well, it's a market that's really desperately trying to hold on to yesterday's low. Remember, Nigel was saying that at the start of the show, and the low yesterday was just around the 24,500 mark. Let's see. I mean, maybe just about 8 minutes. Perhaps we will, save it. We have Hemang Jani joining us on this leg of the show, and we also have Abhishek with us. We'll get into the HDFC numbers in just a bit. Hemang, hi. Afternoon. Sell-off going on. Have you bought anything today?
Good afternoon, Surbhi. I think after a long time, we are seeing a meaningful correction in the market, both at the index level and in the broader market. While the run-up has been so swift, and we are not used to seeing this kind of correction, so it kind of surprises some people. But I think it's pretty normal. So wherever the numbers have been good and overall valuation comfort is there, we do look out for buying opportunities. So maybe in some of the IT names, HDFC Life, some of the private insurance plays. Oil and gas has been a space that we've been liking. So wherever we are seeing a meaningful correction in companies like ONGC, GAIL, we are kind of looking out for buying opportunities. So overall, I think things would stabilize, because we have to bear in mind that this just confined to India, but globally also. Last 2 days we are seeing a bit of correction in the US markets, and currency volatility is also there across. So I think we should brace for some more volatility, but it will sure present great opportunities as well.
Right, speaking about opportunities, one of the spaces which hasn't done very well is the private banking space in general. And two of the bigger banks, we have HDFC Bank and Kotak Mahindra Bank, both of them expected to report their numbers tomorrow. Abhishek joins in to tell us more about what the street is factoring in from both these big boys, HDFC Bank and Kotak. Abhishek.
Well, Mangalam, HDFC Bank had given a hint with respect to the business momentum, wherein the CASA has declined. However, liquidity coverage ratio has improved. So deposits were flat on a sequential basis. CASA ratio down by nearly 200 basis points quarter on quarter, and advances were down by 0.8% sequentially. So analysts are expecting net interest margin to remain flat. So Kotak Securities and Morgan Stanley, both of them are estimating net interest margin to be flat on a sequential basis at around 3.4%. Now, Philip Capital and Morgan Stanley estimates slippages to be at 8,000 crore versus 7,300 crore in the previous quarter, which is seasonal in nature. Q1 slippages are slightly higher for all the lenders versus Q4. So credit cost is expected to decline quarter on quarter. Morgan Stanley estimates 181 basis point decline in the credit cost on a sequential basis. Asset quality largely to remain stable. Again, we have Philip Capital that estimates gross NPA ratio at 1.25% versus 1.24% in the previous quarter. Now, we cannot compare the YOY numbers because of HDFC Limited's merger. So, sequentially, NI is expected to be up 1.7% YOY, and PAT is expected to decline 5% on a sequential basis. Coming on to Kotak Mahindra Bank, the key thing to watch over there will be the deposit growth momentum that will be seen closely. Loan growth expected to remain healthy. So, loan growth as per Philip Capital is estimated to grow at 17.5% YOY and about 2.7% sequentially. Net interest margin as per Morgan Stanley estimate is expected to decline 34 basis point YOY and about 5 basis points sequentially. You need to watch out for the low cost deposit ratio, how that behaves. It has been on a declining trend for all the lenders. Last quarter for Kotak Bank, it was at 45.5%. Slippages are seen 1,400 crore as per Morgan Stanley versus 1,300 crore in the previous quarter. Seasonal in nature, asset quality expected to improve. So our poll suggests NI growth of 13.5% YOY and about 16% YOY growth in profits for Kotak Mahindra Bank.